Welcome to the ABG Investor Days. My name is Johan Brown, a retail analyst here at ABG. We now have the pleasure to welcome Actic and CEO Anders Karlbark and CFO Stefan Ebberyd. The floor is yours.
Thank you, Johan, and thank you, ABG, for having us here. We are looking forward to share with all of you some insights around Actic. My name is Anders Karlbark, and I'm the CEO at Actic since December 2018. And with me today, I also have our CFO, Stefan Ebberyd. He will come in later in the presentation. If we look at the agenda that we will go through today, we have 5 overall points. First of all, we want to share with you our arena, the training, health and fitness arena, and also who we are. We want to share a strategy, and we want to give you a business update. We're going to do a quick summary and then open up for the questions from you, Johan. First of all, then, our arena and who we are. And these figures that we have on the screen are pre-COVID figures. But the takeaway here is that we operate in the Nordics, we operate in Germany, and both of these markets are forecasted to grow in Nordics with close to 4%, and in Germany, which is the biggest fitness market in Europe, with around 3.4%. Even though Sweden and Norway have a high penetration rate, meaning the amount of gym memberships compared to the population, there's still a forecasted continued growth within these markets. So overall, the arena is growing. If we look at the Actic focus, we are mainly present in medium and small-sized cities. So, for example, in Sweden, we are not in the central of Stockholm, Gothenburg or Malmö, but we have a high density of sites at Uppsala. So our target is to operate in medium and small-sized cities, which means for us a slightly less competitive landscape. We do not see the introductions of boutique concepts, and we're not as influenced by digital aggregators so far. We also, to specify that, in Sweden, target city 4 to 50, which means Uppsala down to Sandviken. And within this, we look at cities that grows equally or more than the country average as total. So we operate in cities that are growing as the market. Moving on to some Actic information. First of all, some numbers. We're going to go more into that later on in the presentation, but rolling 12, we have a yearly turnover of 816 million with a high impact of COVID. COVID has been negative for us throughout the year, and we'll double click a little bit on that in a later stage of the presentation. We have an EBITDA of 271 million, 111 million excluding IFRS 16. We have 177 sites at the moment. And if we look at the business composition, the Nordics, which is then for us Sweden and Norway, are the majority of the turnover. Germany less with 12%. If we look at our product mix, and this is revenue shares, the gym memberships is the main part of our revenues. We have PT, personal training. We operate baths, that's 3%. We have some other revenue as well. And then we have digital, which at the moment stands on 0 and something that we view as a totally untapped possibility for the company. That's the product mix today. I believe it will look different year on year ahead, and I think the digital aspect has a huge potential to grow ahead. Our mission, we have a mission to offer the most convenient and inspirational training arena in medium and small size cities. Convenience, because that's the number one most important thing when choosing your gym, convenience, being close to your gym, and that the gym and the training is convenient. That goes for placement of site. It also goes for opening hours. It also goes for how you operate your digital product and open up for convenience. So convenience is huge important component when we look at the business logic of the fitness arena. Inspirational, because that's how you attract new members. You also build loyalty, and you also want to build an experience at the site so that you get the members to do their training as well. And the medium and small size cities represent our current expansion strategy. And with the training arena, we want to highlight that how people now consume training is not only going to the gym. It's at the gym, definitely. It's outdoors, but it could also be at home. It could be at your office, wherever you are. So we want to really broaden the aspect of what and how you can consume training with the mentioning of training arena. Our core company values, passion for a healthier society through exercise. That's our vision, and this is really a core strength within our company. We attract and keep a lot of people whose drive is to help other people live more and feel better about themselves and have a more healthy lifestyle. Customer focus, also a strength. I think we are really focused on finding new ways to understand our customer and adapt accordingly. We have performance, constant improvement, growth, and this is something that we have added during the last year to get a more business focus within our whole organization, where passion and customer focus has been there clearly, but performance has not been as clear. So we believe that that's an important part of doing business in this area. And then we also have teamwork, something that we believe a lot in, and working together. As we're quite a small company, a small support office, we need to do things together in order to be successful. Quick view at our offer. We split that in three. Indoor offer, that represents gym and also the baths that we operate. And that's the main part of where our members are training. We have outdoor, which is a growing part of our business, and something that we have done a lot of tests in to move the needle further. Here we want to really take a position to be best in the market at outdoor training. And then we have digital, which mentioned today is at 0%, but a huge opportunity going forward, seeing how members now consume training. Quick look at our history. We have a history of M&As, and we have a history of growth through M&As. Some has been really good, some has been not as good. And here, if we look at also our greenfield expansion and new sites, they have also been of varied quality. We've been slightly opportunistic, and what we have done here is to set up to be a lot more strategic and really work more strategic with a roadmap expansion going ahead. We have hired a expansion manager coming from H&M, who has run the expansion for H&M in Sweden for 5 years, is now part of our organization and running and setting the targets for how we would expand going forward. That's quickly an overview of who we are. Here you can see our financial targets as they stand today. They have not been changed. We have a growth ambition, and as you could see, we have had a growth over the last couple of years. And our mission is to grow 5% organically and with additional growth from acquisitions. So we still continue to look at acquisitions, but also focusing on the organic growth. Obviously, 2020 is a strange year in many ways, and therefore, of course, 21, depending on the recovery, this would look different, but it's all depending on when we are able to operate under normal circumstances again. Margin aim is 20% EBITDA, excluding IFRS 16 in the mid-term. This has been one of the challenges for the company to live up to, and we have really put a lot of effort into increasing our margin baseline. We saw that when we were able to do a comeback in Q3, that we were able to perform on these levels, even though we lost revenue. So our definite aim is when we go back to normal, we're able to build back our member base. This is still a relevant target for the profitability of the company. Capital structure, if we look at net debt to adjusted EBITDA, if we go back again to the Q3, we had a net debt ratio of 3.1. But obviously also that will be influenced depending on how the pandemic develops ahead. We also have the dividend policy as it stands over there. That's our financial targets today. We wanted to mention quickly the cost structure and how we've been working on that. If we look at the sold membership to start with, we have a quite high gross margin on another sold membership because it doesn't really drive any additional cost, maybe some additional rent, but it does not drive hours, it does not drive any cost of goods. So we have a high gross margin on each sold membership. Going into this, rents, we have a semi-variable rents. We have a flexibility in a large share of revenue-based rents. That of course helps us to be flexible when it comes to tougher times, but also when it's better times, there is part of our portfolio that's also fixed, which will help us to drive profit up. Personnel costs is where we have seen the biggest upside in optimizing our efficiency. We have looked at a lot of other industries. We have done a lot of benchmarks, and we have reworked all schedules in all sites. We have this Monday released a press statement that we are optimizing our staffing. This is the last step in this progress, so that we are set up to operate on a much more efficient terms than what we have done historically. So this is a big change for the company. We have also seen that with this efficiency, we can sell as many memberships, if not more. So it's not that we then scale down on customer experience or sales with higher efficiency. It's purely a profit driver. Other thing that I want to mention is that we have central costs, support costs. It's also where we have done a lot of changes. We have changed a large share of the support team to be able to work more digitally and to be able to set up for physical growth. So here we have worked a lot with reallocating costs and really set up a support office that is able to scale when we go ahead, and then when we start to drive growth again, that we can scale this and the share of costs will go down. Next slide, please. Quick look at our strategy. We start with the Jim Collins good to great hedgehog concept. This was one of the things that we started out with when what's the core of what's Actic in terms of the strategic aspect. So again, if you start to the bottom right of the screen, a healthier society through exercise, that's our vision. That's what I found coming into the company. It's really a core strength. We have a lot of employees that work in this industry at Actic because they can make a true difference in people's lives. That channeled in the right way, I think, is a fantastic strength for the company, but it has to be channeled in the right way and not all over the place. But it's a great start and a building stone. If we go to the top of this ring, I think we as said, are what we can be the best in the world at. We believe we can be the best in the world at offering the most convenient and inspiring training arena with what we have said before, and that's our aim, and that's also our ambition within this. What drives our economical engine? Our main economic engine is driven by the memberships, which gives us a strong cash flow and a great opportunity to continue to invest ahead. Those are the three aspects of our overall strategy. If we move on, a quick look at this one. We can say that market trends are maybe not currently so attractive given the COVID situation. But if we look before and if we look at the communication now, is that a healthier life will be even more relevant and more important, and training as part of that is clearly a key in order for people to grow. We see active lifestyle. We do see a lot of people that wants to go and train, or even though with all these restrictions. And we see that from students to seniors. So it's really broad mass of different people that wants to train. We also see digitalization being something that grows quickly ahead and something that we have been investing in and want to be on top of. Other than that, our platform for growth, which is the organization chart. We have changed and reallocated costs to our organization to be ready to grow. Down to the left, we've mentioned that a couple of times. We have a historic of growth. We have an ambition to grow, and we have an attractive cash generation. Last year and end of last year and this year has been to truly change and set up in a different way. And to the bottom right, we are the market leader in many of the small and medium-sized cities with our number of clubs. Continuing quickly with the overall, and I'm going to mention a few points here on these four different blocks. The geographical strategy is the omni strategy. So we believe in having multiple sites and the training arena in the cities where we operate. So if we take a city, we want to have a destination site, a larger one, preferably with a bath. And then we want to have a couple of other standalone gyms. At home locations are stronger now than before, and at work locations. And the key here in the geographical aspect is to match the potential of number of members to the location and space. That's the core driver of profit at the site, to set up with the right location, but also the right space. And I think this is something we have been very good at before. When it comes to our product offer, what I want to highlight here is that we have an ambition to be the best. And we have recruited a team within training that are the best in these markets which we operate. And we believe that the digital aspect of training opens up for a lot of interesting new sources of revenue, such as PT Online, corporate sales, now having a lot of people working from home. We do not want to gather all of them in a group X, but rather activate them where they are. And we also see the potential of premium training programs as such. Operations excellence, here I want to highlight that we've worked a lot to make sure that we utilize the strength of our chain and operate with high efficiency. And that has given us a better cost baseline. For our brand, we have an ambition to move out of and break out of the category and stand out and build a lifestyle brand within health and exercise going forward as well. Next slide, please. Quick business update. And as a first part, we were hit by the first wave of COVID, and now we're hit by the second wave. This is in Germany, we have all sites closed. In Norway, we have some sites closed. But the development in Sweden is that we're open, as are the majority of all other operators. But of course, we are heavily impacted by lower traffic based on the governmental recommendation not to visit gyms, and that has impacted our sales in a negative way. And that's why we have communicated that we believe it will be a really tough quarter sales-wise. But I'm also confident that we have a quick recovery when the restrictions are lifted. Other than that, I've mentioned some of the customer trends, but really what has happened, it has accelerated outdoor and digital, and at home locations has really changed during COVID, and something we believe ahead as well. What we do here, I think we continue to invest digitally in outdoor. We believe that's where we can move the needle the most. And we will release a new training app next week, which we're really proud of. We think that that's the start of our digitalization. We will also move forward with more outdoor boxes, something that we have tested that has been a complete success. We will also move forward with that during Q2 in next year. Moving on. Some financial highlights from Stefan.
Yeah, thank you. I'm not going to repeat what Anders just have said, but what you see here is the rolling 12 numbers compared to the full year 2019 figures. The key takeaways here is that the sales is highly affected by COVID. As you can see, we have a big drop in sales. However, we have worked a lot with cost control, and hence we have EBITDA that are in line with 2019, and increased margin up to 14% before effects of IFRS 16. Regarding the cash flow, as you can see, we have a high cash conversion. And the cash flow amounts to 102 million compared to minus 45 million last year. And hence we have increased our net debt to 3.1. So that's mainly the key takeaway. Back to you, Anders.
Thank you, Stefan. Managing time as well. So we move on here. We're summing up then. What we want to highlight as main takeaways is second wave of COVID creates turbulence. Closed markets, but also the recommendation not to visit gyms in Sweden. It's challenging, but we showed in Q3 that when the restrictions are lifted, we will be quick to have a strong comeback, and we can create results quite quickly after that. But we need to get through a challenging period. We have focused on operations excellence and cost efficiency a lot during 2019. So going into this year, we are confident that we have our house back in order, and we have a significantly stronger margin baseline. We showed that in Q1, that first 2 months were strong. We showed that in Q3 as well. And our main headline here is that we have set up for growth now. We believe that we have a flow in our organization that enables growth, which we did not have before. We believe digitalization. We believe in digitalization, and that drives our development agenda. We, with Actic Anywhere, our product that will be released soon, that will be the base for digital growth. It will be an app, and there are many apps out there helping and guiding through training. We think that this one that we release is really, really good, but it's also just the start. We think that the digitalization of training is super exciting and something that we will and want to be part of driving for the whole industry. And last but not least, we want to highlight WHO's clear statement that was released also last week. Pandemic or not, people must stay active. And this is what we are passionate about and how we navigate this pandemic. We try always to find new ways to make sure that people can stay active, follow the restrictions, but can stay active. And this is what we're passionate about, no matter pandemic or not. But people must stay active. Otherwise, we have more problems ahead than what we have currently. That's it from me and Stefan. Thank you so much for listening. Johan, over to you.
Thank you for that presentation. So a few questions from me. If we start with the average revenue per member and the sort of the building blocks going forward, how do you think we should think about that? What are the dynamics impacting this?
Short term, it's challenging. We have the closed sites, and the whole Germany will obviously drive average revenue per member down because we have zero revenue in these markets. So that's a huge impact. For Sweden, what we have done here is that we have auto-freezed the memberships for everyone that is 70 plus. And if they want to come and train, they're allowed to, but we're really auto-freezed. And that's a large share of member base now taking with zero revenues. Something that we feel is important to take responsibility. So Q4, it's going to be really tough based on closed sites mainly, but also the freezing some memberships in Sweden. If we look ahead, our ambition is to make sure we build in more value in our membership. So the pure membership, we believe that we have an opportunity to build in value and increase average price slightly. We also believe that PT will grow over time. It's tough to say when because we are losing a lot of trainers currently. We believe that we will need to do campaigns when this is lifted to take back members quickly. So that might tick the price down, but not too heavily. But we believe that we will need to be quite aggressive when restrictions are lifted to get members back quickly.
Yeah. So. Looking at that last part and the sort of marketing spend per new customer, the customer acquisition cost, do you think that will affect margins going forward, given that many will try to sort of win back the customers?
I think that there will be more campaigns than ever in January if the restrictions are lifted then from all competitors. We have seen that they're slightly aggressive. There is a period everyone is quite aggressive and work in this industry. You work quite a lot with heavily discounts under normal circumstances as well. So I believe that we will need to slightly increase marketing. I think that's important to get the members back. I think that should be the priority. But we should also understand that members will come back to the gym most probably where they were last time because convenience is such a driver to the membership. So it's also about targeting right members, finding where they are close to our site and get them back, the members we have lost. So we believe getting the members that we have lost is an easier way, continue to build more membership that will require maybe a little bit more market investments.
Yeah, so a last question from me is about the liquidity position. Are you confident in that given the current situation?
If you look at Q3, we had a cash of 150 million, and above that we have 77 million in available cash in unused credit limits. So I think we have a strong cash position if you look in matter of cash.
Great, thank you very much. With that, our time is up. I thank you, Anders and Stefan, for your presentation. So yeah, thank you very much.
Thank you, Johan, and thanks everyone for listening.
Thank you.
Bye-bye.
Bye.
Hello and welcome to ABG's Investor Days. My name is Sofia Jaspermyr and I'm an analyst within the Industrials and Renewables team. With us today we have Arise CFO Linus Hägg that will start off with the presentation followed by a Q&A. With that said, please go ahead, Linus.
Thank you very much, and thank everyone who's attending the presentation today. I'd like to talk through a little bit about Arise and also some comments about the last quarter numbers, etc. So please, next page. Arise, we develop renewable energy for a sustainable future. By that, we want to be the partner for our investors throughout the life cycle of wind power and help them create value, and of course for ourselves. We still also own power producing entities, and of course we want to maximize the value of that production through professional operation management, sales and financing. Next page, please. So currently Arise basically has three business areas. One is project development, where we have a project portfolio of some 1,300 megawatts. And the business here is basically to develop projects with a view to sell them on to financial investors, so basically earning project profits as and when they materialize. Through that business, we've also generated another business that we label asset management, and that is basically taking care of the wind farms that we sell to these financial investors who typically don't have the capacity or will to locally manage their assets. So currently we have some 1,100 megawatts under management for various number of financial investors throughout Sweden and also in Norway. Thirdly, we have our production assets, which comprise 139 megawatts located to the south in Sweden, and they represent an annual production capacity of some 343 gigawatt hours. And the business as such was founded in 2007, and the production was really the starting point, where we started out with a view to become an IPP, basically, that is an independent power producer. So we developed projects with a view to build them and own them and finance them ourselves. But over the years, we have changed that business model to accommodate the market developments, etc. So I would say since 2014, we started selling projects. And since then, we have sold some 900 megawatts. And all in all, we've built approximately 1,000 megawatt of wind power. So the roots come from production. I think that has been very important in developing a successful project business, but also a successful asset management business. But currently, the business now is very much tilted toward development and asset management. And currently, we have one project under construction that is 231 megawatts up north that we sold in Q4 last year. Next page, please. So coming back to the last quarter, sales came in at 24 million compared to 58, obviously a dramatic decrease. However, I'd like to point out that a lot of the decrease comes from the fact that we did not have any civil works coming through our books this quarter. And civil works in our books comes via the income line item, but also through a cost line item, so they basically wash. But all in all, due to the lower sales, EBITDA was down by 21 million, and that basically is not so much driven by the civil activity. It's rather that the price mix that we generated in our production was negatively impacted by current weather situation, mild weather, big hydro reservoirs, basically meaning that hydropower was going at full speed, whether there was wind or no wind, etc., pushing down prices in this quarter. But I will come back and speak to the power price development. But I think on the positive side, we had an operating cash flow of 49 million, and that is due to that we reached the final stage in Enviksberget and Bröcklingeberget. Those are two projects that we sold in 2018, and they were completed, and we also received the last payment from the investors in those projects, contributing to a very good cash flow in the quarter. Looking at the production side, we came in at 68 gigawatt hours, which is very much in line with normal. However, our average price was 211 krona per megawatt hour, and that is obviously very disappointing and low. And again, this is due to the fact that we've had a very, very special power price year due to mild winter, a lot of precipitation, creating big hydro reservoirs. And I think on top of that, we also have, of course, the pandemic, which has an impact on consumption, but also on fuel prices that indirectly plays a role in the Nordic power market. So events during the quarter, we managed to finalize the work on our lifetime extension on our operating fleet. So we're now going from an average of 25 years to an average of 30 years. And this will have some 10 million SEK impact on the depreciation line item. However, more importantly, it obviously substantializes the value that we have in our operating fleet. So we're very happy that we came to a final outcome in that work stream. Also, we signed new full service agreements for our GE wind farms. That is also very good for the production portfolio because we now extend service contracts for another 5 years with what we call then full service, and that means that Arise does not take any component risk. So basically, we managed to reduce price, extend the full service, and also maintain a very high availability warranty under the contract. So we're very pleased about that. And finally, after the quarter, we completed the refinancing announced. So we took up a bank loan of 40 million euro, which will dramatically reduce our net financials going forward. On group level, we will go from some 65 million of net financial to less than 25 million in net financials. And also after the quarter, some 37 million of convertibles were converted into shares. So the net financials will drop even further than the 25 on the back of that. Okay, next slide, please. So coming back to the power pricing environment, as you can see on the left top table, power prices have come down spot-wise quite a lot. And we were hoping for a slightly better situation coming into the autumn, but as you have seen, the weather has been very mild. It's been a lot of water building up in the reservoirs again, so we have not really seen the positive effect that we were hoping for. But obviously the winter is coming, and we hope that the hydro situation will reverse over the winter. And I would like to point out that, I mean, when you have such an extreme year in terms of weather, you know, it's not going to happen every year, but it happens now and then. And when it happens, it means that, you know, if you have a hydro producer with high reserves, you know, they need to produce regardless of whether the price is high or low, because otherwise they waste water basically. So that means that when you have a situation with a lot of wind and a lot of hydro production, the price inevitably becomes low. Whereas in a normal year or in a dry year, this impact is much, much smaller. And I think on top of that, going forward, we see the phase out of additional nuclear by the end of this year, which will also have an impact in the Nordic system going forward. And finally, of course, as I mentioned, Corona also have an impact in this. It's difficult to quantify, but we know that consumption has been down somewhat, and we also know that fuel prices have been affected. That is oil and coal. You can see this effect partly also on the forward curve, where we on the bottom table represent calendar 2023 pricing. Obviously, it's not as dramatic, but still the spot market is also driving the forward market to some extent. More interesting, we see also that new technologies are emerging, both base industry innovating themselves out of carbon. If you look at the announcement by LKAB a week ago, that's very interesting. We see battery factories coming online, and of course, increasing number of data centers, which are big power consumers as well. So there is a very exciting and positive ongoing trend if you look to it macro-wise. Obviously, in what time frame it will have a big impact is difficult to say, but you know, the underlying sort of trend is very strong for us. Next slide, please. Looking at the certificate market, as we've been saying, you know, this market basically crashed after a proposition to extend it for many years. However, there was a new proposition coming out, which basically puts a stop to the system by 31st of December 2021. And that has now been ratified, but still, even with that sort of stop, the market expects there to be a big surplus when the system closes. And I think to the extent that surplus has been overestimated, you know, there could be some dynamic in the market also going forward. But let's see, you know, we'll have to wait out and see how much terawatt hours are awarded certificates under the system before it shuts down. But we think where it's pricing now, it's basically an optionality. And if there are sort of short-term spikes due to squeezes, etc., you know, that may occur. But we're currently pricing at maybe 2 SEK per megawatt hour, so it's very small numbers and nothing that we really, for our business going forward, we don't really calculate with a big upturn in the certificate market. And I should also mention that certificate really only plays a role for existing assets, and any project that we look to sell now will by definition not be part of the system, and hence it's nothing that really the investors look to anymore when we sell a new project, because basically they do their calculation or investment decision based solely on a subsidy-free investment. Okay, next slide, please. So what this boils down to in terms of market pricing, as I said, we received quite low prices. You can see that on the left-hand side. Production in line with normal, and continuously we have 60% hedged this year on a P50 basis. Again, hoping that this situation will reverse over the course of this winter, but we'll see. Next slide, please. So if we leave production for a while, if we look to our project development business, we've had 3 projects under construction this year. Bröcklingeberget and Enviksberget have been finalized and handed over, and we have received the cash proceeds we were expecting. I should say that in Bröcklingeberget, we may receive additional margin and cash flow due to some ongoing discussions with the sub-supplier, but it's still too early to say. But that may be the case going forward. I should also comment that on Enviksberget, the cash flow received also includes a grid reimbursement from the project Svartnäs, because that we sold a few years back, because Enviksberget basically connects to the same connection point as Svartnäs, which means that the Svartnäs got a reimbursement that was funneled through to us. And finally then Skaftåsen. This is a project that we sold in Q4 2019 to Foresight. Construction is ongoing and is all going according to plan, and we expect it to be completed towards the end of next year. We recognized some gross margin in the quarter and expect cash flow. The next sort of cash flow event from the project will be in the first quarter of 2022 upon completion of the project. Next slide, please. Okay. What we've been doing over the last few years from a balance sheet point of view is obviously to continue to push down our net debt levels. We currently have some 435 million of net debt, and 177 of that is actually convertible bonds, which are deeply in the money. So I think we've come a long way in this effort, and I think with the refinancing that we completed in October, I think we now are where we want to be in terms of leverage on our production. So looking at the refinancing that we just completed, it was again a 40 million euro loan, and the reason for us choosing euro as currency is basically that the assets are priced in euro. So I mean the underlying value is in real terms euro denominated. We also have the income side stemming from euro, i.e. we sell power on a euro basis, so it makes a lot of sense from a natural hedging point of view. And the all-in hedged cash interest is below 1.5%, which we are very pleased with. On top of that, of course, there are some non-cash items for arrangement fees and so on, but the cash interest is below 1.5%. We have a sculpted amortization profile between 600,000 and 900,000 euro semi-annually, with maturity in September 2023. And this refi is really, the financing for our production fleet and nothing else. So again, our 10 wind farms in the south are secured against this loan. Upon completing the refi, we had some one-off effects of some 34 million, and this is mainly due to a SEK swap for the old loan that we terminated. And most of that 34 million, I think about 33, is already reflected in our consolidated equity as we apply IFRS 9 hedge accounting. So it will have a P&L impact, but not an impact on equity. On top of the loan, the secured loan, we have the convertible as mentioned, which is at nominally 217 million, IFRS 213. And they are convertible into shares at 22 kronor per share, and it matures in 2022. And as I started out mentioning, some 37 million was converted after the end of this quarter. And after the refi, we still hold a cash position pro forma of 95 million. And again, looking at the effect of this refinancing is basically that the group net financials will decrease from some north of 60 to below 25. net financials for our production side, if we just isolate the 40 million euro loan, will go from some 42 million to below 8 million per annum. So this is a massive improvement for our business going forward. And if you look again at the production alone, this refi coupled with a life prolongation, which takes down depreciation cost, coupled with lower service cost, we think really paves the way for profitability also in our production operations going forward. Of course, we won't be profitable in a super wet year like this, but in a normal year in terms of power pricing, we see a lot of potential now going forward. Next slide, please. So finally, on our pipeline, obviously this is a bit of our gold chest. We have some 1,300 megawatts of pipeline that we look to develop with a view to sell over the coming years. Currently, we're in the process to sell Ranasjö and Salsjöhöjden, some 240 megawatts. The ambition is to close it before the end of the year, but you never know with projects, it can also slip into the next calendar year. Levo, a smaller project to the south, which is fully permitted, that we hope to realize next year or the year thereafter. Fasikan, also fully permitted. However, concession work is still ongoing for the grid. That's also a project that we look to realize in the next year or the year thereafter. Kölvallen is probably our best project. That's still in the courts in relation to the environmental permit, but we are optimistic that we will have a favorable outcome and hope to realize the project sometime between 2021 and 2022. Finwire also in the court system, again with a similar timeline as Kölvallen. I should say that Fasikan, Kölvallen and Finwire are all super wind locations, and that's why they are labeled to the excellent type of label. Finally, on the late stage development portfolio, we have Tormstay located in Scotland with super wind conditions in the north of Scotland. We've handed in an application, we will hand in an application shortly, but in Scotland the system is a bit different. You have to do a lot of work prior to handing in that application, and the work done so far has been, I think, very promising. We also have communicated an early stage development portfolio, which is located in certain price areas in Sweden, Norway and Scotland, all in all some 460 megawatts. And I think this is basically adding on to the late stage development portfolio in time. And we have screened a number of thousands and thousands of megawatts in order to qualify these from a wind, conflict, grid perspective. So this is an early stage development portfolio that is very much filtered already. Turning to the next slide, please. Well, summing up, we hope to sell the projects Ranasjö and Salsjöhöjden late this year. We look to progress, grow and diversify our pipeline. That means basically to grow that pipeline both across new geographies but also in time. And of course, having sort of laid a couple of tough years behind us, focus is now on profitable growth. Thank you.
Okay, thank you for the presentation, Linus. Now I have some questions. So the lack of the capacity in the grid is a hot topic here in Sweden. So I wonder if this issue will affect you, and in what way?
Yeah, I think it of course has an impact on us, and I think they are both good and bad. If you look to pricing in the southern parts of Sweden, where we have our operating fleet, we can see a big price delta to other price areas. So it offers a lot of support going forward to that fleet. I think it has a slight negative impact on projects up north, but I think one has to view that in light of the system and also the big investment packages announced by Svenska Kraftnät, the Swedish TSO. So I think it's now become such a hot topic that it's become politicized, and that means that we think finally that also means a lot of pressure towards the stakeholders who are basically responsible for making sure that the grid is robust enough and that the price divergence between areas is not too big. So we think I mean, over the years going forward, we have a strong feeling that this will have to be rectified, i.e. that you strengthen up the backbone grid in order to allow more power to flow from the north to the south, particularly also in light of the phasing out of nuclear. But it will take some time, but I think it's really positive that Svenska kraftnät has announced a big investment package that they did, I think it was a month back or so.
Okay, thank you. And in your latest report, you stated that you actively search for new growth opportunities. Can you please elaborate further on this?
Sure. I think, I mean, in the last 5 years or so, we have, extended our portfolio quite a bit. There were a few tough years when we managed to snatch up project rights quite, on price, quite good price levels. I think where we are now, there's a lot more competition for new projects, or basically for projects that are sort of mature in their development phase. So that means that we have sort of opted out or opted into towards a more greenfield type of business model in relation to sourcing new projects. And I think that's also, our DNA to greenfield projects, although we have quite a lot of rights in the past as well. So I think what we're doing is sourcing project rights in Norway, Scotland, which we also have been doing for some time, but we're also actively looking into potential situations in other geographies that we currently have not mentioned. I can't really mention which geographies. We'll just have to come back to that once we've come a bit further.
Okay, thank you. And lastly, I wonder how you work to meet the price pressure from other renewable sources.
Well, I think it's not really up to us. I think that's basically, you just have to look across the playing field, of available technologies. And I think if you look to the Nordic market, onshore wind power by far has the most competitive levelized cost of energy. That is not, the same in all geographies across Europe, of course. I mean, it's not a coincidence that investors are, investing in wind power to the north of Europe and solar to the south. So I think wind power has a super efficient levelized cost of energy up north, whereas solar has a super efficient cost of energy to the south. So obviously, the way we sort of funneling that through the market is basically adopting the latest technology all the time, so that you all the time get the best levelized cost of energy available in the market.
Okay, thank you for the presentation, Linus, and all your answers. We are very happy to have you here and hope to see more of you ahead.
Yeah, thank you very much.
Thank you.
Thank you, everybody attending.
Hi, my name is Rickard Anderkrans. I'm a healthcare research analyst here at ABG Sundal Collier. Today I have the pleasure to introduce Gisli Hennemark, the CEO of Surgical Science. So without further ado, I will hand the word over to you, Gisli. So the floor is yours. Welcome.
Thank you, Rickard, and thank you for inviting us to be part of ABG's Investor Days here. My name is Gisli Hennemark. I'm the CEO of Surgical Science, and I'm here in the Kista office, so it's grey morning here. I don't know wherever you guys are that are listening, but I'm going to run through a quick overview of the company, and then there will be some time at the end for questions. So we can jump into the presentation, Rickard. And there I see the new slide. So Surgical Science vision is that everyone on their way into the operating room should know that the surgeon has been trained and objectively certified in a safe simulated environment. So what we do is virtual reality training of technical skills. So if you see the surgeon there on the right-hand side, the work that surgeon is performing is technically very challenging. You're operating keyhole surgery, which is one of our specialties, laparoscopy. You're operating while you're looking up at a 2D screen, and you're having instruments that go into the body of the patient in different angles, and you're working in a volume, but you're looking at 2D. So what you really need to have control of is hand-eye coordination, sense of depth, psychomotor skills, and your muscle memory in your hands. And all this can be practiced in a safe simulated environment. So it's just as when you step on an airplane, you know that the pilot has trained tricky situations in a simulator, but it's not at all the case if you're unfortunate enough to be rolled into the OR. It can differ greatly between hospital to hospital and country to country, etc. So there is still a lot of standards lacking, but they are coming. And we've actually been working with this for more than 20 years. So Surgical Science has for a long time been a research company, was based in Gothenburg, founded in Gothenburg by a few software developers and a surgeon. So for a long time, we've been working on research to get a technical solution for this. So next slide. If we then fast forward 20 years, we are today a business of two different areas. We have a business area we call educational products. Those are that is the business area where we develop, sell, and distribute simulators under our own brand. So we work primarily with university hospitals that are using simulation to a large degree for their residents. So these are surgeons that are in training, about to start their clinical career. We do this primarily through distributors, and it's under our own brand name. Lately, and I'm talking in the last 3-4 years, we have seen an increased interest from med device companies who have started realizing the business potential in using simulation. So in this business area, we work directly with the med device companies, and we use our technology, primarily software, to embed that onto the med device companies' hardware platforms. Surgical robotics is the biggest area here. And we always do this white label, so we do this sort of an Intel Inside strategy, where our solution is a component in the med device company's platform. And next slide. These two business areas really feed off one another, because in educational products, we get access to key opinion leaders, and we learn a lot about the educational processes. And we also have customers that use our products to do scientific work, which results in validation studies of the simulation software. And all that knowledge and credibility is something that the med device companies are craving, and makes them want to work with us and use our validated software. These two different business areas in terms of revenue streams are a bit different. In educational products, there is a big one-off sale when we sell a simulator with different software components. There is some add-on sales in terms of new, you can call it games almost, so new procedures, so new software pieces. And there is some recurring revenue in update agreements and service agreements. On the industry OEM side, we have initially some consulting revenue to adapt and embed our software onto the platform. And then we enter usually into a phase where we don't have so much revenue. And then once products are launched, then we get license revenue that tends to be very long revenue streams, because there is very high stickiness once you have used our software to validate your products. Perhaps you have used the data to regulatory authorities, and your customers have also started using the curriculums of the software that you have. So we can jump forward to the next slide. Just a quick look at the educational products, what they look like, the hardware platforms. So we work then in laparoscopy, which is our largest product, our flagship product to the left. We work with endoscopy, which is colonoscopy, gastroenterology, and bronchoscopy. So it's basically the same principle. When you use an endoscope to do an examination of the colon, it's a lot of technical skills to maneuver the endoscope. We also have a couple of other products that with their specialities. One called Symbol Box, where you use your real laparoscopic instruments but get the objective feedback. We have a team training application, and we have a scaled down version of LabSim. All these products are our own IP, but we have outside contract equipment manufacturers to do the actual production. None of the products are med devices in a regulatory sense. They're all educational products. And we tend to keep these platforms for a long time. So if we jump to the next slide, but where we do the major investment in R&D is on the software side. So we keep on with faster graphic cards. We keep on perfecting the simulation, and you can do more and more realistic simulation the more processing power you have. We also add new indications or procedures, part of the body, and types of surgeries you can do. So it's almost like a sort of PlayStation game kind of model. You have the platform, and then you can make add-on sales to different target groups at the hospitals. So today, general surgeons, urologists, gynecologists, thoracic surgeons, they can all use different software packages to do their specific training. So right now, for example, we are developing a colorectal surgery module for LabSim. And if we then jump to the next slide, here in the best of worlds, if technology were on my side, I would have played a video for you. But, oh, well, we do have a video. That's great. Okay, look at this video. This is the core asset of Surgical Science. For 20 years, we have done a platform, a physics engine, where we can simulate real-time non-linear interaction between tissue, organ, and instrument in a realistic way. So what we're looking at here is a gallbladder, the surgical removal of a gallbladder, called a cystectomy. And it's really this that has taken us a long time to develop, and that's been very validated. It's how you can work and perfect your skills in an objective manner in a simulated environment. So when you're standing as a trainee. You're standing in front of the simulator, you're holding on to instruments, you're even getting tactile feedback. So when you punch into the liver bed, it will be hard, and you get objective feedback on exactly what you've been doing right and wrong, etc. So it's this asset, this software asset that we keep on reusing and perfecting in all of our projects. And this is built in C++. So this is not built with any third-party software engines, etc. It's a custom solution that we have developed. And we always sort of among ourselves argue that, how can we get more return on this asset? And that's where we keep on working more and more with the med device companies. So next slide. A couple of macro trends here that are interesting, that perhaps were not on the mind of the founders of Surgical Science 20 years ago when they talked about virtual reality simulation. And people couldn't even Google it because there was no Google at the time. But what we're seeing today that really affects our business is number one, there is an increased focus on patient safety. All regulatory authorities, governmental bodies are stressing the importance of patient safety. Number two, there is a big shift from open surgery to minimum invasive surgery. And that's both laparoscopy, when you're holding onto your instruments, and robotic assisted surgery. And this is natural because as economies develop, you want to have surgeries where the patient can go home the same day, where the patient doesn't risk infections and blood loss. And so it's both a matter of patient well-being and also an economic factor. And number three, we see an increased digitalization of healthcare. And this means that the new instruments that are coming out from the med device companies increasingly have digital interfaces. And that makes our asset all of a sudden very valuable because we can implement a pure software solution to our med device customers. So adding our software onto existing hardware. Another effect of digitalization is also a lot of data. We're getting a lot of data, and that data all of a sudden puts the spotlight on patient safety because everyone have known that there is a big difference depending on the technical skills of the surgeon in the expected outcome. Everyone has known this. You can ask a surgeon friend if you have one. Everyone knows this. It's like an unspoken truth or spoken truth. But now you have data backing it up, and that puts even further pressure on patient safety. So I'd be very surprised if in a number of years, if this is not mandatory to do simulation before you start working on real life patients. So next slide. Let's move into what we do for our med device customers. Our largest niche or sub-segment is robotic assisted surgery. And for those of you who are new to this area, it's actually not a robot by itself operating on the patient, but it's a surgeon that sits in a console manipulating robotic arms. And this provides great benefit to the surgeon because all of a sudden you can have added software features to the console and you can sit in a comfortable position. So the surgeons really want this. For the patient, it's better outcomes. And that's why, if we jump to the next slide, that's why initially the growth was really strong in urology, because if you're a man and you're diagnosed with prostatic cancer, you do some Googling and you realize you want to have a surgery done by the Da Vinci robot rather than alternative approaches. But we have seen tremendous growth in the last few years, first in gynecology and then in general surgery, which is a much, much bigger segment. So, and these are numbers here in procedures being conducted by robotic assisted surgery from the market leader Intuitive Surgical. That is a customer of us. I mean, they run our simulation on their surgical platform. So if we jump to the next slide, here's a couple of examples, because what is happening then in the robotic surgery space is you have one market leader that's been very strong and has been pioneering this new technology, and that's Intuitive Surgical. But as patent has started to run out, you now see a lot of new entrants into robotic surgery. To the left-hand side, we see a product from a company called CMR Surgical. It's a European startup. You should look them up if you're not familiar with them, CMR Surgical. They had the largest ever financing of a privately held med device company in Europe ever, so largest private placement ever. And they have a product that they just launched this year called Versus. And they have disclosed that customers such as NHS in England and etc. have started using their technology. With every one of their robots comes something they call the Versus Trainer to ensure patient safety and to ensure that their technology can be adapted. And Versus Trainer is 100% surgical science. So it's an example of the under the hood strategy. So we want to work with as many of these surgical robotic companies as possible and implement our software technology. If you look at the penetration of robotic assisted surgery, it is today around 2% of the surgeries you can do with today's technology that are being done with today's technology. Everyone, if you look at independent research reports, predicts an aggressive growth in this area, as new entrants such as Medtronic, J&J are all coming into this space with their own platforms. And at the end of the day, it's of course the instrument sales for these huge companies that are very important. So they need to gain market access. And in order to do so, they need to demonstrate to regulatory authorities that they have a patient-safe way to introduce the technology, and they have an incentive to transition as many surgeons as possible onto their platform. And that's where simulation becomes a key role. We announced about 2 months ago that we entered into a framework with Auris Health, a framework agreement, where we are their supplier for their future robotic system of simulation. And Auris Health was acquired by J&J for about $5 billion, including earnout payments. So it puts a little bit the scale of the future expectations in this space. So next slide. Just quickly, surgical robotics is the most important niche, but other parts of med devices are also increasingly adapting digitalization and CPUs. Here's an example of a vessel sealer from a large med device company, and that actually contains, CPU power, so you can measure the thickness of the tissue you're about to seal. As it has this digital interface, we can adapt that directly on to existing products. So you see to the left-hand side, you see a surgeon at a congress trying this new device out. And this is a great model for us. I mean, we get paid to implement new tools onto our educational products, which increases the value of our educational products. And the med device company is buying simulators from us and using them in a way that drives the educational business. All of a sudden, we get to be, in the best location of the Congress. So, gonna wrap up here with a couple of slides on our numbers. Of course, the COVID times has affected us like everyone else. I mean, we are a top-line company in terms of our primary objective is to grow revenues. In a quarter like Q3, where COVID was severely impacting the business, we decreased 23% year-over-year. That has a lot to do also with surgical robotic companies are selling less new robots, which gives us less software license revenue. But it also affects when you cannot visit customers at hospitals and promote your educational products. But despite this, we are still a very profitable company. Our EBIT was 7.3 million Swedish crowns. So it's about 30% EBIT margin. And if you look at it from an EBITDA level, we were at 46%, and we grew our cash position. So we feel, despite the difficult times, we feel we're in a strong position. Next one. We do have financial goals, and we are aiming at being a 400 million Swedish crowns company in 2024. We have said this figure may include some complementary acquisitions. And in order to reach that, we see educational products, our own simulators, growing on average 15% per year. And industry OEM, as I explained with the business model, has a bit more uneven growth, because initially we have some consulting revenue, but then the big upside is when license revenue starts kicking in. We have an EBITDA margin goal of 40%, and already at this level we have been beating that. And then final slide, if we take a look at Surgical Science share, we have been at Nasdaq First North Growth Market since June 2017. We have about 2,700 shareholders. The two largest shareholders have been with the company for more than 15 years. They did not sell anything at the IPO. They're both active on the board. And then we have the third largest shareholder as a result of an acquisition we made. I don't know if I lost you there momentarily, but I think actually my 20 minutes are up. So I don't know if that was intentional, but hopefully I'm back on.
Thank you.
Can you hear me?
Thank you for that. We'll proceed to a brief Q&A session. So can you talk a bit about clinical validation and why that is an important part of your business model? Obviously, looking in the longer term, it would be highly interesting to hear more about the potential within the regulatory requirements for surgeons to be certified and these types of developments. So it'd be interesting to hear a bit of how you're working with that and that part of the business.
Yeah, no, clinical validations are really important to us, and it's also important to stress that we as a company are never involved in them. It's our customers that are using our products, because they are the superior products, to do their clinical research. So, for example, a major study that was published some years ago in British Medical Journal was a Danish team that did a big study where one group of residents had simulation as part of the curriculum. And they have also, they operate on pigs, they have some box trainers, they have various means of training. And the control group, didn't have simulation. When these new gynecologists, went in to the operating room to do their first surgery, the study results were amazing. The group that have had simulation as part of the curriculum completed the salpingectomy, which was the procedure they did, in half the time of the control group. And in blindfolded scoring by experienced surgeons, it showed that they had an equivalent experience of someone who already done 30 to 50 prior procedures. So in essence, there was a transference of skills from the simulator to the OR. And that means everything for the patient. I mean, you want to cut away the early part of the learning curve from the patient to the simulator. I mean, who wants to be the first, 10 patients when the surgeon is still learning? Nobody. And you also save a lot of money from having less time in the OR. And all these studies provides a lot of credibility to us as a simulation provider. And that in terms is very important then for our med device customers.
Great, thank you, Gisli. And just a final question before we have to end in the interest of time. COVID-19 has created a massive backlog of elective surgeries here. Is there any trends you are seeing that this might boost your near and longer term market potential in terms of getting these less invasive procedures on the path? Can you say anything about that?
Yeah, it's a great question, and we do see some very encouraging things in the backwater of COVID-19, but it's very hard to draw conclusions with any certainty. I mean, look at it. COVID-19 has made many university hospitals question the fact that they still do a lot of training in the OR. Just as we have questioned why we do all these physical meetings when we can use Teams and Zoom. There is a huge backlog, which means they need more qualified surgeons and they need a bigger capacity. They cannot have, exactly the capacity they need to have some extra capacity for things like COVID-19. That indicates more need for simulation. And it indicates that perhaps robotic companies would sell more robots. On the other hand, you also have some hospital groups that are now having, financial troubles, especially in the US, because they have not done elective surgeries, whereas where they're making a lot of money. So will there be budgets for the investments needed, and how will that balance off with the increased need of simulation? We are not sure in the short and medium term, but we are very confident in the long term of what we're doing as a company.
Great, thank you for that, Gisli. We have to cut it short here. Thank you very much for participating today. Wish you best of luck.
Yeah, thank you for having me.
Thank you. Take care. Bye. Hi, my name is Rickard Anderkrans. I'm a healthcare analyst at ABG Sundal Collier. So the program continues today. I'm very happy to introduce Henrik Winter, Head of Business Development at Biovica. So without further ado, I will leave the word over to you, Henrik. Thank you very much for participating. The floor is yours.
Thank you very much. So as mentioned, yes, I'm Henrik Winter, and I'm heading up the business development at Biovica. My background is plus 20 years within the diagnostic and companion diagnostic industry. And I also used to be an associate professor within cell biology at the university in Copenhagen. Today, I'll present status and updates on our efforts in moving our blood test into the clinical routine testing market. And this is about a test to monitor cancer patients' response to therapy. Next slide, please. So let's start by actually looking into the unmet needs within metastatic breast cancer field. And that's because metastatic breast cancer is our first market focus. So from a treatment perspective, the unmet needs that have been identified by patients and physicians and also payers include tools that allow for a faster and a better treatment decision. And that actually also includes tools to identify drug resistance as early as possible, and hence tools to avoid unnecessary treatment, also called futile therapy. And that's, of course, because you don't want to have unnecessary treatment because it's expensive and it also has some side effects. From a monitoring perspective, the unmet needs we have identified there, and by interviewing patients and payers, these unmet needs, they include tools to avoid invasive radiation-based or imaging-based testing, and also tools that will actually reduce the number of diagnostic tests being performed. So what is the Biovica solution to these unmet needs? Next slide, please. Our product, DiviTum, it measures the activity of an enzyme called TKa. And that TKa enzyme actually reflects the cancer activity or aggressiveness, you could say. Meaning high TKa levels indicates a very active cancer, not responding to therapy. Whereas low or stable TKa values, they signal a cancer that is responding to the therapy. So our product or test, it works on blood samples, so there's no need for invasive testing. Our test also detects cancer changes or changes in activity in cancer 3 months ahead of what can actually be seen by imaging. And hence, it will allow physicians to early adjust their treatment. So this is, faster and better treatment. And by being better or as good as imaging, our test will actually also reduce the need for imaging. So all these that were actually identified as unmet needs is going to be helped by the DiviTum test. And finally, our test uses a technology and a kit format that will suit the routine testing laboratories out there, and therefore fit perfectly into laboratories and hospitals. And even better, behind the DiviTum test, there is a massive clinical data. So the next slide, please. These data has actually been established through collaborations with global key players, as you can see in the lower part of the slide here. It's some of the most well-esteemed cancer oncology organizations that have been involved in our work. And it has resulted in 23 publications in high-impacting clinical journals. And the key messages from these journals or papers is that our assay is really strong in prognosing and also monitoring within cancer. So far, our main focus has been on breast cancer, as you can see here. But proof of concept has also been established within gastrointestinal cancer, lung cancer, and other cancers. But let's dive a little bit deeper into the breast cancer study program that we have undertaken. So next slide, please. We started out very broadly within breast cancer, and we have also created results very broadly. But early on, we identified the clear unmet need within metastatic breast cancer, and also with a strong business case within that field, we decided to put our efforts here initially. So the studies we are undertaking within metastatic breast cancer, they focus on all the unmet needs that I mentioned earlier. And it's actually relevant both to current therapies, but also new therapies coming up. Our study program started out as a proof of concept study program, but it has then developed into a strong list of proof of clinical utility conclusions within metastatic breast cancer. And some of the later studies we have obviously used in as the foundation of our 510(k) filing. And it's not the least the SWOG study and also the Lund study displayed here far to the right in this slide here under the metastatic breast cancer activities. And our latest clinical data, they will actually be presented at the world's largest breast cancer conference, the San Antonio Breast Cancer Symposium, taking place next week in US. So from these studies, let's move to the next slide, please. Because there are 3 studies that actually will be presented at San Antonio. And these 3 studies will confirm our earlier study results and hence the clinical utilities that we have identified. But the studies will also add some new knowledge, some new important findings within metastatic breast cancer. So as you can see here, I've tried to illustrate, the different studies, the 3 studies, the conclusions, and, the clinical utility it will impact. So the SWOG study, for example, yes, it confirms again that TKa is a very strong monitoring tool during metastatic breast cancer treatment. But on top of that, we also show that a baseline TKa test is very strongly prognostic for progression-free survival and overall survival. And it's actually very seldomly that you see that kind of data from a diagnostic company, and hereby I mean, progression-free survival and overall survival data. So very proud of that. And also from the SWOG study, it shows that that TKa can show predictive capabilities and then, help physicians in selecting the right treatment right from the beginning. From the palbo dosing study, it was shown that TKa can detect cancer progression 3 months earlier than imaging during CDK4/6 treatment in metastatic breast cancer. So again, we confirm the very early detection of changes in the cancer development using TKa compared to imaging. And in the PYTHIA, which was a prospective trial, TKa is also here shown here to be an early and strong predictor of CDK4/6 treatment. So all these results are, obviously very, very encouraging to us. They're not only supporting kind of the plan for clinical utility of our product, but they are also hinting to an expansion of the clinical utility. And if you expand the clinical utility, you obviously also expand, the market potential. So next slide, let's look into the market potential we have. So what we have done there and what this slide is depicting is that based on national business cases and also some testing impact models, we have estimated the market potential for our 3 first main markets being US, Europe, Big 5 plus Nordics, and Japan. And a few words to the individual markets here. US is of course being the biggest and most advanced trend-setting market, and therefore key to us. It's a big market, but it's also a uniform market, meaning it's a one market access model. for the whole model, which makes it a little bit for the whole market, sorry, which makes it a little bit easier for us. Regarding EU, the Big Five and the Nordics, the CE IVD labeling is just a formality for us because we have that covered. We will then, copy paste as much as possible from our US experiences, but making sure to adapt it to country per country market access systems and also the European partners, of course. In Japan, a significant regulatory process will be required. So total market size for US, EU5 and Nordics plus Japan, and with the current clinical utility, approaches $700 million. And here we're not looking into some of the potential other clinical utilities that I just mentioned, coming out of new clinical studies. So where are we with our commercialization process? Please, next slide. Here we display an overview of the commercialization activities and also the status. So from the top, the DiviTum TKa product has been fully developed. And next one, the clinical validation has been completed within metastatic breast cancer. With regard to the regulatory piece, all data and documentation required for a 510(k) clearance have been submitted to FDA. And FDA, they have confirmed, that the application is complete. And therefore, it continues into the standard routine review at FDA. And normally, this has an average processing time of 124 days. However, COVID-19 has put all non-COVID-19 tests on hold. And we have also, entered into that situation. And that means for the next 90 days, FDA will focus on COVID-19 testing. And we just have to accept that. With regard to the commercial partnering, it's running full speed. And we, of course, use our key opinion leader network as DiviTum TKa ambassadors. And I can't reveal details presently, but I have a follow-up slide on our strategy for these partnerships. When it comes to the next bar there, activities to secure product reimbursement and inclusion of TKa into US guidelines. This is also running full speed. And I have 2 slides to provide more details here. So next slide is looking at the commercial partnerships. And we are, of course, building a commercial organization in US, but it is not our strategy to build a huge sales organization. We will strongly rely on our partnerships for sales. Our focus is 71 NCI diagnostic centers or cancer centers. These are the early adopters, and they are also typically trend-setting to other diagnostic labs. And these centers are actually also the centers where we have our key opinion leader network located. So in the middle of the slide here, we are more specifically, currently discussing with major mid-sized oncology labs regarding partnerships. And these labs are typically attached to the NCI hospitals. And also for these labs, very characteristic that they have strong experiences within sales and reimbursement, and therefore they are really good partners for Biovica. Now, speaking about reimbursement, let's switch to the next slide. So I'm going to talk a little about reimbursement and the importance of key opinion leaders. Because I think I've mentioned, both during the presentation of our strong clinical data and also just now regarding the commercial partnerships, that we have a very well-established and unique key opinion leader network, and they are extremely important to us. We simply collaborate with worldwide leading breast cancer oncologists, and they're actually not collaborating with us because we pay them, but because they are strong believers in DiviTum as a tool to resolve the unmet needs within metastatic breast cancer. So very good examples are Daniel Hayes or Dan Hayes in US. He's an ASCO or ex-ASCO president. I think Matthew Goetz, also US, and the medical director of Mayo Clinic, also very, very supportive, and a TK ambassador, very important. And Europe, I mean, someone like Jonas Berg, professor at Karolinska, very, very important key opinion leader network. But actually, all the heads that are up here are very, very important to us. Because these key opinion leaders, as I said, they are our ambassadors, and they are extremely important in convincing both payers and guideline holders and also lab owners in making the DiviTum accessible to patients. So very, very important to us. If we switch to the next slide, and now we are talking payers and reimbursement and testing guidelines. Then I just want to, on this slide, say that the US product reimbursement process is running full speed. And as is also depicted here, it includes several tracks. So number one is, and very important track there is establishing evidence. And that really means that, we generate high impact publications. And those publications are based on completed and ongoing clinical studies, but also publications regarding budget impact. Another track is the payers/insurance companies' engagement or nodding to our evidence creation plans. So they have to say, yeah, makes perfectly sense what you're actually creating evidence-wise. And we start actually by onboarding the early adopters here. And this is, those that kind of accept our current evidence as being sufficient. When it comes to guideline inclusion, a third track, this will be based on the evidence publications just mentioned, and also the use of our key opinion leader network to get into these guidelines. When it comes to the final track, coding, pricing, payment, there we have identified the coding path that we will follow for our product. And pricing-wise, it's going to be value-based, and it's going to be, reflecting our budget impact studies and also our health economic study results. So all in all, we can say that for the reimbursement process, we have moved from strategy into full execution, and so far without any roadblocks. Next slide. If we look a little further ahead, our biomarker actually has a large potential to expand. We are currently only scraping the surface with our first application, and we are only addressing 1% of people living with cancer. So the near-term market expansion for DiviTum includes, of course, geographical expansion, as is shown here, and also moving into other areas of breast cancer. Initially, it could be locally advanced breast cancer, obvious to us, which would, even add, additional 30-40 potential, or 30 to 40%, additional market for us. Another near-term ongoing market expansion include pharma collaborations, and that's actually both early and late stage drug development, and with late, companion diagnostics. On a more medium term, then our expansion will include other tumor types like lung cancer, gastrointestinal cancer, and prostate cancer. Which takes me to the last slide, which is a summary slide. So I think it's fair to summarize that our assay is, which is called DiviTum TKa. It addresses key unmet needs within metastatic breast cancer, and there's an immediate potential of between $400 and $700 million for the initial rollout, meaning the initial clinical utility, not the additional clinical utilities we have identified included. And we certainly also can summarize that we have very strong scientific collaborations and evidence behind our tests. And as I said, there's a significant potential financially, beyond the initial rollout. Upcoming milestones, yes, of course, the 510(k) approval and then launch in US. We will see that Q2 2021. We'll also have first US product reimbursement in 2021, late. And then also moving into Europe, Big Five, and the Nordics in the end of 2021. Thank you.
Thank you very much, Henrik. We'll proceed with a brief Q&A session now. So first of all, could you give us an outline or detail a bit more on how you intend the DiviTum to be used in the clinic once it hits the market? Talk a bit, perhaps also if it differs or there are similarities to how physicians are currently working with different biomarkers and tests.
Yeah, absolutely. I mean, first of all, I think it's important to understand that, we're talking monitoring. So many diagnostic tests, is a one-time use, and for early detection or just detection in general. But we are actually talking monitoring, which means that our test will be used, several times. It is a monitoring tool. So it is actually going to be a tool that will replace some of the imaging, CT scans, PET scans. That's how we see the first use of our product, and as also shown by the data here, we can see things happening in the cancer before it can be detected through imaging.
As far as I've understand the test will initially at least play a very important role in determining whether a treatment is effective and perhaps that treatment should be shifted. Just looking at the metastatic breast cancer setting, that can be challenging in terms of there being very limited treatment alternatives for the later stage or refractory patients. I guess my question there is, do you see the imminent potential as bigger or more clinical utility from the test in earlier stages of cancer or less severe stages, or how should we think about that?
I mean, there's certainly also options, in the earlier stages. But when we talk, metastatic breast cancer, there are, some, you could say, routine testing established and some routine treatment established. And of course, in Europe, we follow typically what happens in US. And we are actually currently undertaking our studies in a way that we follow the US market and hence being ready for the European market, you could say. So CDK4/6 inhibitors, for example, in US have moved into first-line metastatic breast cancer treatment. And that's why we have focused a lot on CDK4/6 inhibitors in our clinical studies and created the evidence there. We have also looked into endocrine treatment, of course, because that's more the standard treatment currently in Europe, and that's actually our SWOG and our initial clinical validation is the first-line treatment, endocrine treatment of metastatic breast cancer patients. So I think we are very well prepared and following closely the therapies within metastatic breast cancer also, and adapting our test to those needs. And it's still the same needs, as I said, both for the current treatment and also for the upcoming new drugs.
That's a really final brief question here. You didn't get to cover it as much in the presentation, but the vertical and the potential within companion diagnostics sounds very interesting and seems to be a lot of opportunities there. Can you talk about how you aim to position DiviTum within that vertical and what opportunities you see there?
Yes. We obviously see, what we know is that companion diagnostics are typically early selection of patients for a specific treatment. But there's also more and more a tendency to, apart from initially selecting the patients, you also want to follow these patients and make sure they continue to have an efficient treatment on this personalized drug. And that's the discussions we currently have with pharma. And on top of selecting patients initially, you also want to follow the patients with a precision diagnostic tool or monitoring tool as Diviton. So that is the discussions we have with the CDK4/6 inhibitor. But we also realized that quite a company, bigger our assay in the very early stages to actually identify tissue box.
Sorry, Henrik, you broke up there just in the end. If you could repeat the final sentence just really briefly. Sorry, you have some technical breakups there.
Okay. So just saying that, we have identified that pharma partners use our assay also in the very early stage of their drug development for efficacy testing of their drugs. So now we are actually engaging with pharma both in early drug development and having discussions on the later stages, the true companion diagnostics or monitoring diagnostics as we call them.
Great, thank you, Henrik. And in the interest of time, we have to move on with today's agenda. Thank you very much for taking the time. Wish you the best of luck going forward. Thank you again.
Thank you.
Thank you. Bye.
Bye.
Hello everyone, welcome to ABG's Investor Days. Our next company will be Hexatronic. With us today we have the pleasure of hosting CEO Henrik Larsson-Lyon. My name is Carl Bokvist, I'm an industrial analyst here from ABG and will be moderating a few questions at the end. But without further ado, Henrik, welcome, thank you for joining us, and please, the floor is yours.
Thank you very much. So I'm Henrik Larsson-Lyon, I'm the CEO of Hexatronic Group, and we are active in fiber to the home solutions. That's our core business, so passive solutions for fiber to the home. So I will make a small presentation. If we take the next slide, please. So just a summary, we are listed on Nasdaq mid-cap since 2016. Revenues are roughly 2 billion SEK. A little bit more than 700 employees and approximately 9,000 shareholders. And we have two targets that we communicate, and that's a growth of revenues of at least 20% per year and an EBITDA target of at least 9%. So that's a short summary. Next slide, please. So first, about sustainability. We work more and more intensely on sustainability topics, and we see this as a demand from customers. Our larger customers are putting more and more demands on sustainability activities and goals that we should reach. But we also see internally among our employees that it's becoming more and more important. So this is a topic that we are working more and more intensely on. Next slide, please. So why Hexatronic and how we differentiate? And I would say the largest differentiator for us or with us is that we are able to supply, and we supply the complete passive network when it comes to fiber to the home. And we don't see any competitors being able to do this. And that means we produce fiber optic cables, we produce these plastic pipes, microducts where you blow the cables in, where we have our own design of cabinets and closures, connectivity companies. So we have a complete solution that we know works very well together. And the key here is when you deploy a fiber optic network, and especially a fiber to the home network, roughly 15% of the investment is about the material where we are active. And the rest, say the 85%, that's actually the cost to install the products. You need to dig, you need to hang them on poles and make the connections. So what we do, we focus on solutions that are quick and easy to install in order to reduce the installation time and then giving a benefit to our end customers. So that's what we focus very much on. To that, we also have training activities. So we have training companies today in telecoms in Sweden, Norway, UK and US. And we are targeting to have that in the German market also. And I'll come back to why it's important to have those activities, especially in Germany, UK. Later on. We also have field support. So we have engineers who are out helping our customers. When there are small problems, they make demos, small introductions on new products and so on, something that has been very much appreciated by our customers. So you can say it's a value-based approach that we have when we sell our solutions. Next slide, please. So we are still small, even if we start to become a medium-sized player in our industry. We have to focus on a number of markets or a limited number of markets. So today, our focus markets, that's Sweden, Norway, Finland, it's UK, Germany, it's North America, so US and Canada, and New Zealand. What we have added recently is Baltics, because we made an acquisition there some weeks ago, and also Italy, when we made an acquisition some weeks ago. We are also looking into Australia, because in New Zealand we have a plant producing these microducts, and there is still a lot to do in the Australian market when it comes to fiber deployment. So that's the markets we focus on. And I will come back to the key growth markets. If you take the next slide, please. So first, about the distribution of our sales. So these are the first 9 months this year. And you can see Sweden then represented 29% of our revenues. outside Europe, outside Sweden, that's 33% of our revenue. North America, 25%, and rest of the world, where New Zealand is a heavy part, is 13%. And if I go back to 2017, Sweden represented more than 50% of our revenue. So we have made a change here, and I will come back to that a little bit later also. We expect that Sweden will represent maybe 10-15% of our revenue in 3 years' time. And that's because the Swedish market is quite mature. It will gradually go down, but we target to grow both organically and by acquisitions in North America and Europe. Next slide, please. This is a statistics of fiber to the home connections in the world, and we have selected some countries. We get these statistics once a year, and actually we get new statistics later this week. So these are 1 year old. And you can see there Sweden in the bottom part of this, where last year 57% of all Swedish households had a fiber connection. So, and this is a very high figure when you compare internationally. When you look at the key markets where we want to grow the most in the future, Germany, UK, they are down at 3%. So they have just started to deploy fiber to the home. And it's big markets. United States, 16% fiber connections. Canada is on the same level. And you see Italy at 4%. So around the world, there is still extremely a lot to do in order to deploy fiber and fiber to the home. I will make some comments on the key markets. So next slide, please. This is a comparison. You see Sweden, UK, Germany, and the US, and you see the number of households, homes passed. Just to explain that, that's when you deploy a fiber cable in the street and you pass all the houses, then all houses are passed by the fiber. When you look at subscribers or connections, that's the number of houses that are actually connected to the fiber in the street. Normally, when you build a fiber network, not all households are connecting immediately to the fiber network. And you can see in Sweden, 86% homes passed. This means it's only the rural area left, and that's very expensive to build out. So I saw in the new budget of the Swedish government, they want to subsidize with another 1.4 billion SEK next year for making this happen with more fibers in the rural areas. And I'm sure there needs to be more subsidies to make this happen. The Swedish government has a goal of 98% of all Swedish households should be able to have a 1 gigabit per second connection in 2025. And then that will be very expensive to build. But when you look at UK, Germany, and US, there is still a lot to do, and there is a lot of households. So it's gigantic markets for the future. A few words about these markets. So next slide, please. If you look at the UK market, you have some national players, British Telecom's part with Openreach, Virgin Media, City Fibre, and so on. They have announced, these players, that they are going to build 10 million, 4 million, 8 million homes connections, and most of them are by 2025. So there's huge projects that are starting up. Our main customer in the UK is City Fibre, where we currently have 50% of their need of cables and ducts and passive material. And we have seen that it's really starting to take off in the UK. It's not a money problem. The capital is there, like City Fibre is owned by Goldman Sachs, and they have said that we will finance up to £4 billion for making this happen. The problem and the speed of the rollout is the lack of people, hands and feet to make this happen. And that's also why we want to have training companies. So, for instance, with City Fibre, we have developed their training program. We are going to train all their people and also the contractors working on their projects, and also bring in new people from outside into this market. Next slide, please. The German market is a little bit different. You have a couple of players who are building nationally there, like Deutsche Telekom, Deutsche Glasfaser, that is owned by EQT, also building nationally. And then you have some regional strong players. But what makes it very interesting with the German market for us is that they have more than 800 city networks in Germany. And they normally manage the electrical and gas networks in the city. And a lot of these will build fiber to the home. And it's quite similar to the Swedish market. In Sweden, we have roughly 150 city networks that also build fiber to the home. So we think this is a market that fits our concept very well. I mean, the full system, and we can train the people also. So Germany is still behind the UK in terms of startup and deployment, but it's really starting to take off. And I would say the same there. It's not the money problem. It's the lack of people doing these installations. That's the big bottleneck. What we have also seen in Germany is that there starts to be a number of startups with heavy financial backing, a little bit like City Fiber in the UK, and with big plans of building nationally in Germany. And that's also very interesting for us, where we can bring our knowledge and systems to them. Next slide, please. The US market, just to mention, we have two types of businesses there. On the upper half of this slide, you have our duct business. 2.5 years ago, we acquired a duct manufacturing in Kentucky, and they produce pipes and conduits for both the energy cable market, but also for the telecom market. And we acquired them because we wanted a local production of microducts in the US market. It's a little bit separate business what they do, but it's developing very well. It's a good demand in the market. So we this year added and started up a new plant in Texas to be able to cover a bigger part of the US. And we expect to make another plant or acquisition in the more western part of the US to become a national player in that field in the US. And at the same time, they are producing the microduct that we need for Hexatronic North America, and they are responsible for selling our complete system of fiber to the home. So we have still a small team, roughly 10 people. We have focused and are approved by 2 larger accounts there, operators, but we also focus on a small number of mid-size operators, and some of them are used to the way we build fiber to the home networks, because that's why we are in the US. They build their fiber to the home networks in a different way than we do here in Europe and especially Sweden. And we see great advantages in introducing our system, big cost savings when the operators use our system compared to what they do today. So it's a very interesting market. Material prices are high and so on. And to support this, we made an acquisition of a training company in the US 1st of August, Light Brigade, the leading telecom training company in the US based in Seattle. So they will also support with training on how to deploy our system. Next slide, please. Just briefly, our last quarter, the Q3. So we grew sales organically at 13%, and we are quite happy with that. We think we lost approximately 5% in sales due to COVID. EBITDA developing in a good way, also 11.8%, so clearly above our 9% target. On rolling 12, we are at 8.6%. So with a good fourth quarter, we should be able to reach our 9%. On the sales side, we will not reach our 20% sales target this year. I think we are at, for the 9 months, around 7% growth organically. Next slide, please. Well, when we look at this development long term, so you see the development quarter by quarter, rolling 12 months, and it's back since 2016. We have managed to reach our sales target of 20% all years, except last year we only grew 15%. We didn't make any acquisitions last year, and this year I already mentioned. Profit-wise, we had the peak in 2017 and then it dropped. The reason for the drop in 2007 or 18 was that We were very dependent on the Swedish market. It was more than 50% of our sales. And in 2018, one of the main investors here in Sweden stopped investing. We decided to keep most of our resources because we wanted to use that to focus and build up the business in UK and Germany and the US. So we have had lower profitability, but now it's developing in the right direction. So we start to see that we get now a payoff for the investments we have made. Next slide, please. And acquisitions, it's an important part of our strategy. So you can see the acquisitions we have made back since late 2012. We have a target to make at least 2 acquisitions per year. This year so far we have made 4, so it has been a good development compared to last year when we only made 0 actually. What we focus on now is trying to acquire microduct producers in Central Europe, connectivity companies in Central Europe, and the same goes for the US market and Canada. We would like to buy duct producers, connectivity companies there. We are looking for a training company in Germany, and we are also looking into the Australian market to see if we can acquire a company to get a good footprint in the Australian market, because that's the reason for us. I mean, we do acquisitions locally to get a good, strong and good local footprint and to build on that. Next slide, please. Yes, board, we have 2 new members, just to mention. Frida Westerberg, she used to be the CEO of IP Only here in Sweden, one of the main challengers of Telia, building a lot of fiber to the home, so very interesting background. And Helena Holmgren, she is the CEO of Pricer, also a listed Swedish company. I'll jump to the next, please. Main shareholders, we don't have any dominant big shareholder. It's mainly, I would say, Nordic small cap and micro cap funds that are the shareholders in Hexatronic Group. Next slide, please. So as a conclusion, why should one invest in Hexatronic? And we believe we have made a successful repositioning towards growth markets from a very large dependence on the Swedish market. We have now created good platforms in key growth markets. We provide high quality solutions, and with a very long history and experience in the fiber to the home business. We were involved already in 1998, making the first fiber to the home installation in Sweden. And that knowledge and experience we bring to the countries we go. I already mentioned, but we see that we have built good platforms for growth in these new strategic markets. And we are intending to continue to reinforce those platforms by acquisitions. And we have a proven acquisition model. I would say that we primarily acquire family-owned businesses, and they like our concept with a very decentralized organization. We almost want the sellers to feel that they still own the company. So very decentralized. We cooperate a lot between the companies in the group and exchanging products and adding to their different portfolios. And it has worked very well. We have not lost any of these CEOs or owners that we have acquired. So it's a good model that we have. And also finally, I would say now with the COVID, we see that and we haven't seen it in Sweden really. We have such a good fiber optic network in Sweden that it has worked well to work from home and do homeschooling. But when you look at UK, Germany, US, a lot of people still remain with a copper connection, 10, 12 megabit. And then I would say it's almost impossible working from home. So we have many examples of this during the COVID, where actually the connectivity at home is a problem. And I think this will boost the deployment of both mobile and fixed networks. And we also expect that both on European level and US level, there will be infrastructure programs to boost infrastructure programs, projects such as fiber deployments. It's a necessity for the future. So that was a quick review of Hexatronic Group, and I believe I managed within my time.
Yes, you sure did, Henrik. Thank you. So first question, and you mentioned parts of that strategy in the US when it comes to your new factory in Texas, and also the ambition to expand capacity further, either inorganically or by doing a greenfield investment. So for people interested in this market, is it mainly a capacity play that you need this in order to supply more products to your customers?
Yeah, I would say we can expand in that business. We can expand our plant in Texas, but the problem is, I mean, US is so huge, so you don't transport these. It's big drums with plastic pipes, a lot of air, a little bit lower value add. So it doesn't make sense to send it to the West Coast, for instance. So that's why you need a platform on the West Coast to truly be a national player.
And also your regional exposure, as you mentioned, Sweden has declined as a share of total group sales. But if we instead look forward a bit, that I believe you also commented on, in perhaps 5 years' time, how would your sort of ideal or your ambition in terms of the group's regional split look like then?
No, I would still say Sweden is probably roughly 10% of our business. The fiber to the home deployment has decreased in Sweden in 5 years' time, for sure. But we also see other projects. So, for instance, the transport network, where the fiber optic network that connects the cities. There we will see more investment because it starts to be old, and also they need more capacity and redundancy. We see data centers popping up everywhere. They need fiber connections. We have the area of 5G, and 5G is totally dependent on fiber to the antennas. So I still think Sweden will be roughly 10%, but we should see a strong growth in Germany, UK, and US mainly.
So you're talking about potentially going from fiber to the home to other parts of fiber to the A or X or other parts of these markets?
And definitely, we already do this. I mean, currently there are a couple of big transport network projects in Sweden, for instance.
And I think the final one here has to do with acquisitions and a bit broader one. So first of all, it's a key part of your strategy. The first sub-part of the question has to do with competition. For these targets, which kind of players are out there bidding for the same companies as you are interested in? Are we talking about infrastructure, private equity? Are they in other parts of the value chain, for example? And then the follow-up, once you do integrate these companies, what is your sort of business plan when it comes to achieving synergies, either on the cost or revenue side?
Yes, so first, when you look at the competitive landscape in acquiring companies, it's clearly increasing. There are more, I would say, competitors active in this field, and we also see both Chinese and Indian players who are interested to enter, especially Europe. Private equity, they are investing heavily in the operators, buying fiber optic cable operators. So that's where you see that. We don't see them so active in the material part where we are. When it comes to acquisitions, we rarely look at cost synergies. For us, it's to buy good companies, good people. It could be a niche player, like we did in the UK. They were extremely good in connectivity solutions. But to that, then, we add the fiber optic cables and microducts from the plant in Sweden. So I think this UK case is very interesting. We have almost increased their revenue by 10 times since we acquired them. And that's very much adding product from other group companies. So that's the strategy.
With that, thank you very much, Henrik, for joining us today. Thank you, Hexatronic, and thank you all of you who have been listening.
Thank you for having me. Thank you.
Yes, so hi everyone. My name is Daniel Torsson and I'm an equity analyst at ABG in Stockholm covering the IT and tech sector. Today with us we have CEO Johan Kallblad from Exsitec. And so I let Johan go on for 15 to 20 minute presentation of the company and I will follow up with a Q&A session in the end. So the stage is yours, Johan.
Thank you, Daniel. So if we get the presentation on here, on the first slide, just we are Exsitec. We provide technology solutions for a simpler and more efficient workday for our customers. And if you want to go to the first slide here, slide number 2, it says it's actually a picture of me here, and I was just going to tell you I can't actually see the slides myself, so I hope that we'll do all right. So, but slide number 2, anyhow, here is a brief introduction of myself and the company. So we're a reseller of business-to-business software that improves and digitizes the business processes of our customers. And if you haven't heard of us before, that's fine. You don't have to be ashamed. We were a private company up until a couple of months ago. We just recently listed on the Nasdaq First North Stock Exchange. So, and myself, I've been with the company for a bit over 10 years, and I've been in this space for around 20 years. So, if we move on to the next slide, number 3, this one shows where we're at right now. We're just under 250 employees. Main office headquarters is in Linköping. 2 hours south of Stockholm, and we have 10 local offices actually in Sweden and a subsidiary in Denmark with around just under 30 employees. So most of the people are in Sweden. I've been fortunate to oversee a business here with a pretty solid growth for quite a long time, and it's actually because we're right in the middle of a transition where companies have to adopt digital tools to stay competitive. And they're also to some extent transferring older technologies into to more integrated or more modern ones and cloud-based software and so on. So we've been on a pretty good growth track here. We're over the last 12 months are just under 300 million Swedish in revenue. If we look at some of the owners here, Standout Capital and Syntrans. Syntrans is the investment company of the chairman of the board. And South Street Invest is my own holding company, and we're fairly big owners. Standout has been with us it's a private equity company. It's been with us for about 3 years, and then we got a few new major investors in our IPO here with Creades and Clients as the most well known, I think. So this is some basics of the company. If we move on into slide number 4. I'm just going to just a few words on what it is that we do. So we have partnerships with some of the market-leading software vendors, and we guide the customer to finding the right solution for their business, and we then implement and configure and integrate the software to fit into their business practices, into the customer business, and then we take responsibility after implementation. We try to work with our customers for a very long time to make sure that they are successful in using the software, but also because we oftentimes want to be given the trust to implement additional softwares for additional business processes. So if we move on to the next slide, number 5, what you see here, this is some of the things that we can help a customer with. So we have software for supply chain execution, like warehouse management tools and inventory optimization. We do business intelligence to make use of your data in your company, and we do ERP and finance operation software. We do performance managing, like budgeting and forecasting. We do e-commerce. We also can build tailored solutions to a specific industry. So it's actually a module-based delivery with a high degree of reusability, where we actually build the integrations for reuse. So it's not a 100% consulting business where we do everything from scratch. We build integrations for reuse, and we try to live with the customer over a very, very long time to gain the trust to implement in more business processes than one. So you're not meant to buy everything at once and implement everything at once, even though you're obviously welcome to. But we like doing a small project at the customer site and gaining their trust, and then move on with additional projects as they grow their business. So that's sort of the basics of the business. If we move on to slide number 6 and look at our business, how it pertains to this. On slide number 6, you can see our revenue share here, and still we're almost 2/3 is consulting services in our revenue. And but again, we're not selling standalone consultants. We're selling the services needed to implement the package solutions that we sell. So we assist our customers in going digital by providing the software. We do the implementation services and the long-term support and maintenance required for them to use the software. So again, almost 2/3 of our revenues the last 12 months are consulting services, but also we have around 25% of our revenues that's related to the software use and on a SaaS model. So it's actually product-driven revenue. It's around 25% of our revenues. And then it's a few percent around support revenues, around 4% of our business. And what you can also see here, that we used to sell software licenses in a perpetual license model where we got a one-off payment when the customer started using the software. And but that's all but gone away for us. So it's entirely SaaS model software that we sell that makes up these around 25% of our revenue. So if we move on to the next slide, slide number 7, you see some of our partners, or actually these are the software partners that we work with. It may look like a bunch, but there are around 2,500 vendors of business-to-business package software, and we work with 12 of them. So what we want to be is we want to be the market leader for the specific software in our market segment. So that we become an important and trusted player for the software vendor. So we sell the software, we make sure the customer is successful in using it for a very long time, and the vendor can focus on creating the best software for their specific expertise or business processes. So it's a very common business model that we use. What we've done that's a little bit unique is that we built this integration IP around this, so you actually have ready-made integrations between the software packages to make it easy for our customers to implement and adopt additional. If they have one piece of software that they're successful with, it's fairly easy to move on and implement another software for another business process, because they know they can get support from a single point of contact from us, and they can also get integrations ready-made from us, so they don't have to pay for everything themselves and take the entire risk themselves. They know that the softwares are going to work together in their business. So around the 4 first ones here, Visma, Medius, Click, and Sugar make up for around 80% of our software revenue. If we move on to slide number 8, something that we want to be pretty upfront about is that we don't have any intentions of becoming a software company ourselves. We like the place we are. We feel that our place in the business and the business segment that we're in gives us a lower risk of becoming obsolete, especially from technology changes. If a component that we work with isn't up to par, if new technology comes along that's more competitive, we can simply actually change the software packages we work with into something else that's more competitive. And we don't have to guess what people want to buy in 3, 4, 5 years from now. So we don't have to invest that much in research and development. We can look at what the early adopters in our customer base, what they actually are doing right now, and we can wait until actually the demand is there, and then we can add an offering that we feel is competitive in a certain space. So we don't have to know about what people are going to want to use in 5 years from now, and direct research and development priorities towards that. And it's a short time then between our investment and our cash flow. There are some things, however, that we really love about the business model of a software company. So we do try to model ourselves after their business model in some aspects, where we want to build recurring revenue streams, and we want to have a strong brand recognition for ourselves and take full responsibility towards the customer. So and we use that to create long and development customer developing customer relationships and can create a lot of value for our customers over a very long time. That's the basic idea. If we move on to slide number 9, something else that's been important to us is that we want to be a workplace where our people can thrive and develop. We've had a large focus, and we have a large focus on trainee programs and bringing people in directly from university and to do internal competence development in sales and leadership. So even this year, I mean, obviously it's been an unusual year this year, but we felt pretty confident in the market that we were in. So we decided to bring aboard. I think we brought aboard 33 people directly from university here in August to our trainee program, and that we are really proud of. That's an important thing for how we make sure that we can scale to our own growth potentials by building a strong reputation as a good place to start a career in and to have a career in as a company. So that's important to us. If we move on to slide number 10, this one shows a bunch of the logos that we work with. We have over 800 customers in Sweden right now, 100 more maybe in Denmark. And the target market, we really target the mid-market here. We don't look towards working with the Volvos and the Electroluxes and the global brands, because we're pretty local, and we like the companies that have a local feel to them. We feel that our way of doing things, the software that we have selected, can provide very good support for them, and they need a partner that can assist them with choosing the right software packages not only providing consultants. So we're aiming towards the mid-market, and for us that's companies with a revenue of at least 50 million Swedish, and there are around we think there are around 17,000 companies like that in our market, and we have around 800 of them as customers right now. It's not really specific to any industry. We're in a lot of industries, and the largest customer is only around 2% of our revenue. The top 10 customers are less than 15% of our revenue. So it's not a few key accounts that stand for the majority of our revenues. If we go into slide number 11, this one shows the Q3 revenue. This was our first report as a public company, and we grew the business again. Obviously, strange year this year, and of course, it affects some of our customers. Fortunately, for us, we're not in one specific industry. So, whereas some industries were really, really hard hit, obviously, by the pandemic, some other industries has been more business as usual. So we had a growth in the Q3, organic growth of around 12% and 15% total growth. Full year, we're at around 17% organic growth, 24% total growth. We had an acquisition fairly large for us in the middle of 2019 that made the first half of 2019 was before pre-acquisition. So we had the total growth was a little bit higher in the first 6 months, but we felt that we had a pretty solid Q3 here with a good underlying growth in spite of the complex situation that we're in, that everybody's in right now, of course. So if we move on to Q3 EBITDA profitability, for us, we saw a very big improvement in margins. Q3, it's good to know it's not our best quarter. It's actually normally a fairly bad quarter for us, because we always start our large trainee programs in August. So we have a lot of people. So I brought on board, like I said, 33 people, and we have we pay their salaries, and we don't have any associated revenue. So we also have the vacation period that impacts revenue a bit for us in this quarter, but nothing of this is new in 2020 really. So what did happen that was new in 2020 was some one-off effects, of course, from a new way of working with less travel expenses and so on, and also general cost consciousness on our side. Plus, we have this solid base of recurring revenue that assists us. So we improved our profit margin from around 6% a year ago to 13%, and for the full year January to September, we're at around 16% margin. So move on to slide number 13. Look a little bit at recurring revenue from software that grew 24% in the quarter. And we also felt that was pretty good. Again, we had an acquisition accounting for some of the growth if you look at the full year. But so we had recurring revenue from software last quarter was around 27% of the top line revenue. So so this is a good thing to have, obviously, in an uncertain business environment. So if we move on to slide number 14. Look at some of the trends. Again, I mentioned this a little bit earlier. We see that these medium-sized companies that is our target market, that they're increasing their software expenditures. They've increased on average by 7% over the last 10 years, and there is an overall growth in the market. It's a lot of work that remains to be done. Actually, larger companies are growing their investments even more. So we do think that we've only gotten started here in providing modern digital solutions to the mid-market, and we feel that we are in a very strong market position to have future good growth in this area for a long time to come. Also, there is a transition towards the cloud. And where a lot of the actual solutions that are implemented out there today, they are not cloud-based, and we have a very modern offering, and we can actually help customers in making a journey toward the cloud, and that's also a good trend that assists us. So we expect to grow faster than the underlying market, but the underlying market is good also. So we have a good underlying market, and we want to grow faster than the underlying market. So we feel pretty good about where we are. Another thing, if we move on to slide number 15, is that we using selective M&A. We've actually paused that during 2020. We focused on the IPO, and also we obviously the uncertain business environment was a fact for us also. But we have done 5 or 6 acquisitions over the last few years here, and we've been pretty successful in acquiring and also integrating companies. So we do feel that this is a tool for us to grow faster than what the underlying market provides. Moving on to slide number 16, long-term priorities. First, we have a lot of growth opportunities left in our customer base. It's a lot of growth opportunity left in our customer base. So we do want to increase the numbers of offerings per customer by making it really, really easy for our customers to adopt another software and trust us to implement a solution for another business process that they currently have not automated. So we also want to invest in sales and marketing and talent development internally. We want to, like I said, resume the selective M&A activities. And we've actually, for right now, we're keeping our financial goals at 15% growth and 15% EBITDA margin. These were strange times this year, and it's been actually easier to keep margin than to keep growth for this year. But we feel that the underlying market conditions are actually pretty good if you look at it long term. So we feel that these are good goals to have for a really long time. The last slide for me is slide number 17. It talks a little bit about us, and we try to be business-minded and forward thinkers towards our customers, and also work on a baseline of simplicity. We make things too complicated in this industry sometimes that I'm in. We want to make it easy to work with us and fun to work with us. We want to make the workday of our clients easier and simpler. So by also pushing them a little bit and be forward thinkers. And having their business top of mind for ourselves. So that's what we want to be, and that's how we built this company. So with that, I'm ready to take any questions.
Excellent, Johan. I jump in here. So a very good presentation. Absolutely. I start off with a question on your customer base. You said that the top 20 customers today are less than 15% of revenues. And I guess that the business is quite project oriented. Does it mean that your top 20 customers were 20 other companies 2 years ago? Or how is this?
It's a good point. It's actually, I would say that some customer turns up the first year you implement maybe something large like an ERP. You become a big customer that year. But actually, I think it's surprisingly stable still. At least half of them are of the large ones are companies that are large. Since we don't work with really big, these huge big bang projects. We want to implement one process at a time. It's less risk for the customer, actually less risk for us. And it gives them value before they move on with the next thing. So it's actually a little bit more surprising, more stable than you would think.
Okay, interesting. A question on the market. We didn't talk that much about it. Is it a fragmented market, or with many small competitors, or are you facing the really large IT consultants out there?
It's actually in the mid-market, it's extremely fragmented, which is also an opportunity for us. It's extremely fragmented. I think we are maybe the large player in this segment, but when we are super small, like I said, we have 800 customers in a target market of 17,000. And we don't do, we're not even close to reaching our potential even with the 800. So it's an extremely fragmented market.
Okay, interesting. A question on the software side and the vendors. You said that you have 12 today out of a couple of hundred potentials, but you are agnostic to the software itself over time. What has been the churn rate of that portfolio? Have you changed software recently?
We've actually we've added. We try to be. We've added Lithium, for instance, this year as e-commerce platform. We change out maybe one software package every 2 years. So, but we have changed some, and it's basically because our customers tell us to change. Because when we look at our new sales, they want to buy something else than what we have. So it's actually a pretty simplistic approach. It's not really that hard, but we do look at some key characteristic like we want a software provider that wants to work in a partnership with us, and they want access to our, because I have 25 people in sales and marketing, and the customer, they want access to my sales and marketing department. And we also want it to be easy to integrate. We want it to be relevant in the Nordic market, and to be relevant also from a price perspective. So it's the right price for our customers. So there are a few things that we look for, but we are a little bit slow in adopting new software packages. So.
Okay, I see. A question on the different types of software. You showed a picture where you have CRM systems, ERP systems, etc. What is the perfect niche for you, which is kind of more advanced than the customer can do themselves, but still not that advanced, so you don't need to have 80 specialists within your... What is kind of the perfect niche in terms of...
There is not one, but I love when someone has something a little bit special, a little bit out of the ordinary. I love a customer like Fonus is a very large customer of ours, where there is actually not one standard package to do burial services in the Nordic market with the legalities around that. There is not one standard software you could buy. You need to build it from pieces. And if you were to build it from scratch, it would be super expensive. But we can actually build it piece by piece by taking software packages that already exist, integrate them, and then add a little bit of the specifics on top. I love another company like... GaragePortExperten, to mention something. That's a franchise organization that they install garage doors, and it's also special and pretty. You do go out and you do exactly the same thing. So it's actually and then it's very much standard. It's a delivery of something that's built in a factory, that's manufactured to order, that needs to be the right thing, that needs to meet some people. You need to have it implemented, but in the sales process, you need to be very, very much a specialist in doing exactly this. And this you can. So I love the projects where you can take standard components and build something very tailored. Actually, from very. I love the Scania model of when they build trucks, have this modular thinking to make something very very specific to the customer without having 1,000 different parts to build it from. That's a very fascinating business model for me, and that's something that we try to leverage.
Okay, so kind of a value-added reseller in the software market here.
Yeah, a lot of the value add is also doing the recommendations and the strategy work, and also the integrations, and then also specific solutions. There's a lot of value add. We're not. That's why it's only 25% software revenue at this point, right?
Okay. Two final questions. The first one regarding net recruitment. You said that you added 33 people in the trainee program this year. I think that stands out in the sector compared to other IT services companies.
I think so too, yeah.
What is the plan going forward on the net recruitment side? Are you very aggressive on recruiting more people, or?
If you would have asked me a month ago, I would have said maybe we take it a little bit easy. But actually, it doesn't feel that way now. This second corona wave that all disappoints us all so much, we actually see a pretty strong we still see a pretty strong underlying demand, and still in our industry, it's a competence-driven industry, and the demand for IT people is high. So we're actually starting our next. We started recruiting in towards next year's trainee program, and we're bringing on more than 10 people actually early next year in another consulting program to develop more consultants. But we're actually recruiting. So if you are interested in joining this company, go and check out our website, because we are recruiting for next year's trainee program. It's a lot easier to recruit this year, to be honest. I mean, I see you said we stand out. I think that's correct. We see a lot of applications, and so you can really pick and choose, which feels really, really good. But we want to have the people that are here for the right reasons, and that really want to use their talents to improve the business of these types of companies that we work with.
Okay, excellent. And then just a final question before we running out of time. Based on the current consolidation in the market, we have seen Triton put a bid on HiQ, we have seen Knowit acquiring Creuna. Does it free up employee capacity for you that you can grab, or will it change any other market dynamics for you?
Come again, I didn't quite. Could you repeat that? I got a little bit of a lag here.
Okay, driven by the consolidation in the sector, we see much more M&A. Could that free up employee capacity that you could recruit because people are leaving those firms, or do you see?
Yeah, that's a good question. I haven't really thought of that. Haven't really seen it yet. I think actually M&A activities were pretty slow this year, up until it's just started pretty recently. But usually that's not actually. It's not actually all that bad. We have there is actually one. I can't go into the specifics actually, but there are a few discussions that we have with where maybe some large corporation acquired another corporation, and they weren't interested in the same IP that we would be interested in, or the same capacity and people wise. So actually does happen. We actually did a deal with office management earlier. That's actually official. It was when we were private, so nobody were interested. We actually did a deal with them early this year to take over a small subsidiary that was sort of left on itself. So there actually is, and we are, since we work in the mid market, if a large company acquires another large company because they want to get into the large accounts, maybe there's a mid market segment there that they're not really that interested in. But we love the mid market, so we'd be happy to be part in activities like that.
Excellent, Johan. We have to finish here. 27 minutes and go on with the next company. Thank you very much.
So good luck with your ambitious project here.
Excellent. Thank you very much. Goodbye.
Bye.
Okay, hi everyone. My name is Daniel Torsson. I'm an equity analyst at ABG Sundal Collier, covering the IT and tech sector. For this presentation, we have Proact and CEO Jonas Hasselberg. He's going to present the company for some 15 to 20 minutes, and then I will follow up with a short Q&A session. So I hand over the stage to Jonas, and I will disappear for a short moment. So go ahead, Jonas.
Thank you, Daniel, and good morning, everyone. So like you heard, my name is Jonas Hasselberg. I'm the CEO of Proact since a little bit more than 2 years back. I wanted to talk to you about a couple of things, obviously give you a little bit of background into what kind of company Proact is, how we see the market develop. We'll also talk about what is it we actually deliver to our customers, so you understand that. We'll be using a customer case to give you a clear example of what we do. And then we'll talk about the financial performance and our strategic focus going forward. So next slide, please. So this is a summary of Proact as a company. We're celebrating 26 years this year. We have a large number of customers across Europe. You can see here on the map that we're present in about 14 or 15 different countries across Europe, where Sweden and Nordics is our biggest market, followed by Netherlands, UK, Germany, and then a little bit smaller markets across the Baltics and other parts of Europe. We turn over about 3.6 billion Swedish kronor, and we're just around 1,000 employees across these different countries. So next slide, please. And I think a key thing here in terms of our position in the market, we're very excited about where we stand in the marketplace. Proact has a desire and is very well positioned as a specialist in the IT industry. We are delivering solutions to large enterprises across Europe with focus on data, so storing and managing data and information, which we believe is critical to everybody's digital transformation. So when we look at the agenda of our customers, the CIOs, there's a lot of things happening to drive innovation and improve the speed and flexibility of the organizations and make sure that they are getting value out of all that data they have and are transforming their businesses. We see a big trend to what we call multi-cloud, which is obviously a bit of a technical term, but the fact that our customers will run IT infrastructure in a number of different ways. They will definitely use the public cloud from Amazon or Microsoft. They will run old legacy infrastructure that they may have had for many, many years, and they will be using players like Proact to store data maybe in a more secure and a controlled way. Customers want to know where the data is stored, how it's stored, that it's secure, and this is where we come in. Obviously, Corona has made some changes, accelerated some of this digital transformation we're seeing, but also, of course, made a lot of change to how people work. And like today, we're all sitting at home from home because of the pandemic. So overall, well-positioned in a marketplace that's changing and where data and information is at the core of the transformation of our customers. Next slide. And that's then also visible in some research we see from external research firms. On the left-hand side on the slide, the bars, you'll see the more traditional business of ours. So this would be when we are reselling software and hardware, which is a significant part of our business. And you can see that there's been a expected drop in 2020, largely driven or solely driven by the pandemic, but the business is then recovering in all our main markets. And we do expect to see some growth in our traditional business as well with hardware and software sales. Single-digit or even low single-digit growth, but still. And then on the right-hand side, less trending, but still CAGR or average growth rate over the next couple of years of cloud services, so delivering the same functionality to our customers, but in the form of a cloud service rather than hardware and software, growing more rapidly at an 8% growth rate. Next slide. And like I said, we are well positioned in the marketplace, and we want to be positioned, or we are positioning ourselves as a specialist. There are a lot of generalists out there, which makes it a little bit more difficult to make good margins. So we're very focused on being specialists. We have 5 main pillars of our offering. We advise our customers, of course, in terms of strategic decisions, as well as could be things like how to manage data, how to classify data, how to store data in a secure way. We do have storage products. We have networking products to connect to the data, security products to make sure it's safe and protected, and ultimately, of course, helping our customers getting value out of our data. So those 5 areas are the pillars of our value proposition, all geared in around data and information. Next slide, and I'll talk about a customer case of ours. It's a Swedish company called Fortnox, relatively famous here locally in Sweden. They are a software as a service provider targeting mid-sized enterprises with a ERP or a finance system. Obviously, the data of their customers is super critical to them, mission critical, and it needs to be stored in a way that's safe, always available, and highly reliable. And we are delivering a cloud solution for them that enables them to be more robust, but more importantly, it's very modern, built on the latest cloud technologies, but also gives them that value and flexibility and innovation capability to develop their product. So if you go to the next slide, the component then of this offering is a set of storage products. So this is where we deliver storage technology, hardware and software that are being put in data centers that are partly under our control and part under Fortnox's control. So this is exactly what we mean by multi-cloud, that they use the different technologies and different ways of deploying technology depending on their needs. It's in 3 different data centers, so they are geographically spread across Sweden to make sure that they are redundant and safe. They want the data to be stored where they can control it and locally, so it's under their legal control as well. And then next slide, we're providing them with networking connectivity, both between these data centers, but obviously also between their premises and and of course access to the internet so customers can get to them. So we're providing very modern connectivity and using our cross-border capabilities with skills out of other parts of the company outside of Sweden to deliver networking services. And then on the next slide, we make sure that it's safe. So like I mentioned already, it's physically located in Sweden. It's full redundancy through the 3 different data centers that I mentioned, and then we provide a number of cloud services of ours or our managed cloud services portfolio to make sure that these systems are up and running and delivering value 24 hours a day. And then on the last slide here on this case, please. We deliver then the ultimate business value here to Fortnox. So the point here is we deliver consulting services to help them design the system. We've sold them hardware and software solutions to enable their new modern infrastructure. And then we provide our own cloud services in the form of networking and systems management and backup solutions to make sure that this data is protected and safe. So we believe it's a good case study, an example of how we deliver IT infrastructure in a way that's very, very complete and holistic, very focused on data, like I said, and in this particular case, meeting the needs of Fortnox very specifically. Good. Let's go into the financial numbers on the next slide. So this is what it looks like for our year-to-date numbers. We've been a little bit less impacted by the pandemic than we expected at the beginning of the pandemic. We were definitely worried that this will have a significant impact. We're now seeing a slight growth. We have 10% growth year-to-date, 1% of which is organic. We see good growth on our services business and very good growth of our cloud business, and 14% of the cloud business is through organic growth. And EBITDA has improved very well, and that's a combination of better margins on our products and driven by revenue mix and gross margins, But obviously, as we also communicated here about half a year ago, that we have been working very focused on our costs and been able to reduce costs in a good way, so which has contributed to a positive EBITDA development. So good revenue development, partly then through the acquisition of Peopleware a year ago, and partly organic, and in particular good growth in our services business. Next slide. We communicated 2 years ago that our new financial targets, or long-term targets, they remain stable. So we are still targeting a growth on average of 10% per year or more. This will be a mix of organic growth and acquired growth. Profitability, we measure profitability as EBITDA. We want to be at a level of 8. I think currently we're just around 6%, so there's 2 more percentage points to go. We think that's doable through a combination of revenue mix shift to services, scale as we grow, and that we have still improvements internally to get our service delivery in particular to be even more efficient and even more automated as we grow. So there's opportunities and activities in place to make that happen. And then last, as I already alluded to, it's very important to us to grow our services component of our revenue. Right now it's right around 40%. We want that to be at least 50%. And the majority of that growth from 40 to 50 should come then from our own cloud services. This will give us a contracted revenue. Typically, the contracts for cloud services as well as our support services are 3 years, sometimes 5 years. So obviously, contracted service revenue gives us better predictability and some stability to our business. Obviously, also a better relationship with our customers and adding more value to our customers. So it's an important strategic move for us. So if we go to the next slide, we'll talk at a high level what we're doing to get there. So if we look at our strategy across 5 different buckets, obviously the market position that we're playing in and that we want to strengthen all around being that data management specialist and create competitive edge. Our own people is super important. The competence and the skills and the expertise is something we work quite a bit with. Broadening our portfolio and conducting sustainable business, frankly, is important. In the area of commercial and portfolio, a lot of work then on broadening the portfolio and also in broadening our capability of selling cloud services. So being able to reach into new areas of our customers. More often now these decisions are made not in the traditional, or not only I should say, in the traditional IT department, but also being made by business owners in the organization that we're working with, because they are a key part of realizing a digital transformation and operational efficiency or better decision making, whatever the use case may be. So we're working very much on our commercial go-to-market capabilities. At the same time, we do believe that the traditional systems business, the selling of hardware and software, is going to be a key part also going forward. I mentioned we believe it's going to grow, even though single digit or low single digit. So we'll continue to develop that area. Artificial intelligence is one of those areas where we see a lot of use cases within our customers happening and where we would both have to broaden our offering in that area, in the systems area, but also engage with a different type of buyer within our customer. Operational excellence, I mentioned already, super critical to our long-term efficiency and reach our financial goals, but obviously also to make sure that we deliver with great quality to our customers, or I should say continue to deliver with great quality to our customers, because we do that already today. But quality and customer satisfaction is high focus here, and then the speed and efficiency of our service delivery. And we have very recently deployed a new tool that automates and improves our customer processes. It's just one of those initiatives we're doing in the area of operational excellence. Fourth area in our strategy is our people, as I mentioned. So being able to attract and develop and empower our leaders is one of the strategic areas we focus on. And like I mentioned already, sustainability, where diversity is one of our key focus areas. Clearly, just code of conduct and being an ethical business in the way we engage with customers and partners, and environmental, making sure that our data centers are as environmentally friendly as feasible. And then last, but definitely not least, as I mentioned, M&A is strategically important to us, and it's helping us accelerate the strategy, both through then broadening our portfolio in areas where we want to grow. That will be areas like public cloud, where we do see a big business opportunity, networking, which will be more and more important, in particular in the context of public cloud, and security, which is an area where our customers are seeing an increased need, and we want to be able to deliver more security services to our customers. So that's the 5 areas of our strategy. And I just wanted to dive in next slide a little bit deeper on the M&A, because we did relatively recently, about a month ago, an acquisition in the UK. So that will be the second acquisition here in about a 12-month period. We also did an acquisition in the Netherlands in October of 2019. But this year then, we bought a company called Cetus Solutions. They're based out of Manchester in the UK. A little bit smaller company compared to last year's acquisition. They are 50 employees. They're turning over about £13 million. But have very strong capabilities in cloud technologies and what we call modern workspace, so enabling the employees and the users of our customers to be more flexible in how they work, and obviously remote working is one of those key drivers. They have very strong partnerships with key technology vendors, like you see listed here. So they bring in not only new customers into the Proact business, but they also bring expertise in areas where we that will enable us to grow in the UK markets. Complementary from a customer perspective, so while they are playing in the same segment of mid to large enterprises, we have very little overlap between customers, which means that we now, when we combine our 2 customer bases, see a very good opportunity for cross and upsell of our offerings, so being able to bring Cetus offerings into the existing Proact customers and vice versa. And obviously then the complementary portfolio is also enabling that. And last but definitely not least, like with all our acquisitions, we want them to have a positive contribution to our EBITDA growth target, and that's also true for the Cetus acquisition. So in many ways, a good representation of the kinds of acquisitions we're looking at here as part of our strategy. So next slide is just summarizing what we're communicating here today. We're very well positioned in a marketplace where we see growth and where our expertise is at the front and center of our customers' digital transformation journeys. We are on good track executing against our strategy. We do see positive development of our financial results here during 2020 and year to date, despite the pandemic. And last but not least, we are also then tracking on our M&A story with this latest acquisition of Cetus Solutions in the UK. So that's my last slide. Thank you very much. Back to you, Daniel.
Yes, excellent, Jonas. Thank you very much for a good presentation. I start off with a question regarding the pandemic effects, actually. Have you seen any change in the consumer or customer behavior in terms of investments in system sales versus service or cloud? Because when I look at the cloud order intake, it's quite weak throughout the year, and you said that has been negatively affected by the pandemic. Isn't that quite surprising? It could be the other way around, actually.
Yeah, you're absolutely right. We were a little bit surprised. So when the pandemic started to worry us here back in February, March, we did a lot of scenario planning and try to anticipate how to mitigate the impact. And we, of course, expected that we would be mostly impacted in our consulting business, that our customers would, on their own part, save money by reducing the usage of consultants. And we expected the systems business to decline because it's something that's quick for them to push forward, transactional purchasing of hardware and software. The effect was quite the opposite. Our consulting business has a little bit of dip in second quarter, but otherwise it's been chugging along very nicely. Our systems business, as you've seen, have definitely been strong during the year. And what we have seen challenges with are two things. One is, as you say, signing up new contracts on our cloud offerings and engaging new customers in general. So, and it's been a combination of just difficulties doing business via this medium of Teams, and people being a little bit reluctant, or customers being a little bit reluctant to make 3 to 5 year commitments in times of uncertainty. I think over the last couple of months, we see a little bit of change of behavior. It's probably a combination of maybe either see some light in the tunnel of the pandemic, although the second wave is maybe blurring that a little bit, but frankly a pent-up demand, and people are getting used to this new way of working and new day of doing business, and can't sit still. So we see a little bit of positive development on our business now, which is good.
Okay, interesting. And then the question on the business model in cloud. Are you offering the cloud solutions as price per data in general, or more a fixed price for an implemented solution? I mean, is the data volume itself a revenue driver for you?
Yeah. No, and it varies quite a bit. And our solutions, as you can imagine, as we go into really large enterprise, is very complex. So the pricing model it's a mix of a number of things. And in many cases, there are dedicated implementations. So it's not like when you and I buy a Spotify subscription or a Netflix subscription. It's a super standardized package. It's all running out of the same backend. So we often implement dedicated systems for a particular customer. So it will then be based on definitely the capacity of the system, so storage capacity, but could also be things like the underlying architecture investments and depreciations and SLA, so the quality requirements they have on things like uptime or response time. So it's a mix of a number of different components, but ultimately it comes down to the capabilities of the service.
Okay, I see. A question about the Cetus Solutions acquisition you made around 5 weeks ago. So what are the first impressions? How is it going with implementation? Everyone's working from home in the UK, etc. Any surprises you have seen there?
Yeah, positive surprises so far, which is great. The team, obviously in Cetus, everybody gets a little bit worried when there's a new owner, and in Cetus' case, they were the founder was the owner, so it was everybody knew the owner, and then the owner was active as the managing director. So obviously, it's a concern when, relatively speaking, a bigger company comes in. That has been very well received. We've been very active with communication, and our local team in the UK is meeting with the Cetus team on a very regular and high frequency basis. So that's, I think, been very positively received. We see some positive development in the synergies, where both on the revenue side, but also on the cost side of things, as we're now become a bit of a bigger player in the UK and bigger player towards some of the partners we're working with. And a lot of positive engagement in terms of cross and upselling between the teams. So, and we saw the same with the Peopleware acquisition in Netherlands. The sales guys and the customer teams are very eager to get to know each other and find ways to develop the business within the customers. And so that's another positive development.
Okay, excellent. Sounds promising after a month at least.
We think so, yes.
Yeah, and then the question on your EBITDA margin target, 8% going forward. You are around 6%, as you said, and that's going to be driven by a higher share of service sales, partly going forward. And the two most recent acquisitions, Cetus and Peopleware, as you mentioned, they have much higher service revenues than you have, and much higher than 50% of sales, but they were not at 8% themselves. So what else is going to drive that?
So Cetus' service component was not too different from ours, but you're absolutely right. Peopleware had a high degree of services revenue, and it's like the thing we spoke about here. There is a scale component of being able to leverage size to improve your margins. There is a mixed component here. Different services are higher gross margins. And then last and definitely not least, the way we deliver this, and we're still, and it's true for Peopleware as well, and it's very typical when you're small-ish, a high degree of manual and customer-specific processes where we think we can do things more standardized and automated. So those are the three main components that would help us reach that target: scale, efficiency, and product mix.
Okay, excellent. We have 1 minute left, so I have a final question with a relatively short answer, hopefully. The market is certainly transforming from investing in hardware to migrating into cloud solutions for data storage in general. How far have we really come on that journey for large enterprises? Do you have any good clue?
No, I think there's plenty to go, but I think the main thing to be aware of here, and there's a reason we use this term, which may sound a little bit like an insider, IT industry insider term, a multi-cloud. There won't be a single cloud solution for the future. Our customers will live in a world of different architectures and different technology solutions for different needs. They will use the public cloud. They will use Proact Cloud. They may be running things in their own legacy data centers. And that, I think, we will see for as long as we can predict the future. So it will be a multi-cloud world forever. And I think most customers are aware of this and have come relatively far.
Okay, excellent. We stop there. Thank you very much for the time, Jonas. Good presentation.
Thank you for listening and hosting.
Yeah, and thank you, everyone. And then we go over to the next company. Thank you. Goodbye.
Hi and welcome everyone to today's presentation of Flexion Mobile. My name is Stefan Knutsson. I'm an equity analyst here at ABG, and with me today I have the CFO of Flexion, Niklas Korsar. Welcome, and the floor is yours.
Hi there, thanks a lot. I'm sitting here in London. I'm almost alone in the office. I don't trust my broadband at home, so I'm here. We have few people. We should be 35, but it's very, very quiet here. So if you go to the presentation, next slide. So Flexion Mobile is a distribution platform for mobile games, and that means that we go to third-party game developers who typically work with the top 750 biggest games and secure the distribution right for those games into the stores we work with, what we call the alternative market. We're a London-based company, 56 staff. Went to First North 2.5 years ago. As a company, we work with a very, very simple revenue share model where we, someone purchased something and then we split up the revenue between the store, us, and the developer. I'll come back to that. We come pretty far. We have the biggest distribution power on our market. So we work with all the big stores, which is Huawei, Amazon, Samsung, One Store, Xiaomi on the market. We also really built the biggest, already after 2.5 years, the biggest portfolio of games. So we work today with 20 games. It may not sound that much, but if you think about it, the world's biggest developer in terms of have 26 games which are on 750 top grossing games, and we have 20, so we're the second biggest distributor game, but we are the biggest on our market. We grew the revenue in our company a lot since IPOs. We grew by over 500%, and we're EBITDA positive in the last 2 quarters, which is great for me as a CFO. Next slide, please. History is very important for us, and I come back to that. So the company was set up by 2 brothers, Jens and Per Lauritsen, so are still in the company and the biggest shareholder. And they have developed technology to be able to distribute mobile games. They started a very simple try and buy solution, and that has then grown into what we do today. We went live with game on freemium games on Android in 2014, and thereafter we built both continue with the technology but also a full service offer, which I come back to. What is really cool is what we achieved last quarter, and that is that we hit on our top games, not game, but games, we generated more than $500,000 per month on these games, and that is what a top 750 game generating Google Play. So we are really starting to add the proper value to developers here. Next slide, please. So we work in mobile gaming, massive market, as you probably know, $70 billion market growing to some $100 billion over the next few years. In the space, we don't work with Apple, so we focus purely on Android. That's 85% of all mobiles. It's more than 50% of the revenue, and that is where all the new opportunities are. On that market, we don't distribute games into Google, we don't distribute into China, so we focus on the alternative market. That's our target market and the market where you kind of want to take. Next slide. So on this market, we work then with the top stores on this market. So we work with Samsung, One Store in Korea. They have about 30% of the Korean market. Work with Amazon, you all know that. Huawei is a newcomer in the Western world on app distribution. Xiaomi, but there are also a lot of other players. The rest of the manufacturers like Oppo and Vivo. You have Facebook entering the space. You have TikTok entering. So everyone are kind of coming into this new market. Why are they doing that? For first and foremost, they all want to get a share of this massive revenue cake, so to say. But for these players, it's of course also very important to build their own ecosystems on the market. So think about it. I'm a heavy Amazon user, and the last thing on earth that Amazon want is that I go over to Google Play every time I buy a game, because then Google tries to capture me with their advertising. So they want me to remain in their ecosystem all the time. There's also a lot of regulatory pressure in the market, that there's 2 dominant stores. We see that in the US, we saw it in Europe, continuing in Europe. You have it in Russia, Southeast Asia, Korea. So there's a lot of top-down pressure. And we also start to see quite a lot of bottom-up pressure. And a typical example is Epic, how they are fighting with Google and Apple, where basically for the developer to get a bigger say in the whole distribution. On top of that, we start to see a lot of movements in new regions. The one we've been waiting for a long time, it will come one day, is the Indian market. That is, in terms of users, as big as China, but it's at the moment still a tiny market, but it's coming. Southeast Asia, Middle East, South America, which are markets where the kind of Western one-fit-all solution in Google Apple is not working very well. You have a lot of languages, different payment solution, different cultural things. So the market is really opening up at the moment, and we are in the middle of that. Next slide, please. So what is the problem here? The developers are in 2 stores, Google and Apple. They're both there. They're in both stores. That means there's 3.5 million apps in each store, and the developers it's really, really hard for them to be seen. And they have to spend a lot on user acquisition to be seen in those markets. At the same time, it's very hard for them to reach out to new stores, because the games are now so complex that you need to build one distribution pipe for each store, technically, commercially, operationally. And that means that maybe they try 1 or 2 of these alternative stores, but they don't do it full-hearted, and they cannot remain in 2 stores. So there's a market problem here that we solve. Next slide. By developing a full service offer, and we're the only people who can do this. So we identified all the pain points for a developer in distribution, and we have then, since then, 2014, solved those problems. Basically, what we can go to developers and say, instead of you doing all this, give us the existing file you have for Google, and we then take care of everything and send back money and data to you. The underlying technology here is very important, and that is that we have a repackaging solution where we can take that file from Google Play and repackage it in our software, and then create dedicated files for each stores. We're the only people who have that technology, and that's really the underlying reason why we could start working on this full service offer. We have a patent in the US, patent pending in Europe on that. In Europe, we still wait. I think it's a COVID delay on responding from the grant office. Next one. So basically what we tell the developer is, you're very good at Google, you're very good at Apple, continue to do that. You don't distribute in the rest of the market. So let us do it for you. Let us become your 3rd distribution pipe to the market. And by doing that, we combine enough value for them to be, to justify to open up a new kind of distribution pipe, which is Flexion. Thanks. Next. Why is it only us who can do that? And that is really why when the history comes in here, because we started this in 2007. So we started with some really simple technology, simple games and simple channels really, and slowly built it up to a position where we are today. And you think about it, it's very hard for someone else to come in now, because if you don't have the channel and technology, you're not going to get the games. And if you don't have the games, you can't build the technology and channels. So it's very hard to enter. So we build really strong barriers of entry. Next slide. So basically what we're doing, we're clearly a first mover on the market. We have a very scalable model. We are creating barriers of entry for others. And we start to see what you call network effects here, where the developers are start introducing other developers. We can work with other games for the existing developers, and the channels are start introducing us to developers. So we build a kind of not an ecosystem or an enabler for an ecosystem, but it's our little market here is just growing. It's growing quicker and quicker and quicker. Next slide. We work, as I said, with a very, very simple revenue share model in the company. So we take a game and we convert it, put it out in a store. Someone pays 100 down to the store. Google and Apple take 30%. We have one store, we have 30% store fee. But we also see stores down to 15%, but say on average, they take 20. That means that the store pays down 80 to us. And then we have a kind of soft target to have an 80-20 revenue share with the developer. So 80% of 80 is 64, which is the payout to the developer, and we retain 16. If you look on the last quarterly numbers, we reported 13% margin, but there were some positive historical effects in there, so we are at slightly north of 11%. So yes, there is in this narrow strategy, maybe there's 50% growth potential in margin, but it's important to note that we are not a margin play in Flexion. We are a revenue play, and that's where we focus on. We don't focus on increasing the margin in the company. We've seen quarters where we do more than 50% growth in one single quarter, and that's kind of eaten up. That's a much bigger gain than working on the margin in a single quarter alone. What's important to note here also that we sit on the cash flow stream after 80. So that means that we can take in the cash, analyze it, put it together, and then pay it out. So we have what kind of the grocery model, ICA-modellen in Svenska, where you sit on the cash and you get what you call a negative working capital flow in the company, which is very good when you grow your revenue. Next one, please. The portfolio has grown a lot. We had 4 games when we IPO'd, and we now grown to 20 games. I will say with a lot of value into them. But it's fair to note here also that if you look on the KPI section in our quarter numbers, where I think we have 7 games in a ramp-up period, which hasn't really kicked off yet. So there's still a lot of potential in this portfolio. We also have a target of 27 games in March 21, which is the end of our financial year. And we maintain that because of a very healthy pipeline in Flexion for the rest of the year. Next one, please. This is an important slide. I think when I talk to an investor, about 90% of them talk about that Flexion is about number of new games. This very linear relationship between new games and growth in revenue. And yes, it's one of the axes how we grow. Direct sales. We see that the target number of games we can market was 2.5 years ago was 400. Now we have 800 games we can market. And also we start to see this network effects by, we have a relationship with the developers, so we can work on their other games. We get introduced to new developers. The stores work with us on opportunities. So yes, it's a very important factor in our growth. But if you think about it, that portfolio we have at the moment has revenues of $1.5 billion. So why can't we increase the distribution power on these games a lot? Massively. So what's important here is it is more important than number of games, is the distribution power in Flexion. And if you see here, we have last year, we took in one more channel, Huawei, which worked. So we basically just put out the whole portfolio in that store and just lifted the revenue base of the whole company. We also see by having games out in these stores who invest a lot of money themselves, we kind of grow with them, so to say. So Huawei has an investment program of $1 billion. One store we work with have announced an investment program of $100 million. Samsung are the same, Amazon the same. So just being there, we are growing with the stores, which is very attractive. So just to summarize, it's a lot of different ways we can grow in Flexion, and hopefully at least one of those different axes are growing. And in a dream scenario, we get a lift in all kind of axes in the company. So I think that's the reason why we see a very healthy growth multiple in the company. Next slide, please. So just to summarize the strategy where we are. So we have a very narrow strategy at the moment. We call it earlier go-to-market strategy. I think we're beyond go-to-market, but it's still increase the number of games, increase the number of channels, and get stronger distribution on existing games. It's narrow, simple, and very focused, and that's what we do at the moment. And with that, we have a lot of growth opportunity. We have a model where you get a very diversified risk profile, both in games and channels. And we see what we see, and something I learned over my years in Flexion, it is quite painful to build a platform. It's very costly because you need to do a lot of development and processes. But when you reached it, you come up to your critical mass, which we have done, and I show that in the financials. You can operate with a very low marginal cost in the company. So it's a beautiful position for us to be in. So existing strategy, stable, diversified, profitable platform. And from there, be able to then grow and take opportunities in kind of land grab opportunities in bigger new strategies. And that is, for example, work with the stores on alternative promotion strategies, follow the new trends, which is more direct consumer distribution, where we have a lot of tools and the kind of technology for it, to work on when UA, user acquisition, comes into this market for real, to be a real player in that, and also to work on consolidation in our service industry. All strategies, which is things we're thinking of, but it's not the core strategy at the moment to develop, because that is the green sector. But in there, a lot of growth opportunities, and also possibility to add value services, which then you maybe can look at growing your margin beyond 16%. Next one, please. So if you look on revenues, we have had a pretty decent growth in the company. We've grown by almost 20% quarter on quarters over the last 10 quarters, or since we did IPO, with a bit of hockey stick at the end. That's a factor of one, we launched some really big titles long before that, who just took off in the last couple of quarters. We put in a new channel, Huawei. We just lifted the revenue base, as I said earlier. We had seen some COVID effect, especially in Q1, but we haven't really seen that to be a very big driver for us. It helps a bit, but it's definitely not the key driver on that market. So yes, pretty good growth. Next slide, my favorite slide as a CFO here. And that is that we have a very linear relationship between revenues and gross profit. We are at about 11%. So since we're growing revenues by 170, almost 200%, you get a very decent growth in your gross profit at the same time as the cost level being flat in the company here. So we see we have minus 2% in growth on the cost base, and at the same time as we managed to increase the staff. The reason why we kept that flat is that we work with our Hungary office to make it more efficient. But most importantly, we work with very big IP, so we have to have very focused, structured, and automated processes. So we're not dependent on expensive staff in Flexion. And you don't really need to be a rocket science if you go to the next slide to see what the effect of this is. Next slide. Yeah, and that is that, from a kind of control negative EBITDA, you go into positive EBITDA mode and beyond. This is just mathematics, really. And the next slide also, the same on the cash. where you had an kind of controlled burn rate and you're going to positive cash flow, both because of EBITDA, but also because you have this working capital effect in the company. So just to summarize on the next slide. So basically, we have the biggest portfolio in our market. We have the biggest distribution power. We have a massive, massive market opportunity. We are a first mover on our market. And we have a very, very clear strategy how we're going to go forward. And from that also that we see a very, 170% growth in revenue and we're EBITDA positive. So it's a pretty decent position at the moment as Flexion. Thank you.
Thank you, Niklas. Very interesting. I will just ask some questions. And the first one is, what would you say is the biggest value add that you bring to the game developers? What part of the offering are they most appreciating?
It's that we have a full. What we add value is that we also solve all the problems. We see, competition of people who provide part of the problem, but it doesn't work because you need to solve all of them. You can't have a car without wheels. It doesn't help. If you solve all other problems except the wheels, you're not going to have a car that works. And we are the only people who have a working car at the moment. So that is our full service offer. We started by thinking that technology would help us, but we realized very soon that we need actually to be a service company, a technology-supported service company, and that's what we is in Flexion.
And have you seen any change when it comes to negotiations with the game developers, like for say this year and 2-3 years ago when you were not as established as you were?
I think there's two factors here. We are. First of all, we handle extremely big IP, intellectual property, and the property, could be actually from a third-party provider. Actually, it could be like a Disney, for example, who has a Donald Duck thingy, and so the bigger we become and the more titles we have, the easier it is for us to build that trust that we can handle those big games. And the second factor is that, as I said, that we now have KPIs where we, on our top games, generate $500,000 per month. And it kind of becomes quite a big story for them. They kind of can't ignore it. So yes, it's easier and easier for us to, and quicker for us to sign up new games.
And part of your success this year has been because of the new distribution channel, Huawei. But my thought is, what happens when a channel like that grows very big? Because my initial thought is like, isn't the game developers starting to target that market directly? There has to be more to the story than that, than my first initial thought.
Yeah, but still, we work with many channels, and I think you need the combination of them to be strong enough for do it. They're not going to do one because it's not big. The opportunity is not big enough for them. And then on top of that, with Huawei, they don't have the Google functionality, and it's quite tricky for the developers to actually get it to work with them. And that's something we work. So I really don't think that is a problem for a long time for us.
Okay, perfect. And then if we look at the development here in the recent quarters, you had very strong growth. And in the same time, you have kept costs under control. So your total SG&A has dropped from 33% of revenues down to below 15%. What has been the main driver, and do you think it's a sustainable level to be at?
I think it's very much we just reach critical mass on the platform, where you have a product that works and you have the knowledge in the team, and you built enough capacity to work to operate where we are. It's very simple, and at the same time you're getting strong titles that grow a lot. So it's yes.
Okay.
Just to continue, as is.
Okay, perfect, Niklas. And then to just lastly, you mentioned that you have also future growth possibilities from hybrid stores and so on. Which one of those are you most excited about?
As I said, we are not. The strategy at the moment is what I call the green side of the left side of the strategy. But we are kind of looking into the new ones and see where we're going. Of course, user acquisition, it drives the whole market at the moment, and that will come to kind of our market too. And we're then in a perfect position to go in and be a real force and enabler of that one too. And it's a massive, massive opportunity. But the other twos, let's see. It's a little bit what we see how the market develops. We learn in all fronts and we see where we end up.
Okay, perfect, Niklas. Thank you very much for presenting with us here at ABG today. And yeah, thanks.
Well, thanks.
AI powered.
Hello and welcome everyone to today's presentation of Semcon. My name is Stefan Knutsson. I'm an equity analyst here at ABG, and with me today I have the CEO of Semcon, Marcus Granlund. Welcome.
Thank you very much, and thank you for inviting me to the Investor Day. I want to just briefly present Semcon, and for you who have not previously been following our company, just to give you a brief background. We're of course the partner in advanced product development, production optimization, and digital product information aftermarket solutions. That's what we do, and in these three areas are our main focus. Going on to the next slide, please. So briefly, we're an international technology company. We have two business areas structured within engineering and digital services and product information. We're around 1,800 dedicated employees, and 2019 we had a group revenue of 1.9 billion SEK. We turned 40 this year, so we were founded in 1980 and we're listed on the Nasdaq Stock Exchange and present in 7 countries at 30 sites. So in fairly international company, but our main focus is in the Nordic region. We put people first. As far as we are concerned, technology has no purpose of its own. It's the value it adds to people and our planet that is most important. And by uniting physical and digital solutions, we create user experiences that matter. This is how we make a difference. And this is the why that all our dedicated employees work towards every day. And it's extremely important that we have this why as our focus to create the inspiration in our everyday work together with our customers. So next slide, please. As we work towards making this planet a better place and also working with the people focus, we work with sustainable innovations in 3 dimensions with our customers, both retrofit by using existing products and systems where we use R&D to make those even better. We also use reinvent with new products and services where we create those together with our customers. And now it's also a very clear trend that we also work with reimagine, working with our customers with regard to business models and offerings to make those offerings even more sustainable. Sharing business models is, of course, one of the clear trends that we see. And in the top left-hand corner, you have one of the examples of the hull skater that we have created together with Jotun, which is well known for selling their paint. And here we have created a hull skater that goes across the hulls of the ships that cleans the hull and makes sure that we can reduce CO2 emissions by 12.5% by reducing the fuel consumption of the ships and also making the oceans around the world cleaner. So that's one of the inventions and new products that we put on the market. We also work with Getinge within surgery rooms, and you see other examples here to the left. Next slide, please. We are with our customers through the whole development chain, both going from strategy and design over to prototyping, piloting, industrialization operations, and then aftermarket. So we are often in very early stages together with our customers with regard to product development, production optimization, and with the aftermarket offerings that we have. Next slide, please. Looking into the financial development in our company recently, we have been on a very, very good journey for the past few years, strengthening our profitability and also our financial position. We have, due to COVID-19, made a few restructurings in the second quarter. But as you can see, we have a very strong financial position now with 186 million SEK cash and now operating margin of 8.5%. And adjusting for those 37 restructuring costs in Q2, we have an adjusted operating margin accumulated of 9.6%. Moving on to the next slide, please. And the next slide, please. Also been working very hard to improve the cash flow over the past few years. And the cash flow from current activities have gone clearly up and are now up to 213 accumulated this year, which is a clear improvement. Of course, a decrease in tied up working capital has helped to strengthen the cash flow in 2020. And as we have a very strong growth focus going forward, we will tie up a bit more capital, but we will not be going back to the cash flow situation that we had a few years ago. Next slide, please. And with regard to liquidity development, this has also been a very strong focus from the management and the board of directors in the company to improve the financial stability. We have really succeeded in doing that. And during the last few years, we've also made a few acquisitions. One acquisition in Germany, which is Haas GmbH, with focus on aftermarket towards the railway industry, where we see huge investments all over Europe at the moment. And the last acquisition that we made in the beginning of this year in Q1, Extractor, which is a company providing digital platforms for learning management systems and digital training, where we are now one of the largest in the Swedish market and in the Nordic region. This demand is also increasing now due to the pandemic, of course, when classroom trainings are less favorable and everyone is doing their training digitally. So we are now well positioned for further acquisitions with a strong financial position. Next slide, please. Just to give you a short update regarding COVID-19 and how that has affected our operations, I'm extremely proud of my team here at Semcon. We have successfully been working at a distance, keeping the high productivity in the operations and even strengthened the productivity during COVID-19, turning to distance working within 1 week. Taking restructuring measures, doing that in 1 month in April, and we have been really efficient in keeping the cost down and keeping cost control during these times during the pandemic. And we have also during this time moved in the strategic direction that we want to accelerate the transition with even more diversified industry verticals. And we also adhere, of course, to local recommendation and stay safe. So next slide, please. Looking in a bit to the business area product information and their offering. Here we have our own platforms and digital tools that we provide to our customers, which we are populating with user information, service information, parts and accessories, product information, and also training solutions that I mentioned just briefly. And on top of that, we're also providing strategic support and operational excellence with regard to this. Next slide, please. I can show you a bit what's happening here. This is a business area that is now accumulated during this year, is performing an operating margin above 15%. We see a good demand for digital aftermarket solutions. We have more than 75% of revenue from long-term contracts where we have our own digital platforms. Of course, this creates a good environment for long-term customer contracts where we have been very successful over the last few years. And we have also anticipated strong earnings at the end of this year, of course. In the world around us, you've probably seen a few capital market days from industry companies where it's clear that the focus on investing into the aftermarket and service business for our customers is increasing. This creates resilience for our customers in turbulent times, which means that you need to have a good backbone with regard to product information and good, stable digital platforms where you can distribute the service information and product information for those products. So the customers are investing more in aftermarket solutions at the moment, and that's, of course, driving sales for us. And we are creating the technical documentation and digital platforms which are not core activities for our customers, which makes it more likely for them to outsource that kind of operations to us, which is where we create the long-term contracts with the customers. So if you go to the next slide as well, just to give you an example of what we do, one of our customers is well-known AGCO, which is the largest company in the world producing and selling agricultural equipment. And here we had a focus together with them to use Semcon's digital platforms to provide digital information to with regard to their equipment, which is then distributed to the farmers, and where we used best practices and technology innovations to do that. So we created one global interface with unified processes and standards. We used one master language for this group and increased reuse of information that could be used with owner's information, service information, training information, and so on. And we, least but not last, also improved the dealer and farmer experience by creating this for them. They wanted a more efficient operation. They had the creation of documentation being made in 16 different sites around the world. Now they have centralized this, and normally when we enter into these managed service contracts, we are able to reduce the cost of the customer for this segment by around 30%, which makes it very attractive to enter into a partnership with Semcon in this area. And also by using our digital platforms for distribution and populating the information also creates, of course, a long-term relationship with our customers. So moving on to the next slide, please. The other business area is providing engineering and digital services. This is where we provide strategic design and innovation, advanced engineering, production optimization, and digital services, and also providing advisory services and project and quality management. This is, of course, a strong trend. The R&D is increasing, and technology is playing an even bigger part in our society. That's why we see strong trends here also for our growth going forward within production optimization and product development and connected products. If you go on to the next slide, please. So here we see during the last year, we have accelerated our industry diversification. We have grown within life science by 23%, not the least by within production within life science. It's a very strong area for us. And we are one of the strongest suppliers here in the Nordic region towards the life science industry. We have used successful cost savings here as well and created better resilience in this business area in more turbulent times. And as I mentioned, the investments in R&D are still a top priority for our customers. And the demand for our services, when customers don't have budgets to increase number of own employees and increase their fixed cost, is of course that they need to keep the R&D activities up, and that's when they also use us to accelerate their transition to make their production facilities and products more connected and more smart. So the connectivity trend continues both for products and for production. Moving on to the next slide, please. So one example here is the partnership that we have with PowerCell for green fuel cells. We help them to optimize their production for new robot cells and to create more efficient fuel cells. So as you know, the fuel cells are 100% CO2 emission free, and we are their product optimization partner through automation and robotics. Moving on to the next slide. So just showing you a brief film regarding what we do within artificial intelligence and how we use product information and our connected and AI competences to provide value to our customers. Go ahead, show the film.
With more complex technology than ever before, still, we expect it to run smoothly at all times. Besides frustrated users, the cost of downtime can be severe, making fast and correct service a top priority. Semcon has developed a unique AI-powered virtual assistant to help service technicians find the information needed to solve complex problems, just by asking for it. Let's have a look at how it works. We have used the latest knowledge from the complete field of artificial intelligence. Our experts built a data miner that constantly and automatically crawls through huge amounts of data in different sources, closed or open, cloud-based or local. The information is then structured in an advanced semantic layer, making the data accessible for the AI-powered virtual assistant. The assistant has a sophisticated level of speech recognition, so regardless what situation you're in, it'll understand your question. It'll talk and reason with you. And then the answer to your question is presented in a straightforward manner, making complex service easier and faster than ever before.
Yes, so this is a good example of what we can provide, and this is of course our own intellectual property that we have created, and we see a huge interest from a lot of industry customers within this segment. Now going on to outlook and strategic direction. Next slide, please. We're on this fantastic journey, and I'm really proud of the team here at Semcon, what we have achieved during the past few years to put us in the position where we are now. We did during 2015, 2017 a refinement and refocus with new strategy, a divestment in our operations in Germany, and focusing on financing and capital structure to achieve the target of getting to a stronger financial position, which we did. Now 2018 to 2020, we have worked with expansion and digitalization. We have done some restructurings in engineering and digital services to put us in a better position for growth. And we have had an extensive digital agenda. We've taken investments and made acquisitions during these years, and we've reached the group financial targets prior to COVID-19. The target has been to strengthen the profitability, which we have really done during this past time. And now it's time for the 2021 to 23 focus, which is growth and profitability, and to both increase profitability and also grow, both with organic growth, because we see the main trends are with us, both within digitalization and also within aftermarket services. And we also have the financial strength to make acquisition as well to boost our growth. And we will continue to work with continued digitalization. Next slide, please. So yesterday in 2015, we were at operating margin of 0.4. We had a non-automotive share of 33%. We had a net debt of 78 million. Now we are at 8.5% operating margin. We have increased and moved into other verticals as well. So now non-automotive share is 66%. We have a net cash of 186 million. And now the focus is continue to make sure that we grow and grow even faster, and also increase our profitability to be at least on par with our financial targets, of course. Now, next slide, please. And so the focus now is, of course, to continue the transition towards digital solutions, continued focus on managed service and solution-based sales, be the employer of choice, of course, to continue our recruitments, high productivity, efficiency, and gross margin, which we have been very successful in achieving the last few years and will continue, and accelerate growth, both organic and through strategic acquisitions. Next one, please. And so the targets now, as I mentioned, we've reached those. Operating margin of 8%. We're on 8.5 now. Equity asset ratio above 30%, 59.3% in Q3. And dividend yield is, according to target, 1/3 of the profit after tax. Although, if we look historically, we've always been paying out more than 50%. Last time we paid out dividend in 2019 was at 57%. Next slide, please. So we have a solid position for future growth, growing need for technology. There is increased focus on service and aftermarket solutions, as I've mentioned. We have a unique combination of digital solutions and advanced engineering. We have a beneficial industry diversification now moving into new verticals. And extremely important, inspired colleagues, the basis for profitable growth. We have now on very high levels, historically on employee engagement and employee satisfaction. And we have a very strong financial position, as you've seen. Next slide, please. And the year-end report 2020 will be published on February 10th. Next slide, please. So, as I said, we put people first, then technology, all to make sure that we put people and planet in focus. Thank you very much.
Thank you, Marcus, for the presentation. I want to start off with some question on the product information side. You mentioned the collaboration with AGCO, and it's interesting to hear. Is it mainly cost savings that the customers will benefit from when they become a customer of yours, or is there also other parts?
Now, their main focus was to really increase the value for the end user of their products, to ensure that they have even more loyal customers where AGCO will benefit from repurchasing of AGCO products, to have a loyal customer base. And you get a loyal customer base by having really outstanding service information and making sure that the farmer gets the best possible experience of their products that they can possibly achieve. So that was their main focus. Then, of course, it's not bad to be able to lower their cost as well significantly, as we have done in that case.
And you also mentioned that this is often non-core activities for your customers that choose to do a managed service contract. Is there true for also the biggest organization, or is there a sweet spot that you target more mid and small size organizations?
I mean, AGCO is a very, very large company, the largest company within, as I mentioned, agricultural products. And most of our customers within this segment are multinational, very, very large companies. Of course, we do have companies in the mid-size segment as well, but the usual customer for us in this segment are the really, really big customers where they see strategic advantages in going with Semcon as their partner within product information and aftermarket services. And our customer target really is the customers that are in industries where they provide advanced products and systems, where there are requirements for updates, both with regard to digital platforms and with regard to the product information that goes into that system. That means that we have ongoing business and recurring revenues to a larger extent compared to customers which are in segments where there are more simple products.
And since you launched this product with AGCO, have you seen an increased interest in your offering from other customers because of that?
Absolutely. And we see that we have a large number of ongoing discussions at the moment. And as we've seen now with a bit of a downturn in the economy, of course, and the business cycle that also was initiated before COVID-19, we saw an increased interest in getting the backbone of the customer's aftermarket business really up to speed and up to date to make sure that they can make use of that to be even better in increasing the growth of their aftermarket services, which is a clear target for many of our customers. Some of them even set targets now to have 50% of their total revenues should come from the aftermarket business. And you don't do that just by putting an app in place. You need to have the backbone in order, and you need to handle all the legacy of product information, user information, the service information, parts and accessories information in order, and we can do that for them, both from a strategic point of view and make sure that we can deliver on that together with them.
And would you agree that you, because of this development, that you are more competing with maybe IT consultants and software companies? And if that is correct, what sets you apart in this case?
I mean, the traditional IT companies don't provide the expertise that we have within product information and how you structure information in the way that you do the authoring and topic-based writing within this segment. So we both have the digital platforms to populate and distribute the information, but we also use multi-site deliveries, for example, from Hungary, where we have more than 200 colleagues doing the authoring of all that complicated technical documentation. And that's usually not that the IT companies have in their offerings. And that's why we are one of the largest companies within this segment in the world today.
And then going over to engineering and digital solutions, what would you say that where are you in the transition away from the automotive sector? You have decreased it quite a lot, but where do you stand right now?
First of all, we're very proud of our heritage within the automotive industry, even though we have taken the strategic direction to really grow other verticals and done that very successfully. And now the automotive industry is 34% of our total revenue. It's a fair share, even though the competence that we have in that area is where also our customers take a lot of investments going forward. It's within electrification, it's connectivity, and it's aftermarket services. So we are quite comfortable with the position that we're in now. We have created a company now over the past few years, which is much more resilient with a stronger position. I foresee that we will have a larger growth percentage-wise within, for example, life science and the energy sector and those kind of industries and the manufacturing industry outside of automotive industry. But we will also have make sure that we can support our automotive customers in areas where they take a lot of investments now within electrification and connectivity. That's something that we see as both profitable for us and is creating fantastic value for our customers.
Thank you, Marcus. I would like to has been very interesting to hear your journey and where you're aiming for, and thank you for coming and presenting with us here at ABG.
Thank you so much. Thank you.
Hello and welcome to this next presentation here at ABG Investor Days. My name is Simon Granat and I will be moderating this presentation, and I work as an equity analyst at ABG covering tech and IT companies. With us today we have the pleasure of welcoming Johan Nordqvist, who is the CEO of Briox. And with that said, Johan, please go ahead and present the company.
Thank you very much. As said, I'm Johan Nordqvist and I'm the CEO of Briox as of May this year. Before I begin, I just want to extend a thank you to ABG for arranging this day and for, of course, everybody listening to this presentation. I think most of you are familiar with Briox, but for those of you who are not, we're a software as a service company that develops and sells our own ERP system that enables collaborative accounting between accounting agencies and their customers operating in Finland and the Baltics. Move on to the next slide, please. What I will try to do in the next 15 to 20 minutes or so is to give you a brief introduction to Briox. This includes a brief history of the company, a look at our board and our management, the markets in which we operate, our product, and our sales model. I will also then spend quite a bit of time trying to explain our business model and how, with focus on how it's designed to help us scale up and drive growth in the coming, hopefully very exciting years. So with that, if we move on to slide 4, please. Good. The history of Briox dates back to about 10 years, although it's been operating in its current form for about 4 years. I'm sure close to all of you are familiar with Fort Knox. In 2020, Fort Knox wanted to take its product offering outside of Sweden. And as part of this decision, a spin-off company was formed, which got the name Fort Knox International, with the objective to introduce the product to primarily the UK, Finland, and Germany. So in the coming years then, quite significant time was spent on adapting the product, although the platform was the same, but to adapt the product so that it fit local customer needs and also legal requirements. And about 2 years later, it was ready to be launched. And in the coming years, then quite a lot of efforts were made into signing up partners in these markets, both strategic accounting partners and integration partners. Although a lot of progress was made, the German and the UK markets proved to be quite difficult to get into and scale up quickly. So in 2016, an important decision was made to focus all of the efforts on the Finnish market. This is also when the company got its name Briox, which it operates with today. And this proved to be quite a good strategy. The business picked up. A local sales team and the local office was established in Helsinki, and more accounting agencies were brought on board. So in the coming years, we have established collaboration with several important integration partners, such as many of the leading banks, Holvi, Servant, and some other players, and also formed partnerships with many of the leading accounting agencies in Finland, BDO to mention one. In the past year, we also moved into Estonia, where we now, as of this year, have people on the ground and an office in Tallinn. And as of this year, we have also entered the markets in Latvia and Lithuania, where we now have local salespeople since about 6 months back. I came on board about 6 months ago, as I said. In this year, we've also strengthened the board, which I'll talk to in a second. And at this present time, we have partnerships with about 170 accounting agencies in the 4 markets in which we operate. If we move to the next slide, please. Here you can see the board of Briox, and I'm bringing this up to demonstrate that we have significant experience and expertise when it comes to the ERP and specifically the accounting industry. We have the chairman in Johan Rutgersson, who was actually the CEO of Briox himself during 2010 to 2016 to 2018. He's also working in several other SaaS companies and very familiar with this industry. We're also fortunate to have one of the co-founders and the former CEO of Fort Knox on the Briox board in Jens Koldskog. Jens has been working pretty much his entire professional career with ERP systems and accounting. He also has significant time in Visma, which is the same as Daniel de Souza, who was brought on board now this year. Daniel was formerly the CEO of Visma SBCS. And we are also very pleased to have Helena Westin on the board, who I dare to say is one of the leading people in Sweden when it comes to marketing and PR. She's been the head of marketing for several big Swedish companies, and she's now on the board of several big companies, including the Swedish television. Moving to the next slide. As I mentioned before, we have, and I want to underline this, we have sharpened our focus and now fully focus on winning together with accounting agencies. There are different ways how you can get to the sort of the small and medium-sized enterprises and their end users, but we believe the right way for us is to go through and work with the accounting agencies. And some claim that the accounting agencies and the accounting industry is facing somewhat of a grim future, with a lot of services being automated, we have services being outsourced, and so forth. At Briox, we do not think so. In fact, we think that the accounting industry is facing quite a bright future if, and for those who are able to adapt. This is a big industry. We have pretty much all the companies in our markets. They very much appreciate help from accounting agencies. But having said that, the accounting industry is already going through a major transformation. We're seeing that clearly in Sweden, but also in the markets in which we operate, where a sort of adaptation to the changing world is needed. Much is being automated, and many automated tasks will be done differently, sort of administrative tasks will be done differently in the future. And the progressive accounting agencies will move quite drastically to providing consulting services rather than managing an administration. And Briox simply exists to support in this transition, where we try to contribute with a more effective and more successful collaboration between the accounting agency, their consultants, and their end users, the small and medium-sized enterprises. If we go to the next slide, quickly about the markets. As I mentioned, Briox today operates in 4 markets: in Finland, which is where we have come the farthest, Estonia, Latvia, and Lithuania. And just to pull a comparison, the total size of these markets combined, both in terms of population and the number of companies operating in these markets, is about the same as Sweden, with the only difference being that as a total, the market growth is quite significantly higher than Sweden. We've also chosen to be present in this markets because of the high digital literacy. I would say to some degree, these markets are even more advanced when it comes to using digital services than Sweden, although this is perhaps not the case fully in the accounting industry, but things are happening or changing there quite rapidly also. We have also chosen these markets because the setup in which how you work as a small to medium-sized business owner together with an accounting agency is very similar to Sweden in the model that we know, where about 80% of all companies are linked to in some way to an accounting agency and getting help from there. And also, from a synergy point of view, we have several customers operating in all 4 markets, so there are also synergies to be had in serving customers that operate across the border. So all in all, we feel that these markets together make up a good base for Briox to expand into the future. If we move on to look at our product, it's basically a very powerful software as a service platform that enables a what we believe is a very effective collaboration between, on the one hand, the accounting agency and the accounting consultant, and the small business owner. And the unique thing is that they are able to work in the same system, so not using different systems. So everything is integrated and works seamlessly together. It's just that the different parties do different things in the system. We've also now, after having spent significant development time, we now have a product that is adapted and fit to meet the local needs of the markets. Because it's worth mentioning that there are, although the platform is the same, there are quite significant differences from a legal point of view and also from a needs point of view in its different markets. But the platform we have now has now been adapted to fit the markets where we operate. It's also a module-based product, meaning that both parties can put together the modules that they find suitable just to fit their needs. So all in all, it's a fully cloud-based product, which is more or less ready to go in all our 4 markets. Next slide, please. We are certainly in a scale-up period as a company. And in that light, it's of course critical to have an effective sales model. So what we've done now in the last year is to really clarify how we go to market. And what you see here is basically how we take on all the markets that we work. So of course we are out now knocking a lot of doors and acquiring more agencies. But what's important to highlight is that the moment we sign up an agency, that's when I would say the real work begins, because the typical agency starts quite small, bringing on maybe 1 or 2 consultants who try this system out. Typically an accounting agency works with many different systems. So they try their wings, they get familiar with the system, they perhaps bring in some of their end users and start working in Briox. In this process, it's critical for us to have a very efficient and well-functioning onboarding process where we work very closely with the customers to train the agency consultants, to get them familiar with this way of working so that they feel confident to expand and let more consultants start working this way. And ultimately then having the confidence and the ability to bring in their users. And that's how the model sort of scales up. And once this ecosystem is sort of in place, there is a continuous joint business development process to be had where we develop together and ideally then bring in and introduce more services and provide even more value, both to the agency consultants and then ultimately to their end users. So it's a straightforward sales model with new business acquisition, sophisticated and systematic onboarding, and then continuous upselling along down the line. If we move on and look at slide 11, to summarize our sort of business proposition and where we believe we stand out, needless to say, there are many players in this field, many good players, I would say, but there are in some areas where we think we have an especially strong proposition. First of all, compared to many of the more established players in this field, we are a truly SaaS ERP system, meaning that we are 100% cloud-based. We were born in the cloud. That's where we have our DNA, and that's what we used to. Whereas some of the other players have an on-premises platform and try to transform into a cloud-based service. We also very strongly believe in the power of having an open, free API so that we can quickly integrate with what we believe are value-adding services. Examples of this are banks, which we easily integrate into our system, which is very important both for the accounting agencies and their end users. But it can also be other services such as salary management systems. But the idea is that we fill our system with whatever makes the life easier for the accounting agencies and their interaction with their end users. We also believe, or we know, that we have a very strong product proposition in the markets where we operate. And as I mentioned, these are markets that are highly digitalized. We also have a very scalable go-to-market model, and I'll show you in a second how that scales up in practice. We already now, although we're in a scale-up phase, I believe that we have proof of concept in the sense that we already have a little bit more than 170 accounting agencies signed up already using Briox. And then the interesting piece when it comes to growing and then over time transforming into hopefully a highly profitable business is that we have a product with a very high gross margin so that when we scale up, it quickly turns it into revenue and profit. We also have a subscription model where more than 95% of our revenue is annual recurring revenue. So unless we change clients, it's a very sticky business model. And last but not least, and this is important for the future, once we have the customer base in place, it's a very expandable product offer, meaning that we can easily enter into other services that can where we can extend the product line and build the business on the existing product customer base. Next slide, please. I wanted to show you just a typical example of how we typically enter a new partnership with an accounting agency, and then that scales up. And this is important to understand because it's sort of by definition, especially in this slightly conservative at times industry, it's a process that sometimes takes time, and it needs to take time. But on the other hand, it has a very interesting upside. So typically, as I mentioned, when we enter a new partnership, it's on a tryout basis at first, where 1 or 2 accounting consultants try this out with the blessing of the company, but they get acquainted with the system. They try to adapt this way of working to see how it should work when the accounting agency hopefully scales up. And this consultant will typically bring in a handful of customers where they try this out. So as you can see, the annual revenue with this initial setup is quite limited. But if we move on, after some time, when next slide, please. When the consultant feels confident, typically more consultants are brought on board, and they in turn then add more end users and their customers into the mix. And as you can see, from a very small starting point, quite quickly this starts scaling up. And if we move to the next slide, in a typical case where we have, this could be a slightly bigger than accounting firm, when you have 10 consultants, and each consultant then has 10 clients on board, quite significantly or quite quickly, the revenue keeps growing. And next slide, please. As you can see in this typical case, if you move on, please, to the next slide. If we would have, again, this is a medium-sized agency most likely, in the case where you would have 10 consultants operating in Briox, each consultant has about 20 customers that they serve. They typically have more, but let's assume 20. And as we're seeing, most of these customers or end users typically use them more than one license or module or service. You can see that the initial roughly €1,000 revenue per year is significantly bigger once an agency is fully on board, working in this type of way, in this collaborative way with their end users. As I mentioned, this typically takes time. In some cases, it's a faster process. Sometimes it's a much slower process, but it's important to understand how this model is supposed to scale up. We've come the farthest, as I mentioned, in Finland, whereas in Estonia, Latvia, and Lithuania, our focus primarily is to sign on the agencies and then in the next round, bring on the end users. If we move on, please. I wanted to show you, as I mentioned, the sort of the engine of this business model is going through the accounting agencies. And here you can see quarter on quarter the number of agencies that we have brought on board. And as of now, we stand at a little bit more than 170 agencies that are, to a larger or lesser degree, operating with the Briox system. If we move on, please. I wanted to round off here a little bit, just showing you examples of the partners that we already have on board. And I wanted to mention this more as a proof of concept that although we are at an early stage and really a scale-up phase, it's important that we have managed to establish the trust of these partners. On the integration side, you can see Swedbank, SEB, Holvi, to mention some of the banks that are working with us, that are fully integrated into our system, so that our customers can use seamlessly switching between these systems, so it's integrating the product. We also have already both small and smaller accounting agencies as customers. BDO as an example of one of the bigger ones that operates across several of our markets. But we also have local players like Leinonen and Numeri and other Norian and other agencies starting to work with us. So this gives me strong confidence about that we have something that is of interest in these markets. And if you please move on, I wanted to round off just to frame sort of where we stand at the moment. I think that there are several, I would say, barriers that sort of need to be overcome for a company like Briox when we enter new markets with a slightly new way of operating. I think the first step, and where we come the furthest, is of course to have and be able to offer a platform that is powerful enough that can do the job, and that is something that both the agencies and the end users can work with in their daily job. I think here dare to say that we have we have in place, although we are of course continuously developing our product offer, especially in the Baltics. But this part would come a long way. Secondly, is to bring this offer and actually gain the trust of the potential customers. And here I'm talking as a first step then to the accounting agencies. And with 170 agencies already working with us, I think we have proof of concept in this regard as well. So our big focus now as a company, and what will be the focus in the years to come, is of course to continue signing more accounting agencies, bring on more integration partners, and then together with them, the big focus is then to introduce the end users into the Briox system for our system to fully work and for us to really bring the value to our accounting agencies and their end users. And this is our big focus right now and what we'll be focusing on in the years to come. We currently have about 6,000 end users in the system, and this is a number that I will work hard to bring up in the near, medium, and long future. So with that, I round off. If you move to the next slide, I want to thank you for listening to me, and again, I appreciate you having the interest to follow Briox and hopefully be with us on a very interesting journey in the years. Thank you.
Thank you, Johan. Let's continue this presentation with some brief questions. I'd like to stay on the OPEX topic initially. I know that in recent years you have expanded into several new markets. You mentioned Lithuania, also in Estonia and Latvia, of course. And that has, of course, dragged up your OPEX levels a little bit. How should we think around OPEX going forward? Do you feel like you have a good level at the current state, or could further investments drag up the OPEX even more?
Right. I think it's a very, very good question. And of course, the nature of this business is that you have to invest quite significantly in order to be able to play ball, so to speak. And of course, expanding into new markets and with such a, in a way, slow business model, which we have, that means that you actually drive cost ahead of revenue for some time. It's difficult to say exactly where we'll end up, but I think that we are at a reasonably good level when it comes to OpEx at the moment. We have expanded into these new markets. We have local organizations on the ground. And I think our big focus now is to make our model work in the way I've described today with the resources we have at hand. Having said that, I think we should stay open to accelerating even further as soon as we see our model scaling up. But to answer your question, I think we are at a reasonably good level where we are right now, but we're open to scaling up faster if and when we feel that is the appropriate thing to do.
Perfect. And historically, you've and also as you've gone through the presentation, is that you may primarily focus on the accounting bureaus as you go through it, as they in turn upsell your products to the end customers. So far, this strategy has been successful, I'd say, given the rapid growth you've had in the amount of sold licenses. But how do you actually make sure that the consultancies actually recommend your products to the end consumers?
Exactly. No, I mean, you're asking the right questions. And I think that if you take on a model such as ours, I mean, having the agency signed up is a prerequisite for doing anything, which is why that needs to be a focus. Where I think that, again, I don't have all the history with Briox, but what I want to drive, what I think personally is very important, is that you have to work very closely with the agency to ensure that they understand the concept, that they feel confident to actually invite their customers into this mix. And I'm saying their customers because you could, of course, as a company like ours, have a strategy where you go straight to the end user. Some do. We believe, as I mentioned, that the winning route is to go through the agency, but then that also requires that you work very closely, which is why we're now in the coming year going to focus a lot on being much more systematic when it comes to onboarding the agencies and together with them systematically onboarding and introducing end users. I think this is something that has been done well to some degree and not so well to some degree historically. I personally think that you should be systematic about this, and having a very good product should almost be seen as a hygiene factor. But where I would love to see, where I think Briox can have a very strong competitive advantage further down the line, is to be very good at onboarding and actually working with the agencies to sign them up. And to answer your question, if we do this well, I'm very confident that they will then actively endorse Briox over maybe some other alternatives, because they appreciate the way of working and the service they get as a whole working with us.
Thank you, Johan. Unfortunately, we have run out of time for any further questions, but thank you for attending at our event here today.
Thank you very much.
Good afternoon and welcome everyone. My name is Jesper Birch Jensen and I work as an equity research analyst here at ABG. And with us today we have the founder of Bublar Group, Magnus Granqvist, who's going to tell us a little bit about the company and its plans for the future here. So with that said, please go ahead, Magnus.
Thank you very much. Thanks for having me. Yeah, we founded the Bublar Group in 2015 and we are today 270 employees in 7 cities. Our main office is here in Stockholm, and we're listed at Nasdaq First North Growth Market. We have had a tremendous growth, mainly through acquisitions, and the largest acquisitions we did was Goodbye Kansas. That's in a solid turnaround phase. They were into our bookings from May 1st, and their turnover, the Q1 to Q3, was 190 million crowns. And that's actually a fantastic growth comparing to last year. It's up, the revenues are up 85% corresponding year 2019. And also an EBITDA level around 0 for this period. As I said, they are incorporated into our group from consolidated from May 1st. And we, in the group this period, we show an EBITDA of minus 27 million. And that's mainly because we have not activated the cost for our 2 big game productions. And we also have a seasonally a little bit weaker season in July, August. In Goodbye Kansas and in Wobbling, that other subsidiary, but that's back on positive level for EBITDA in September. So, next slide, please. Our value proposition. As you all know, the world is now fast going digital, and it's going visually digital as well. So what we do in our group is that we combine the cutting-edge technology with content. People expect their experiences in the digital world to be as good as in the physical world and to be more so authentic as ever. And we offer our customers their most treasured visual experience by converging cutting-edge technology with world-class artistry. Next slide, please. Our business and our companies are built upon 3 cornerstones. The world-class artistry, that's our structural capital, the process we have to create digital content, to create characters and creatures. We will see examples of that. The other one is the cutting-edge technology. We will work a lot within the XR, that's augmented and virtual reality, the VFX pipeline, and also the performance capture. The third one is valuable IP creation, and that's also where the magic happens. Here we create the IP software that we use for our services and also IP content rights in games and movies. This is the opportunity for our scalable business, and that will increase starting next year. Next slide, please. Looking into the revenue streams, so far in our group, they are mainly project-based revenues, but we have started to gain revenues out of licensing and recurring revenues and sales of software and solutions. In next year, we will also see the third one when it comes to IP creation, when it comes to in-app revenues, especially from our mobile games and mobile services. Next slide, please. And we have an outstanding customer base. We work with the leading movie, film, streaming, and game companies out there. Everything from Netflix Disney, Warner, and the leading game studios like Epic, behind Fortnite, CD Projekt, Electronic Arts, etc. We also work with several of the leading Swedish export companies that you see on the lower row here. And that's especially when it comes to virtual and augmented reality. And during these first years, they have been very much testing out the new technology, done several like proof of concept to see how we can implement the technology into their organizations. And they're now more and more increase their investment into especially visual experiences when it comes to augmented reality and virtual reality, especially when it comes to virtual simulation, where you have VR goggles and try out different things virtually instead of doing them physically in training and learning, etc. That's very exciting. We will see some videos out of that later on. Next slide, please. The thing is also that we are, our business is based upon a very solid base of rapid growing industries. And these industries within games, movies, XR and streaming services are also converging. The film industry, for example, today when we deliver our solutions there, they produce everything in video game engines like we do when we make our games. The COVID-19 have affected especially the film and movie industry. They have delayed the recordings and so on, and putting actors in the same place and so on. So the film industry now turning more and more into CGI-based content that we build up in computers. And here I would like to emphasize that Goodbye Kansas have done a really nice shift mainly towards the gaming industry. So today around more than 60% of the revenue streams actually comes from the expanding game industry. And we are quite certain that the film industry after COVID here will wrap up. So that will be really good for us. Next one, please. So let us have a closer look on our show reel, starting with the Goodbye Kansas. So next slide, please. And here, once again, please. We see a short reel of 1.5 minutes. So. Thank you. Next slide, please. So everything you saw here was actually built in computers. And one thing that will have a tremendous growth forward is what we call digital humans. That means that we will start to interact with computers in a humanized way and not based on technology. It won't be a technology-focused interaction. It will be more humanized. And a couple of days ago, I read about Gartner that actually predict that 85% of all organizations' interaction with humans will be non-humanized. And a lot of this interaction will be through digital avatars. And what we do within the group is that we work with several companies where we combine our ability to create these digital avatars and combine that with artificial intelligence. So we as humans can have a good interaction in real time with services. Let's see how it can look here. This is an example where we work together with a US-Australian company, Unique. Next slide, please.
Health assistant, and I have been trained to answer your questions about the current COVID-19 virus. Click Let's Chat to speak to me.
Next slide, please. Now we're into the XR technology, that's augmented and virtual reality. And that's a really key focus for our group. We are working closely with we can have next slide, please, with the head-mounted display manufacturers like Oculus and HTC. And we as a group are also merging into building scalable products. We're turning it from an agency group with product-based revenues and go into products. And one of our first projects that we worked hard with in 2020 is our VR Firefighter. We are right now building an international sales network of these products, and we already received our first order. So that's really showing promising way. We can have a next slide. We will see a video of how the VR Firefighter works, where we combine our software together with hardware products. In this case, organizations can train in firefighting. Just an example, it's just the first product in a line of a product portfolio that we're creating. Please go on with the video. Thanks.
Fire is dangerous. Everybody knows it, and we don't want to put people in danger if we don't need to. The firefighting simulator is really great for it. In VR, we can come really close to a realistic situation. It can be like a hotel room or an office space or a warehouse. That doesn't really matter. It matches the real thing. It's more cost-effective and sustainable.
We use Fusion 360 to CAD up the parts. After that, we 3D print them and test them out on the actual fire extinguisher. We have 2 track parts, so it's one on the handle and one on the nozzle. Before we used Vive trackers for our first prototype of the fire extinguisher. We're now moving over to the Oculus Quest to get a more portable fire extinguisher. Just like in a real-world scenario, you have to pull out the pin, you have to aim the nozzle and then press down on the handle to get the virtual fire extinguished.
Basically, we can take any mesh and we put it through a voxelized system. With that, we can really create a realistic fire spreading. So when the node is put on fire, it lights up its own flames with their own particle system that connects to a smoke system that starts to smoke fill the entire room. We've had people like bending down to avoid the smoke and trying to wave it away from the face just to be able to breathe.
Thank you. During COVID-19, we also see a massive boom in the retail industry. And here is our other product. It's a SaaS-based product that enables retailers to actually show their products in 3D. Instead of having a 2D screen, as we're used to when we're browsing products on different internet sites, we actually have the software that can take this product and people can try them out in their own homes or on their bodies with virtual try-ons. And with this service, we offer the retailers a possibility to use the technology for like $99 to $299 a month. So let's have a look at how that software works. Please go on.
I'm Jordan, one of the co-founders of Pure Cycles, and I manage the direct-to-consumer business and the e-commerce business. We like to be on the cutting edge, and we like to be experimental. And here in AR, I was like, oh, look at this. Your brain starts to think that you're looking at the product. And you can get really close into it and see, great detail about it. Creating the model was super easy. We already take photos of all of our bikes, so we uploaded those to the marketplace, and within a couple of days and one revision or two, it looked exactly like our bike. And then it was seamless. It just popped right into our store. I think it's much easier to see the frame in AR and walk around it and see the geometry. But if you can see it in your apartment or see it in your living room, it feels more real. Between 50 and 60% of our visits are mobile. Of that, 60-70% of that's Safari. And it's enabling all those customers to see our products in AR without having to do anything. And AR is a better experience. It's not something you can get in a series of photos online. And so we obviously want to offer that to our customers.
Thank you. Next slide. Yeah, thank you. It's and especially with this software, we actually work with Shopify, which is a leading e-commerce platform. We have noticed we have a little bit slow speed up when it comes to expanding on this SaaS software, and that's mainly because the retailers and the product owners, they don't have 3D objects actually of their products. So that's why we focus on in our Manila office to actually be a 3D factory of reproducing these assets into products that can be shown through the software. So that's an evolution that will really start this upcoming years. So now we go into Virtual Brains. Next slide, please. And in Virtual Brains, we have two prominent platforms. Next slide, please. There we go. We have two technology platforms in the bottom here, and we work with leading IPs to create new services with a really scalable business model. On the right side, you see the movie-making platform that's out of the acquisition we did of Plotagon last week. We'll come back to that one. On the left side, we use our real-world games platform. That's the one we use to create outstanding games, 3D-based, map-based games. And we have today Otherworld Heroes that's in soft launch still. And we work on the details for that one. And the other one is, of course, Hello Kitty, as you are well aware of. We can have the next slide, please. And we have big promises for the Hello Kitty launch this summer. As you all know, it's one of the absolute biggest brands, media brands in the world. It's actually the second highest grossing media franchise out there. So that shows that there's a lot of consumers out there that would like to have an outstanding game product. And we have one of the few platforms actually to deliver that kind of service. So we have in our Virtual Brains studio, we have full speed ahead on our two productions. So we can take next slide, please. I would like to talk a little bit more about last week acquisition of this is exciting company, Plotagon. We did this acquisition mainly because of they have an outstanding and very proven, several years proven platform that make it possible for users actually to create their own animated videos in minutes. And for those who know the software, they can do it in seconds. And Plotagon just recently went into partnership with one of the leading global avatar networks, the Korean Sepeto, that's owned by Naver. And we are jointly, we can have next slide, please. We are now in production of a joint app where we will, from Bublar and Plotagon side, we will run the app and Sepeto and Naver will do the marketing for it. So it will be mainly towards the existing 180 million registered users in the Sepeto world, and also through Naver and Sepeto's social channels out on Facebook, Instagram, TikTok, etc. Sepeto's users today, they are mainly based in Korea and Japan and Southeast Asia and China, where the app goes under the name SciSci, and US and Russia, UK and Germany and so on. The company is, the Naver is a big Korean tech conglomerate, partly owned by SoftBank and Sequoia. And what we also think is interesting here is that we also get a good partnership when it comes to rolling out the Hello Kitty game later on this summer. We also think it's interesting because in just a couple of weeks ago, the biggest band around the world in music industry is from Korea, both in K-pop and K-drama. Big Hit Entertainment, for example, went in as owners of Sepeto. And Big Hit Entertainment actually did Korea's largest listing. They went IPO this October, and it was the biggest IPO in 3 years in Korea. So of course, there's a lot of consumers out there that we potentially can attract with this new movie-making platform. So that's a really important cooperation for us. We can have a look at how the Sepeto network works like. It's an avatar-based network where you actually create the avatar through your cell phone, and you enter and meet other people into the network. You can play games and so on in the network. So please run the video. Thank you. Then we have the last slide. As you see, it's all about virtual worlds. It's about avatar. It's about computer-generated experiences. And that's exactly where we are in Bublar Group. Our main focus now is secure the ongoing turnaround for Goodbye Kansas. We also gonna next year take this exciting products with a good go-to-market approach next summer. That comes both to the Sepeto app and also the Hello Kitty, and also running out Otherworld Heroes. We will also leverage on our expanding customer base. We work with some of the biggest company here, and we have just scratched the surface when it comes to delivering of our services. So we can easily just stay inside that client network and expand rapidly. So that's also key focus for us. When we have secured these things, we will later on then grow in other markets and in other areas. But right now, that's the main focus. So that was it. Thank you very much.
Thank you, Magnus. We're actually running out of time here a little bit, so I'd like to thank you for coming here and telling us more about Bublar and your exciting plans for the future.
Thank you.
Thank you.
Hello everyone, and welcome to this presentation with Strongpoint. My name is Øystein Lodgaard, and I'm one of the analysts that follow the company here at ABG. Now I would like to give a warm welcome to Jakob Tverbakk, which is the CEO at Strongpoint. The floor is yours.
Thank you so much, Øystein, and thank you for giving me this opportunity to talk about Strongpoint at this Introduce Day. So today I want to go through a very short intro and then give you all a little bit of a glimpse of what Strongpoint really is about. And then in good orders, you are probably also somewhat interested in the financial figures. I will be sharing the latest financial figures that were published regarding the Q3 this year. First and foremost, I should say that Strongpoint, we are a retail technology company. That is first and foremost what we are. And for those of you that have been following Strongpoint, you will, when you see this presentation, you will already now notice that both the color scheme and logo of Strongpoint is somewhat changed. And that is to reflect what we really are. We are providing retail technology in every shopping experience for a smarter and better life. And we're doing that both in store, but also online. On the next slide, I'll be talking about what we have named the double opportunity for Strongpoint. So this was even pre-COVID-19, we were talking about the double opportunity. With COVID-19, we just see this opportunity being accelerated. And the opportunity itself stems from a general growth in e-commerce in retail and in grocery retail particularly, where we are focusing our efforts. And if you just think about sort of the growth in e-commerce, again, both pre-COVID-19, but in particular with COVID-19, the emergence and growth of e-commerce is causing a margin pressure on the in-store operations. So basically you're taking sales away from the stores, putting it online, and you're not able to compensate 100% for the loss of or windfall of sales, and as such you end up with a margin pressure. That's where Strongpoint's solutions in store come into play to make the store more efficient. The second opportunity is e-commerce in and of itself. If you haven't already, as a grocery retailer, moved online pre-COVID-19, you for certain have started or are very close to be starting your e-commerce efforts. And Strongpoint have all the solutions needed from an order comes in to picking and delivery to make that happen. And not just to make that happen, but we have world-class solutions to make that happen. I wanted to, on the next 2 pages, give you a very short glimpse of what are the solutions that we actually do have. So starting with in-store, we have solutions ranging from self-checkout solutions where we provide both hardware and software. We are a proud distributor of Pricer electronic shelf labels, where we have contributed to, in particular Norway, but also Sweden being one of the highest penetrated countries of ESLs in the world. We are also growing that in the Baltics and emerging so in Spain. We have the VenSafe solution, which is a solution to protect high-value items, typically cigarettes, snus, in the store. We're also a proud distributor and leader of Reflexis's workforce and task force solutions in the Nordics. And many of you will also have known the cash management solutions that we have installed at many grocery stores in Norway and Sweden, but not least cash being king still, even with COVID-19, in southern parts of Europe. That is an area where we see cash management solutions being in demand. Our e-commerce solutions are also integrated with the stores, and here we're just showing that with our picking solution and click and collect lockers. So we have a number of our grocery retail customers doing the picking of e-commerce orders in the store, and also delivering that to click and collect lockers at the store. But more specifically on e-commerce, on the next page, we're basically showing how we're serving the full value chain. So from an order has been received from a customer shop, we have the solution to do the picking either in store or in dark stores. We have the solutions to make sure that we get the deliveries home, if that's the case, or in a drive-through and click and collect solutions. And throughout the order process, we're ensuring that both staff internally are getting the necessary communication and messages, and likewise with customers. And more so, we're growing increasingly in, I should say, confidence about the solution that we have. If I'm for a second may just pick on our picking solution, we're seeing that our solution, where we are achieving with existing customers in the top quartile 240 items or more per man-hour being picked, we're seeing that is sort of a 3, 4, if not 5 times the picking frequency you'd see in a default US or UK environment. So very proud of that. I think then on the next page, just wanted to again emphasize that we are a retail technology company that have been around for quite some time. All the major grocery retail customers in Norway, Sweden, and the Baltics are customers of ours with one or more solutions. And in here you will also see 1 or 2 Spanish customers where we are increasing our presence. I believe on the next page we'll have also a little bit of the highlights of Q3. So to give you a little bit of flavor of what sort of sizes are we looking at. I'll go through each of these 3 highlight areas. First and foremost, the financial performance in retail technology and overall for Strongpoint as a company. I'll be sharing some of the customer successes we've had. And lastly, I will also touch upon the progress on the way to the 2025 strategic ambitions that we shared some 9 or is it 10 months ago now, earlier this year. So Q3, we achieved a top-line growth of 19% when you compare with the same quarter last year. Of course, 19% is what we would label as strong. That is in a situation where we're growing our business in most areas and most countries, but is actually absorbing also a decline or retraction in our Spanish operations, where we historically have had cash management solutions being sold to the Horeca and hospitality segment. And as you would all know, that's not a segment with a lot of traction right now. So which just makes the 19% growth even a better and stronger performance. Moving on to the next slide, I wanted to share with you how this splits out throughout the different business areas. And again, we are a retail technology company. We happen to have a cash security and labels division in addition to that, but we're primarily a retail technology company. And as you'd see from the figures, 80% or so of the revenue stems from retail technology. The growth in Q3 was to a large extent driven by cash security in relative terms, just because there is a lot of fluctuation in that business. But if you look at the absolute figures, you'd see that most of the growth comes in retail technology. I'm also very proud that this is the area or country or area in which Spain is lying, which means that the growth in the other markets have been substantial or very substantial. Actually, in Norway and Sweden. In this quarter alone, we've seen about 40% top line growth, so 40% growth. Moving on to the EBIT, I'm sorry, that's the right as well. The relative share of revenue follows what you'd expect. Our e-commerce business have been growing from last year 5% of top line growth to a double, close to or in the range of 10%, and we're expecting that to continue growing. And as you also see on this slide of relative share, the payment solutions have been in decline. So overall, as Strongpoint, we have a very balanced portfolio coming from a history many years ago where Strongpoint was more known as PSI or cash management solution. So today we are a much more balanced portfolio, and we are really in the areas in which we are seeing a lot of growth. Then moving on to the profitability, as we're saying, we want the profitability to tag along with revenue, and it does so, and more than just that. In Q3, we had a close to doubling of the EBITDA for the company as a whole, so 35 million kroner EBITDA. Again, if you go to the segments, you will see that on the next page, you will see that there is a lot of improvement in the cash security, as that is getting up to a critical level of activities. But you will also, of course, notice that the retail technology EBITDA is at 29 million kroner, or close to record high numbers historically. And this is really where we want to be. This is a EBITDA margin of north of 13%. We have earlier presented in the strategy 2025 ambitions that we want to have a group-wide turnover of 2.5 billion driven by organic growth, and that we are bound to have a profitability levels of 13 to 15% EBITDA. So with retail technology achieving 13% or more in this quarter, I'm very pleased and proud about that type of performance. So those were some of the financial figures I wanted to share. Other highlights that are important for you as investors to know about is, well, first and foremost, in Q3, and that will also be the case for Q4, we are delivering on a order of ESL for NorgesGruppen, one of the largest grocery retail company in Norway. Some of you commented on that being a surprise, but for us as Strongpoint, being a solid and long-standing supplier to a company like NorgesGruppen, this comes not really as a surprise. This is the result of high-quality deliveries year over year, but not least very pleased to be able to attract that order and deliver on that. On the second point, I have click and collect deliveries. And as you'd expect with COVID-19, we have been delivering lots of click and collect lockers, both stationary, which is the primary type of click and collect lockers we have, but also mobile lockers, which you see on the right-hand side here. So we have several proof of concept with, I should say, leading grocery retail companies around the world, and hopefully this will also develop into pilots and rollouts. So very pleased about that, and looking forward to be able to present something for you in not too long. Likewise, on our picking solution, we have a continued very strong demand for our picking solution. And as I said initially, we are feeling more and more confident about the performance abilities of our solution. Having both benchmark versus competing solutions, but also speaking with grocery retail clients, and we're talking leading grocery retail clients or companies in the world, we feel more and more confident that we have really a diamond in the making when it comes to our picking solution. So again, lots of exciting demand, and looking forward to be able to present something here for you that also solidifies this with customer cases. Lastly, if you may move on to the next page, I wanted to give a little bit of a touch base on the strategic ambitions we set. So the strategic ambitions, again, for Strongpoint, 2.5 billion organic growth and 13 to 15% EBITDA margin. We have proven now, I believe, with both Norway and Sweden and the Baltics, that we have operational leverage. We are able to take on new solutions, but also new orders, and being able to produce very nice bottom line with that. We're still in the making of seeing this being the case in Spain, but have ambitions and plans still to grow the Spanish operations to similar sizes as we have in these other countries. Also important in the strategy 2025 is delivering on the supporting elements. So we are, I like to say, only a 1 billion kroner company, but we have had to do a number of recruitments in sales and marketing to make sure that our solutions are being known out in the market. And we are also implementing a Salesforce CRM system that will be live and kicking in Q1, or actually in January. And that is going to be more and more important for us, that we operate as one company, being able to link the marketing efforts that we're doing with the sales efforts, and ensuring that we get a lot of success with the solutions we have in our arsenal. Then lastly, this was from Q3, so this was the proposed dividend. The dividend was approved by the General Assembly and follows the policy from the board of having a growing dividends over the years. So this year we delayed the decision as the General Assembly was bound for April in the midst of the Corona pandemic. We had the GM on October, and they paid out a 60 øre or 0.6 kroner dividends this year in November. So rounding off from my end, on the last page, we have over the course of the year, as the pandemic has evolved, reiterated the 2025 ambitions. We will be achieving 2.5 billion NOK revenue through organic growth, and we do have a EBITDA margin objective of 13 to 15%, and as said earlier, we have proven that that is absolutely possible in the retail technology area, which is the focus for Strongpoint both now and going forward. So with that, I'd like to thank you all for your attention, and Øystein, I understand you might have some questions.
Yes, thank you, Jakob, for a very interesting presentation. To start off, you mentioned, of course, you had delivered some of your click and collect lockers. Do you see that as COVID has accelerated the shift to online grocery shopping, do you see that this in general has increased the demand for your e-commerce solutions?
Absolutely. I think it's without the question of the doubt that e-commerce is growing very rapidly in the grocery retail space. For those companies that were customers of ours on e-commerce solutions before COVID-19, we saw an acceleration in the deployment of our e-commerce solutions. And for players or companies that were about to start, they have started. And then we have many more to get started on e-commerce solutions. I think all grocery retailers that in the past have been reluctant, and maybe rightfully so, to go into e-commerce because of historic profitability question marks, are now seeing that there is no way you can be running a grocery retail chain without having a e-commerce offering. So I feel very confident about the e-commerce growth going forward as well.
Exciting. And I also know that you're working on a software version of your e-commerce logistics suites that I think that you're going to launch from 2021. Do you think that this could be an important growth driver for you?
Absolutely. So historically, we've, not to make this into a history lesson, but we acquired a company in Sweden back in 2018 called Cube. We have invested heavily into that solution, and correctly so. This is the third generation being launched early 2021, which is a fully cloud-based solution. So we are very excited about getting that out in the market and starting to get the customers onto that solution.
I think. And you mentioned that you're currently delivering a big ESL order to NorgesGruppen. Should we expect that it could maybe become more orders from NorgesGruppen from 2021 and onwards?
I wouldn't want to single out specific customers, but we have long-standing relationships with all the grocery retailers in Norway, Sweden, and the Baltics, and we also have a very strong and good relationship with Pricer. So one thing being that the Pricer ESLs are superior to its competitors, but we also believe that we have the cloud credibility and history with the customers to ensure that the solutions are being deployed correctly. And it should also be said in that aspect that there are also links between the ESLs and our e-commerce offering. I've mentioned on the earlier occasion the ability to do what we call pick by light, so meaning you would be facilitating or helping the pickers do the correct picking at a faster rate when you integrate the picking solution that we have with the Pricer ESL. So very confident about that, also supporting a continued growth in general in ESL.
And M&A is also a part of your strategy. Could you give some flavor on what type of companies that you may would like to acquire?
Yeah, so I just want to make it absolutely clear that the financial ambitions that we've set are organic growth. But you're right, we have M&A activities to further grow beyond that. What we are seeing now during the pandemic is that there are a couple of geographies which are emerging as having a very good product market fit to Strongpoint's offering. So without going into too much detail on exactly which country those are, there are 3 or 4 countries where we're seeing the very nice demand for e-commerce offerings, for self-checkout offerings, for Vensafe as well. And when we believe that we have a sufficiently big product market fit, it might also make sense for us to not just hand over the business to partners, but also take part of the business opportunities arising there.
And can you also say a bit about what types of new products that you may want to add to your portfolio going forward?
So we are going to continue growing and developing the solutions we have. First and foremost, that is within e-commerce. We have a solution ourselves. We're also in a number of dialogues with, for instance, MFC players or micro fulfillment center players, which could be relevant in the cases where you want to have express deliveries and you also have sufficiently high demand, as an example. So integrating our solutions with those types of solutions will be important. Beyond that, this will be continuing to develop our self-checkout solutions. And then it's self-checkout solutions along with other types of self-checkout solutions to make it even more relevant in the climate we are in. We're looking at, for instance, total contactless self-checkouts. We're talking about self-scan solutions as well. And again, we're in a number of discussions with smart trolley providers as well, where we could see our solution being integrated. So e-commerce solutions and self-scan and check efficient checkout solutions are clearly areas in which we want to continue growing.
Okay, thank you very much, Jakob, for taking the time to present to us here today. I think it's going to be very exciting to follow Strongpoint in the years to come. And thank you to everyone who listened in. I wish you all a great day.
Thank you.
Hey, and welcome to this next presentation here at ABG Sundal Collier Investor Days. My name is Simon Granat and I will be moderating this presentation, and I work as an equity analyst covering IT and tech companies at ABG. With us today, we have the pleasure of welcoming Anders Wetje, who is the CFO of Avensia. And with that said, please, Anders, go ahead and present the company.
Thank you, Simon, so much. And hello, everyone. I obviously wished that this presentation could have taken place live, but I guess we, for the time being, need to go with these digital kind of solutions, and it's better than nothing, obviously. Please take the next slide. As Simon already said, my name is Anders Wetje. I work as a CFO for Avensia. I have quite a long history actually with the company. I was a board member of this company for 15 years before I made kind of a reverse career move, I guess, and joined as a CFO. And I'm also one of the major shareholders of Avensia. Next slide, please. A brief introduction to who we are. The company was actually founded back in 1998. We did something completely different back then, and I say we. I was not involved at the stage. The company did something completely different. It was founded in Lund. We have our headquarters in Lund, and we are publicly listed and traded on Nasdaq First North Premier market. We are in number of employees slash staff, a bit more than 300 modern commerce experts working for Avensia today. And as that indicates, our focus today is 100% on modern commerce. And what is it that we actually do? Well, we do everything from trend spotting and strategic advice to systems implementation and daily operational support. There is actually a bit of a debate ongoing internally in the company today if we are a modern commerce company that is very good on technology, or if we are a technology company that is very informed about modern commerce. And I think I would go for the former definition if I would put a label on our company today. We work with brands, business to business and business to consumer clients, and our customers do digital business in more than 150 countries around the globe. Next slide, please. Our vision is a very bold one, I would say, a very daring one. It's been crafted and worked at and agreed on just 6, 7, 8 months ago, and that is that Avensia should be a global driver of modern commerce. And when we talk about modern commerce, we often talk about our customers' customers. And I guess that could be all of us in this audience today. How we as consumers behave in different market places, in different market channels when we consume things. And when I say consume things, that could be everything from buying something physically to actually accessing a service. So it is how we as individuals, how our behavior is changing over time when it comes to consumption. So that is, in short, I would say, the definition of modern commerce. And we want to be a driving force in defining the future in this area. Next slide, please. We have a global footprint. As mentioned already, our headquarters, they are in Lund. We have other Swedish offices in Helsingborg, Malmö, Stockholm and Umeå. We have a strong market presence in Norway and an office in Oslo. We have a tiny office, I would say, in London. We have the same in Chicago. Both of them are more or less sales offices. And then we have a development center in the Philippines, in a town named Cebu, where we are at presently, I think we are 40 to 50 staff and growing out in the Philippines, where it's possible to find highly qualified staff for very suitable for what we do. Next slide, please. And here you can see some of our clients, customers, and I think that many of you recognize most of the logos and most of these companies and brands. Yeah, it's a lot of business to consumer. We have a bit of business to business as well. Ahlsell and Exsitec, which is a fairly new client of ours. IKEA is there. Saint-Gobain, we do a lot of big data handling for them. But it's been, I would say, historically quite a heavy focus on business to consumer. Next slide, I think, shows some of the sites that we just recently launched. We have been involved in a major project for NK over the last, I think it's at least 2 years now, and the site was launched not long ago. And as many of you probably know, NK is a fairly complex animal. There is a property owned by Huvudstaden, and inside of NK you have, I don't know how many different stores, and they are all separate from each other. So it's been an extremely complex task to put together an e-commerce site that works smoothly for NK, but it's been a great project, I must say. We have Indiska, which is a very interesting client of ours, now in new ownership, family ownership, and driven by really ambitious entrepreneurs, and I would say with strong financial backing, and we believe very strongly in Indiska's future, and we hope that we can contribute to their future. Other sites, Kovab and Skin City. Please take a look. We are very proud of these sites, and they often generate real substantial change in the top line, and hence the overall P&L numbers for the people and the clients we work with. Next slide, please. We are in I would say basically we are a consultancy company. We are, you know, often dreaming of that we would be something else, software firm and you know, subscription models and every all the good stuff that comes with that in terms of margins and valuations, etc. Deep down, we are a consultancy business. However, we have a very strong recurring component in our business, in the sense that the clients and the companies and people that do become clients of ours, they tend to one, stay for a very long period of time, and two, they also tend to increase their business with us over time. A typical kind of interaction between Avensia and the client of ours is that we start out with giving them some strategic advice. Giving strategic advice means that we are often being introduced and interacting with the top management of whatever company it might be. And that often opens up and kind of broadens our scope in what we do and how we service these companies and these clients over time. So you can see the blue here is existing customers, and we define existing customers by saying that that's a customer that we sometime during the last year sent an invoice to. So all the companies that we had sent an invoice to at the latest December 31, 2018, they are the blue column in 2019, and you can see that there is a bit of growth in there. And I could say that roughly over the years, our split in revenue has been 80-20, something like that, on existing customers and new customers. So what I want to say with this slide is that we are a consultancy company. We shouldn't fool ourselves with trying to bring across a different message, but we have a strong recurring component in our revenue stream. Next slide, please. Well, I guess it's impossible to do a presentation without mentioning COVID-19 and Corona. And so I will do that, I think, in the next 2 slides. I mean, obviously, we, as most other companies, have been affected by the pandemic. And obviously, our first priority has been a focus on health and safety for all our employees and our partners and clients and what have you. And it hasn't affected us very much because we are very used to work in a distributed manner. We are spread out in many different offices. Our teams that are put together to deliver value and solutions to our clients, they often sit in different geographical locations. So remote working conditions have not really meant a big change for us. A change that is, I think, evident for everyone is that the corona pandemic accelerates the digitalization of retail. I'm coming back to that a little bit in the next slide. We have been negatively impacted this year. As a short-term effect, basically our business, I shouldn't say came to a standstill because it didn't, but our business it thrives when we have ever ongoing discussions with our clients, discussing the next step in refining the solutions that we already developed for them, discussing with new clients about new projects, meaning that the clients need to take investment decisions for the future, etc., etc. All that came to a complete freeze middle of March. And we went through a period of a couple of weeks until some of the clients put their heads back up and said that, okay, it doesn't seem that the world will end this time either. So, and slowly then returning back to business. But it's quite evident that 2020 will be a very kind of odd year for us. However, that we also see that the corona pandemic is bringing around opportunities if we look a bit longer into the future, obviously, as we are so active within digitalization. And we are not part of the problem, obviously, for retailers, business to business, clients, whatever. We can, however, be a significant part of the solution for many of the challenges that people are facing out there in the market presently. The next slide. I will not go into this in any kind of detail. I will just conclude by saying, and I think that most of you have read different articles, different statements, different XYZ over the last 6-9 months. And all of them basically are saying that all these trends that have been seen in retail and in business over the last 1, 2, 3, 4, 5 years, they are now accelerating, and some of them are accelerating quite dramatically. It's becoming even more evident for businesses that if they don't have a proper digital plan, whatever that digital plan might entail, they might face big problems. Often it's a question about securing survival longer term in a completely and very rapidly changing marketplace. Something that is not mentioned here, but maybe should have been mentioned, and that's obviously not directly linked to COVID-19, but now Amazon has entered the Swedish marketplace. And obviously we are working very actively with many of our clients to kind of adjust to a future where Amazon will be around. Because I don't think that we should be naive and say that, well, they had a bad start in Sweden. I think some of you might have read those articles where they had some translations that went wrong, etc., etc. But this is Amazon, and we have the greatest of respect for them. And we also see that many times that they can be actually one of many sales channels that our clients use. So we are guiding, we are advising, we are assisting, we are rebuilding technical setups for many of our clients to actually adjust, and where many of them will use Amazon as one sales channel in preparation for a different and very, very much more digital future than what we have today. And all of these, accelerating trends obviously is something that I shouldn't say speaks for us, but we like what we see when we at the same time take a look at, okay, where do we have our skill sets, what is it that we can assist our clients with, etc., etc. I think that we have a very interesting strategic positioning going forward. The next slide, please. Some key financials for first through third quarter of this year. I mentioned that we have been affected by COVID, and we had a top line, or we have had a top line growth of 6% for the first 9 months of this year, and that is a much lower number than what we as a company have experienced historically. You can see that our operating profit has been cut in half. Last year we managed to produce 17 million in operating profit. This year it's 8.5. And the one and only, I would say, explanatory factor is that we have increased our headcount. I mentioned before that we are 300 plus modern commerce employees working in Avensia. We actually have 275 on our payroll, and then we have roughly 10% that work as consultants for Avensia. And one interesting thing that did happen when Corona struck back in March is that all of a sudden the recruiting window for talented people opened up, and we in the management team and we had a brief look around in our meeting room and said that what should we do? And we said that we should recruit. Things will come around again. Now is the opportunity to bring people on board. Recruiting talented people, talented individuals is by far the biggest bottleneck we are facing when we are trying to grow our business. So we have taken on board a lot of people this year. We are very happy to have done so, but obviously it has had a negative short-term effect on our margins. We have held it together when it comes to cash flow. Looks like a completely dramatic, insane increase of 300%. But it should be seen, of course, against the background that the base number 3.8 is not a very big number. But we are keeping our arms around our dear cash flow and preserving cash in, I would say, in a good way. When our Q4 and full year numbers were presented back in February for 2019, our board proposed to the shareholders that there should be a dividend of 0.28 Swedish krona paid for 2019. That was then withdrawn, or maybe I should say postponed, when Corona came. But the board just recently took a decision actually to summon the shareholders mid-December, and hopefully the shareholders will decide to execute the dividend, which I think is another testimony that we are fairly confident about where we are and where we are going, although that 2020 will clearly be, so to say, a little bit of a middle year for us in terms of growth and profit. Next slide, please. This is our share, our stock. I think it went down the last couple of days. I think it was 16.5, something like that today. And I think that we are compared to the all share index. I think that this year we are basically in line with the all share index. We have had a tremendous development at Avensia in terms of our share price over the years, but obviously share prices, they go up and down. We hope for a positive development going forward, but that obviously remains to be seen in terms of how we perform. Next slide, I think, should be the last one. We are running out of time. The future for us, we see a continued volatile but significant and increasing global opportunity when we look ahead. I talked about these trends, that acceleration and growth post-corona, so that we hope to be part of a strongly growing market going forward. We have reorganized ourselves a little bit to increase our customer focus and increase our efficiency. I talked already about attracting and retaining key talent, which is basically the one, if I would pull one deciding factor out of the hat, that I can't underline the importance of recruiting key talent. And it's very, very difficult within this field to find qualified individuals. Actually, the competition for these individuals in the marketplace is very fierce. We also focus a lot on IP and products. I talked about Avensia being a consultancy business. Yes, we are. However, we do sit and we do deal with a lot of intellectual property, things that could be, considered to be products. We do, bill our clients a bit of licensing revenue in different areas. I think there is a lot of potential for us to try to get our arms around that area much more than is the case today. I think that was it, Simon. I think I'm through. I'm sorry I used 3 too many minutes.
I think it's perfectly fine, Anders. Let's do just a quick 2 questions because we have some minutes remaining on this session. So initially, I'd like to stay on the net recruitment topic. Obviously, you have kept your net recruitment rate at a very high rate throughout 2020. Has this been challenging to do? I mean, given that it might be a hard cultural fit initially, as people have mainly been working from remote, and also how should we think around the net recruitment rate going forward, given the recently high rate?
No, I think it hasn't been very difficult. I think that we are starting to have a good name in the market. A lot of people who are, kind of working in this area are keen to come and work with us, or I should rather say that they know who we are when we contact them. I shouldn't sit here and brag and say that everyone comes and wants to work for Avensia. That's not the case, but we are known in the marketplace. We have a good name in the marketplace. And as I mentioned, it was kind of a window, like opening a window in mid-March, from extremely difficult to, there were abilities in every corner. And I can say, and I don't know if that's an indication of where, the world economy is heading again, the window has I shouldn't say it's closed completely again, but the climate in the recruitment market has changed quite dramatically over the last 4 to 6 weeks in a way that's a bit amazing, a bit astonishing. So right now, we are back to where we were before, where we need to work harder to continue to recruit.
Very interesting. Let's continue just with a couple of questions on the Storefront family. What is the current status there? We don't need to speak that much about numbers, but is it a growing part of your business? Does it progress according to your own plan? Some comments around the Storefront family would be helpful.
Sorry, I would say that it distinguishes us in many cases when we go out and approach clients. I think that's, for us to build kind of a product business on Storefront standalone, going forward and looking into the future, I'm not sure that will happen. But it gives us tremendous leverage in the marketplace when we are out speaking to clients. Because it gives us a much broader offering when we go out and speak to people. And that is a great help in many places. But, an off-the-shelf product that will sell in tens of thousands of licenses going forward. I wish that was the case, obviously, as a shareholder of Avensia, but I don't really see that happening, Simon.
Okay, thank you, Anders. Unfortunately, we have now run out of time, but I'd like to send you a big thank you for attending today. And with that said, I wish you a great rest of the day.
Thank you so much, guys. Goodbye.
Hi everyone, my name is Daniel Torsson, Equity Research Analyst at ABG Sundal Collier, covering the IT and tech sector. And for this presentation, we have BTS Group and the CEO Henrik Ekelund. Henrik is going to present the company for some 15 to 20 minutes, and then I will follow up with a 5-minute Q&A session in the end of the presentation. So I leave the stage for Henrik and his presentation, and I will disappear during the presentation. So go ahead, Henrik.
Thank you, Daniel, and thank you everyone for listening in. For those of you who only have 1 minute, I'll give you the summary. BTS, we're a totally global business spread all over the world in a miniature format with just under 2 billion SEK in revenues and with a long track record of profitable growth since we came to the market. And with quite a unique technology-based concept. That's the 1 minute summary. And to tell you a bit more, if we look at, go over to the next slide, our vision is to be the global leader in strategy execution. And what does that mean? So we work for the top 2,000 companies in the world. And we help them once they have a new strategy, a new initiative. We help them to train their people and to align their people so the strategy actually happens. And as we all know, it is tougher to implement a strategy than to design it. And that's what we're focused on and where we are a leader. And we have about 850 professionals around the world. And in 2019, 1.8 billion SEK in revenue. Now, looking at the next slide, you can see that we have a global footprint of over 30 offices around the world. Roughly half of our business is in the United States, about a quarter in Europe, and a quarter outside Europe. Now, looking at the next slide, at the market drivers, you can say that the more change there is in the marketplace, the more opportunities for BTS. And there are a lot of change drivers currently in terms of the changing technology, the change in behavior of consumers, the change in society values, regulations. There's so many changes. And the more change, the more business opportunities for us. Because when companies set new initiatives and new strategies, that is when they need our services. Now, looking at the next slide, you can see some of our customers. And as you can see, we work with clients among the biggest 500,000, 2,000 in the world. And what is pretty special is that our average lifespan with the customer is 7 years. So our churn is quite long and the customer loyalty is very high. Now, what do we do for these customers? Let me show you then 2 cases very quickly. The first case is a large European gas utility company. And they came to us and they said they had made research in their market. And the conclusion was that their customers disliked them a lot. It wasn't that they were just okay. No, they were heavily disliked. And they decided to get on a journey to become loved by their customers and also realized that this was not only a question about marketing. It was a question about the whole culture in the company that influenced how the solutions they offered, the pricing they offered, the service they gave, and so on. So they realized this is an internal issue. We have to work with this internally. And this is a big company. They had 2,700 managers. And we took all those 2,700 managers through a customized learning experiences, showing them what is customer centricity? What is it to truly care about your customers? And what does it mean for your business? It was a customized, very advanced learning journey involving simulations. And as you can see, both the customer and employee NPS grew a lot. The next case on the next slide is a globally leading industrial company. And they had a new CEO that we knew since before we had worked with him. And he came there and he concluded that the products were fantastic, but the profitability was too low. And the understanding of profitability was also too low. So he hired us to train many of his top leaders to really understand how to increase profit in the operation. And the results, again, profit has improved and the share price has climbed. And we have hundreds of these cases. And in fact, when you try to improve a company, like all our clients are trying to improve all the time, the most critical factor is the mindsets, the capabilities of their people. And that is what we help them with. The next slide tells you a little bit. You probably understood that we are, to some extent, a professional services company. We have consultants, we have trainers, but I want to point out that this is not a pure service business. We're a combination of service and product. We have a lot of products in terms of simulations, in terms of contents, in terms of special industry applications that we are reusing. So our clients are not only buying us, like a pure consultancy, they're buying us and our service, our consultants and our services. Now looking at the next slide, so BTS, 18 years since we came to the stock exchange. I've been the CEO all the time. Even before the IPO, I was the founder and the CEO. And as you can see, the revenues have grown a lot and profit a lot. In fact, the dividend that we gave last year and that the board has proposed again for this current year is 18 times higher than when we came to the stock market, and the stock price is roughly 11 times higher. So it's been a good run. We've grown revenues 14% per year accumulated, and profit measured in EBITDA 18%. So it's a long-term profitable growth. And let me stop there and talk about 2020, because 2020 is a totally different story. It's been a year with totally different numbers, but we have a very positive outlook for the future. Let me share, with us that since we develop people, we do a lot of that physically. Okay, we meet people in sessions of 25 or 50 or 100 or sometimes 2,000. And from March 1st, all physical deliveries have been cancelled, everything. And that represented 70% of our revenues. So you can imagine that was quite a drama for me, going from all-time high in the stock price and a blasting full order book, and suddenly 70% is gone. And it happens just in a week. So we thought about very quickly, what do we do? And we came to the conclusion that 2020 for us would not be about maximizing profit. It would be about building for the future. We could have fired a lot of our people to maximize 2020, but what about all these people and their knowledge and their capacities and all the customer relations? We would have lost a lot. It's like tearing down half of the hotel just because it's half empty. It is not good policy, long-term thinking. And instead, we kept everyone and we said, yeah, we'll have less business, but let's take all our employees and focus on virtual. So let's try to take all our physical deliveries and put them on Zoom and other platforms and convince our clients. That's been an enormous undertaking. We'd never done anything virtual before this year. We trained everyone in BTS in this. We redesigned all our programs. We convinced clients to go virtual. And because of that, we didn't lose 70%. We lost 32% in Q2 and then 20% in Q3 because we've seen the market pick up during Q3. And interestingly enough, during Q4, even though Q2 we saw an enormous impact with enormous cancellations, in Q4, in the second wave, we are not seeing that because our clients, they already have a grip of how to run their operations now. In Q2, they didn't have that. And they're all now used to using virtual, and they're all thinking post-COVID. So the second wave has not impacted us. And in fact, we believe that although the 2020 numbers, it will be a profit, but much, much smaller than before, we see that in 2020, we've made the moves to virtual. We've kept our organization intact. We generated a lot of new clients. So we are extremely well positioned to take off after 2020 on a new graph. You see that beautiful graph of profitable growth, we have used 2020 to build for another beautiful graph going forward after this year. So I was asked to talk a little bit about innovation. So if you look at the next slide on innovation strategy, innovation is extremely important in our industry and becoming more and more important every year. And it's easy to go wrong when you innovate. It's easy to develop the wrong products, food that the dogs won't eat. How do you handle that? So we have 4 pillars in our innovation strategy. First of all, it's customer driven. We very rarely develop any solutions without having the first customer. And that means that we have validation. That means we have some financing. That means our project is much more market driven. And it means the project is also more efficient because we have a target customer and a delivery date. It's also decentralized. We have 850 highly educated people around the world. And I give them a lot of freedom. If they find customer needs and customers that are willing to pay and willing to commit, we allow them to develop on their own. And then we pick the best of what is created. And this has proven to be a very successful strategy compared to some other people who try to centralize all of this. They have one thing centralized, and that's the digital resources, because there's certainly scale advantages. And looking at the next slide, how did we handle this switch? This was enormous for us. 70% of our business gone. We realized that the only way is to go virtual. And we also think this is not only 2020. We realized that this is what's going to become big in the future. So how did we handle that? Well, first of all, we set focus. This was the only challenge. This is everything we did after March 1st. So 850 people focused on training, selling, redesigning, and becoming pro at this. And again, we didn't create one centralized team. That would have taken months to get going. We instead allowed our top professionals around the world to experiment. And then we have a tight communication. So we learned the best practices. Now we've been through this, and now we're centralizing back the best practices. A few words on our acquisition strategy. We have, during these 18 years of 14% growth, the majority has been organic, probably 90% over those years. But we have, in the later years, increased our speed of growth by acquiring companies. We have now the type of scale, and in our industry, there are so many small players, and with the global market and with the technology becoming more important, the smaller players are having a tough time. So we're getting a chance to acquire businesses, and we have a couple of purposes. It has to be either growing the service offering in a very logical way. So we find a product that we can sell that is connected to what we already sell. This way we got into assessment and into coaching. Secondly, getting into new markets. 5 years ago, I was not in Italy. We were not in Germany. We are now there because we bought organizations with 30, 40 people, one in Milan and one in Cologne. And we are now in those 2 big markets. We focus on small to mid-size. So that's 5 to 15 million euro. This means it's much easier to quickly increase the value of what we bought. It's easier to integrate, and it's less risk. It's very, very important with the talent and the culture fit, because we work closer. Now, looking at the slide, coming out stronger, we set ourselves goals back in March, where we said, okay, how do we make this year the platform for a long period of profitable growth? Well, when we end 2020, we said back in March, we're going to have a much larger customer base, which we have today. We're going to have a broader offering, which we have because now we have physical, virtual, and digital, a stronger organization. And even though we've kept the same size, we have exchanged some talents. There's always an attrition in the company, and in this year's market has been fantastic to hire great people. We also tripled our marketing budget. That was another decision in March. We realized now is the time to go get new customers. And we become much better at marketing also during the year. And looking at the next slide, the market outlook. So situation has improved during Q3, and this remains in Q4. We haven't seen a downturn due to the second wave. We believe physical deliveries will return when the corona restrictions are lifted, with some time lag. People will be careful, but virtual will stay huge. So instead of pure physical, we will have a combination of physical and virtual. We have a dividend policy where we give a dividend on roughly 50% of the profit after tax. And due to our very positive cash flow, we have this opportunity. And if you look at the next slide, you can see how our dividend has grown. And so it's 18-fold since we came to the stock market. And for the year of 2019, the board recently proposed to keep the dividend intact. We had a very profitable year in 2019. And due to a positive outlook going forward, the board has proposed to, in December, decide at the annual shareholders meeting and then distribute, if the shareholders meeting says yes, the same dividend. The next slide shows the 10 largest shareholders. So it's a combination of people who've been parts of founding the business and some major institutions. Most of them have been with us for a long, long time. Lannebo actually all the way since our IPO in 2001. Now with that, I have done my 16-minute presentation and I look forward to questions.
Yes, excellent, Henrik. Thank you very much for a good presentation. I start off with a question. You are a global company, as you said, so it would be interesting to hear what you see around the world. How well has Asia, for example, recovered from the pandemic as it was affected earlier than other regions? What do you see around the world?
I mean, first of all, a couple of things. Number one, in Q2, companies cut everything. Now they are looking forward. They realize there's a life after COVID. They've organized themselves and they've got used to virtual. Enormous change. Observation number two, the market is still very split. There are some industries, airlines, hotels, etc. They buy nothing. There are some industries, tech, pharma, etc. They buy more than ever. And then there's a group in the middle that who are a bit cautious. But all of those are moving in the right direction. In terms of geographies, it's true. We saw the impact of COVID already in Q1 in Asia. So the 70% drop we saw already in Q1 in Asia, and we didn't really have the time then to correct that. But we've also seen Asia come back faster. And you can also see that in Q3, our region where Asia is part is actually the highest performing. So I think they are leading for what's going to happen in the other geographies.
Okay, that's very good. And then a general question. I mean, looking in the history, you have had the largest demand and the highest growth in periods post-crisis when companies need to change and adapt to a new future. And it has also been a potential driver for you in the coming years after this pandemic. Is that how we should see it? And also, can you say something on the need for your services for companies when they have their employees working from home? Do they have a higher need or a lower need to incorporate a culture in general?
Yeah, I mean, this is a very good question. I mean, as I said in the presentation, the more change, the more business opportunities for us. And the 2020 pandemic has accelerated change for many companies. It has also created challenges for many companies. Many companies have employees now that are quite exhausted after living by Zoom at home for a whole year. They have employees who are perhaps wondering, what's the current strategy going forward? What's going to happen to our company and so on. So yes, there is a bigger need than ever for companies to invest in their people. both because of the change and because of the challenges during the pandemic. So, yeah, there are of course a lot of uncertainties out there a year like this, but we see lots of market opportunities.
Do you see, for example, companies with a policy that their employees should work from home for a longer time? If we take Facebook, for example, they have said that their employees should work from home until the end of 2021. Do they show a higher demand for your products because they need to live with that for another year? Or does it change based on policy here? Or do they wait a year to invest when people
I don't think there's a difference.
Yeah.
Really. Obviously, if people are working from home, you're right. There is a bigger need for our services because you're less connected to your peers. So there should be a bigger need, theoretically. And I don't have the data to say if that's true, but it could be.
Okay, interesting. Then I have a question on edtech companies in general. We see that some of them are growing quite significantly during the pandemic, as they have software tools and they could do remote educational tools as well. Do you see them as a potential competitor in the future for some parts of your business? I'm thinking, for example, about the Norwegian company Kahoot, which just got SoftBank as a majority owner, and the share price has rallied during this year. Is that something that is a concern for you, or how should we think about edtech companies?
I mean, you're absolutely right. I mean, the companies in the educational sector that sell software, they've done fantastic in 2020. Whereas the people who sell the training, they've done really poorly. And I mean, if I compare with peers that are public, if we lost 20% of our revenues, they've lost 40%. So those two parts of the industry have done have had different outcomes in 2020. What we try to do with edtech companies, they provide platforms so that big companies can organize all the learning programs they have and organize all the content and make it easier for their people to get access to this. And they're not competitors. We need to cooperate with them. So we are building our solutions. We have several clients where the clients tell us, please make sure that your content is connected to Skillsoft or is connected to Edcast. So it's very important that we can connect to them technically, because otherwise we can lose deals. But so far, we do not see them as direct competitors.
Okay, interesting. Have you looked at some pure software companies to acquire during the pandemic, or have you rather looked at people's businesses, companies?
We bought 2 digital companies in 2019. I think, we are interested in digital companies and in more consulting-oriented companies. Depends a little bit what we find. Of course, it's a big market out there with many players and people who have a lot of capital. So the way you succeed is to stay focused. If we go too far from our core, we will not be the best in the world. And the market is so big, so we can continue to stay focused and do what we do.
Okay. I think actually that was my last question. We only have 1 minute left of the session. So I think we thank everyone listening in to Henrik and BTS story. And thank you very much, Henrik, for participating in our seminar today. And I think that we will now.
Thank you so much for inviting me, and thank you everyone for listening in. Okay.
Excellent. Feel free to reach out to either me or Henrik, of course.
Thank you. Bye.
Bye.
Good afternoon and welcome to ABGSC Investor Days. My name is Jesper Birch Jensen and I work as an equity research analyst here at ABG. And with us today we have the CEO of G5 Entertainment, Vlad Suglobov. He's going to tell us a little bit about the company and their plans for the future. With that said, please go ahead, Vlad.
Good afternoon, everyone. Thank you for staying until the last presentation of the day. As Jesper said, I'm the CEO and co-founder of G5 Entertainment. We are making mobile games, casual games, and we identify our primary audience as women over 35 years old. They comprise about 70% of the company's audience. Let's go through the presentation and switch to the next slide. Yeah, you can see we had quite a dynamic development over the years in terms of the revenue and earnings as well. We are operating on a global and huge market, which is the fastest growing part of the video game industry. We have 7 offices in different locations around the world, with our development offices primarily in Eastern Europe, which gives us a unique advantage in terms of the cost and the class of the game development talent. We've created some very successful games in our history. The Secret Society made over $130 million in sales and achieved 30 million downloads. Hidden City exceeded that, made about $330 million to date and achieved 17 million downloads. And we have released 7 games in 2020. We have one more which we may release until the end of the year. Maybe it's going to be on the edge of the years. But there's one more game that we have prepared for this year. And then our plans for the next year include about 5 or 6 games. I think I said 6 in the previous report. So we have quite a lot of stuff going on in terms of the development pipeline. We've been listed on Nasdaq Stockholm since June 2014. And we were public in Stockholm since 2006. We were previously listed on NGM Nordic and then Aktier. And then in 2014, we relisted to Nasdaq Stockholm. And we received some awards for the quite dynamic growth that we have had over the years. Let's move on to the next slide. So the market we operate on continues growing. The largest part of that market is Asia, but we are not that active in that part of the market. Most of our sales are in North America, about 58% as of the last quarter, but still we have 15% of sales in Asia, about 21% in Europe. There is strong underlying growth in the market of mobile games, and of course, it has received extra attention this year due to lockdowns. A lot of new players were introduced to mobile games as they try to, find something to do and entertain themselves during the lockdowns. We believe that this can be a very good boost for the industry and ourselves as well. That will not really go away because our games are designed in a way that they're very enjoyable. And so once you are you're used to playing our games, there's a good chance you will come back to playing our games. We, in a way, these lockdowns were kind of a free promotion for the company's products and other mobile games. And I think this will accelerate people moving into mobile games, playing mobile games. And, it will just help move the industry forward. Going forward is going to be a good, positive wave to ride, so to speak, even if the pace of growth for the overall market can not be going forward may not be as fast as it was this year. So yeah, I think we covered this one. Let's go over to the next slide, please. So mobile games is a relatively new phenomenon. They have started appearing around 1997, as you can see from this amazing infographic. And then around 2008 was when the iPhone came out, and this really changed the dynamic of the growth of the underlying market. With this change of generation of the phones and the introduction of tablets, the market quickly became the fastest growing part of the overall games market. And this is the market we are operating on. And obviously, this is also the market. I mean, this is the reason we were able to grow so fast. But at the same time, this market continues to be growing really fast. And as you can see, it now accounts for almost half the revenue of the mobile games industry. Let's move on to the next one. Thank you. If you look over the last few years of G5's history, what happened was that until 2008, we have reached unprecedented revenues on the quarterly and annual basis. A lot of that revenue was driven by the licensed games, the games that G5 did not develop internally, but rather G5 has published. At the same time, we continued developing games ever since the company was founded. So we already had a strong development teams inside the company, and we had some very successful games that we have developed internally as well, like Mahjong Journey, for example. But a couple of years ago, we decided that we really need to focus on developing more games internally and to raise the quality bar. We had the means of doing that. We just needed time. We needed to hire more people, create more teams. And we wanted to create all the new games that we used to source from external developers, but this time do it internally. We could afford this investment, and we could afford potential downside, as not all games are equally successful, but this would expose us to a lot of upside, and we would not need to share as much revenue with the developers. And we believe that we had the knowledge and the understanding of the market to be able to be successful with our own internally developed games, even on a higher scale. So we started hiring more people around 2016. As you can see, we went from about 300 to about 700 total number of people in the company. And we started releasing what we call a new generation of internally developed games in the summer of 2019. And as you can see, there was this point between Q2 and Q3 2019 when the quarterly revenue from own games started growing substantially. And then we had this quite amazing jump from Q1 to Q2 this year. And as I have mentioned, we have benefited in a way from the situation with the lockdowns, because a lot of people had nothing better to do but play mobile games. So we were happy to be there for them to provide some entertainment. And a lot of people have downloaded our games over the second quarter specifically. And for us, it has been almost like a free marketing in a way. And this, we are still enjoying, I think, the increased attention. And Q3 is not even the strongest quarter of the year. Usually it's kind of on a weaker side, but we continue to see strong performance in the third quarter and now in the fourth quarter. Although the lockdown effect is not as strong, we still see the increase in the number of downloads that we believe in part is seasonal, because Q4 and Q1 are seasonally stronger quarters with many people staying inside and playing more games. But also with reintroduction of lockdowns, even on a smaller scale, there's even more incentive for people to stay home and enjoy mobile games. So we really look forward to the rest of the fourth quarter and the first quarter next year, as this is historically the strongest period of the year for the company. Let's move on to the next slide. So the games that we offer our users vary in genre, but they all appeal to the same demographic, which we can see is predominant demographic among our audience. There's hidden object games where you try to find objects, but there's a lot more than that. But the core gameplay is that you try to find objects on these beautifully rendered backgrounds. And the latest example from that genre is the game called Sherlock that we have released just a couple of months ago, maybe a bit more than a month. There's match 3 games. And although this is the second smallest genre for us, the first one being Hidden Object, match 3 games already account for a substantial percentage of the company's revenue. We make millions of dollars on a monthly basis, and the overall market for match 3 games is huge. It's way bigger than Hidden Object, and we only have a tiny slice of this market. So this market presents the biggest opportunity for us. Probably if we can get to having 1% of this market, this would already be several times over in terms of the current revenue that we're generating from this market. There's also Mahjong Solitaire market where we have a sizable percentage of the overall worldwide market. We are one of the leading developers in this genre. And we have Mahjong Solitaire, Mahjong Journey game there as our largest, but we have the new generation of Mahjong games that are also catching up quickly. We also have one game in word puzzles category, which is doing quite well, but nothing special yet. And all of our games are connected by the G5 Friends network. I think it's becoming even more important given the situation where everyone is spending more time at home, and it allows you to play with friends, communicate with friends, buy gifts for friends. And we can see that the usage of this network is growing over time. And we've been doing this for many years. It was always our vision that games are naturally a social network for people who play them. Let's move on to the next slide, please. The way we develop games and kind of our thinking and our strategy in that regard is that we think of our offering in the market as a portfolio. It is difficult to predict which games will be successful, which games will not be very successful. So we always think in terms of creating a number of games where each game is, is kind of, we're trying to test the thesis that this type of game is going to be popular in the market. And we try to place these bets, but the outcome is determined by the performance of the whole portfolio rather than one game. Sometimes we have runaway successes like happened with the Secret Society, Hidden City, and prior to that with our own games, Mahjong Journey and Virtual City Playground. And these stars drive the performance of the whole portfolio. But we can work with having these stars, and in the absence of these stars, we can still continue performing and showing great performance and great profitability. So as you can see, from 2019 to 2020, the revenue from owned games now comprises about 62% of total revenue of the company. And that's quite a reversal of the situation a couple of years ago when it was only 30%. So there has been great progress there. And while our licensed portfolio has been going down gradually over time, still generating very strong cash flow and a lot of profits for us, it was declining. And then the revenue from the new games released from 2019 has been kind of replacing that revenue. And these are the games that have been growing over the last year. Some of the games that were driving growth during this period of time is Jewels of Rome, Jewels of the Wild West, Jewels of Egypt, and Town Makeover. And now Sherlock is performing very well and also driving the top line growth. I've mentioned we have released 7 games in 2020. We have more development teams than we've ever had. So as you can imagine, we are developing all within the framework of a portfolio of games. Let's move on to the next slide, please. So on this slide, we have kind of a theoretical chart of the revenue performance from a single game in a portfolio. And obviously, we start with creating a minimum viable prototype. A game that is complete and provides full experience for the player, but at the same time, it has just enough content for maybe a couple of months. And we release that game to the market. We look at the analytics and how well it is performing. And if it performs well, we start scaling the game with the user acquisition, and that is paid marketing. And we go through the period of growth. Eventually, a game usually achieves some sort of ceiling, which can be overcome by improvements to the game or improvements to the marketing strategy, but usually it peaks at some point. And this is the point where the game is no longer contributing so much to the growth of the top line, but it starts to contribute a lot to the profitability. And as you can see, most of the profits of the game is actually made after it has peaked, so to speak, and after it has stabilized on a certain level where we don't spend as much money on user acquisition, we just collect the money from previously acquired users, and we spend only a limited amount of money reinvesting in user acquisition. And that's the situation right now with the older part of our portfolio. Although it is stagnating gradually or flat, we are making a lot of profits, and most of the profits that this portfolio is going to make is still ahead of us. So you can think of it as money in the bank, but you are collecting them gradually. So that's the older part of the company's portfolio. And then the new part of our portfolio, the new generation of games, is showing really strong growth. For example, in the last quarter that we have reported, it was plus 72% year over year for own games and plus 425% year over year for the new generation of games. Let's move on to the next slide. So once we launch the games, they are kind of in the left bottom corner, according to this diagram. And depending on how well they perform, how far they can reach in terms of the monthly revenue, they become stars, or if they do not become stars, but we still want to make money from them, we move them to the harvest mode to the right, and they become small cash cows. And we just try to take back the money that we have invested in the development of the game and then some. And most of the games that we develop, they actually are profitable over their lifetime, even if they're not adding a lot to the top line of the company. We do get the money back with a healthy margin. There are, of course, a few games that have lost the money to the company, but that's part of the portfolio approach. You have some losers, you have some average performance, and then you have some really strong performers. Some games like Hidden City, The Secret Society, Mahjong Journey become so big in terms of the monthly revenue that we call them the big cash cows. And we never really remove the team from these games because we continue making updates because there's a large audience and large revenue that justifies making monthly updates. And this can happen over many, many years while we are collecting profits from this type of games. Let's move on to the next slide, please. So the third quarter of this year really shows what I've been saying is that we were riding fundamental, several very important waves. Obviously, one is environmental in the sense that this is the way the lockdowns worked for the companies, that we had much more attention from the players in the second quarter. And I think some of that continued into the third quarter, although there was quite a cooling down in that regard. But there are two fundamental changes in the company over the last couple of years that are really showing the results right now. And one is those extra teams that we have and all these new games, new generation of games we have launched since summer of 2019. And the second one is the improvements we have made to user acquisition. We have changed the management in user acquisition about a year ago. And then for some time, they were looking at what's going on with the company and coming up with the recommendations. And starting at the beginning of 2020, we were able to optimize our user acquisition spend quite a lot by introducing additional tools, by kind of reshaping the process that we used to do it, and by adding more user acquisition managers for more granular approach. And so in 2020, we see that we are spending a smaller percentage of our revenue back into user acquisition, and that has really affected the profit margins positively. And the fact that 62% of revenue is generated by own games, and on this part of the revenue we don't pay royalty, was another big factor for the expansion of the profitability of the company. And we believe that both of these factors will continue going forward. Even lockdown situation may or may not continue. We all hope it's going to be over soon. We're happy to be there for the players in the meantime. But I also think that the biggest impact from the lockdowns is already behind us. And what we are seeing now is that just people enjoying their mobile games and seasonally strong quarters ahead of us. Just because everyone wants some entertainment and something good after this year. So the results of the third quarter were, as I mentioned, quite strong. Own games grew to 62% of total revenue. Was only 54% in the second quarter. The growth of own games year over year was 72%. New releases performed really well. And another interesting metric that we're tracking is the monthly average gross revenue per paying user. It's the metric of monetization of our users, how well they're paying. It actually increased 31% year over year compared to last year. And that is due to two reasons. One is that more people in our audience are playing match 3 games, and they are higher monetizing than Hidden Object. And the second thing is that because of the improvements to our user acquisition process, we were able to acquire higher quality of users in terms of monetization. Let's move on to the next slide. So when you look at our revenue in Swedish kroner, you have to remember we do not really have revenue in Swedish kroner. 58% of our revenue is in USD, 15% mostly in Japanese yen, and 21% in euro. So we report in SEK, and that distorts the picture a little bit. So while the revenue year over year in Q3 went up 10%, the underlying growth in constant exchange rates is actually stronger. And sequentially from Q2 to Q3, in Swedish kroner, the growth of own games wasn't as spectacular. But again, adjusted for FX, there was a 13% advancement just quarter to quarter in terms of revenue from own games. Yeah, I think I covered other metrics, so let's move on to the next slide. As I mentioned, we have these fundamental improvements in the business that have allowed us to substantially expand earnings margin this year in 2020. And as you can see, this already started in Q1 before we even had any effect from lockdowns and COVID-19. So we continue in that regard, and there's strong performance in earnings. And it is important to understand that this is driven by fundamental changes to the business. One, larger percentage of revenues generated by own games, and another is much more efficient user acquisition spending. And having all these new releases marketed efficiently leads to the expansion of earnings margin and the gradual expansion of gross margin as well. Let's move on to the next slide. In terms of cash flow, we're doing really well. We have zero debt. We are putting money into the account pretty much every month. And you can see that at the end of the Q3 this year, we had the highest cash balance for this time of the year. And this is despite paying out a dividend this year and also spending, I think, about twice that amount on the buybacks, given good market situation. So the cash flow is strong, cash conversion is strong. There's zero debt, and we continue investing part of that cash back into developing new games, and we have more than enough to continue developing new games and bringing them to the market this year and next. Let's move on to the next slide. So the outlook for the company is really bright, actually. the revenue from own games continues growing, and the revenue of the company becomes more diversified. We're not as dependent on a single game as we used to be. Having a star in a portfolio that accounts for a large percentage of your revenue is great in some respect, but also kind of a little bit more risky because you depend so much on the dynamic of one single game. And I think we are moving into, for now at least, to another phase of our development when we are not really that dependent on any single game, and it is a much more diversified portfolio of games. So you can expect us to deliver more stable top line performance, and the same applies to earnings. We have said that as we have optimized user acquisition spend, we intend to maintain about the same percentage of reinvestment of revenue back into user acquisition. It can go up a little bit over time, but there will be no large swings as it used to be in previous years. With all the new games that we have released over the last year and a half, we have a strong growth foundation to continue to perform. We have the largest number of people in the development teams and in user acquisition teams, and they're doing a great job, and they're preparing new games, and they're preparing amazing new holiday content for existing games. This quarter, again, I think the underlying situation is really beneficial to us because people will probably be spending a little bit more time at home than in prior years. And we can see there's a lot of interest towards entertainment content towards the end of the year, as everyone is spending more time during colder period of the year and kind of reinforced by the reintroduction of the lockdowns. So I think fundamentally, it's a good situation for the company. It continues Q4 and Q1. But that said, I think this extra attention that mobile industry has received, mobile games industry has received, and G5 has received, brought us a lot of new players, and this will continue to benefit us in the years to come. And the most important thing is that we have managed to accomplish this strategic transformation where most of the company's revenue is now generated by the company's own games, and we became much more efficient at marketing these games. So this has started even before the COVID wave, and this will be with us even when hopefully this thing is over and we go on with our lives. And I think what happened is that we kind of moved forward towards the curve of the growth, like with all things digital, and this will benefit the industry and ourselves, of course, in the years to come. Let's move on to this next slide if there's anything left. Yeah, this concludes the presentation. Thank you.
Thank you, Vlad, for that thorough rundown of the G5. And a couple of questions for me. I think I'll start off with some questions about your most recent games. Obviously, you released 2 new games here in Q4, Sheriff of Mahjong and also Sherlock, the Hidden Match 3 cases, which you touched upon. And I was just wondering, can you tell anything about the data so far for these games in terms of long-term potential, in terms of revenues?
Yeah, it is still a little bit too early, but we see that Sherlock is performing really well. I think it's a combination of well-known characters, because it's a game about many books, but the main character is Sherlock Holmes. I think it works really well for the players. Sherlock also is a combination of match 3 game and a hidden object game, and both are the favorite genres of our audience. So we see it's not very fast growth, but it's very steady and stable growth with large organic component. So I believe this game is going to perform well. I cannot say on what level, we will see, but there's still a lot to do in terms of the continued development of the game. It doesn't have all the standard quote-unquote features that most of our games have. So there's still a lot of potential for the development team to improve the product over the next couple of quarters. With the Sheriff of Mahjong, I think also it's going to be a stable and good performer in our portfolio of Mahjong games. I think it has potential to be one of the best performing Mahjong games in our portfolio. So I'll leave it at that.
Thank you. And just a final question on your new games. In November you released a game called Supermarket Mania Journey, and I just saw some data from Sensor Tower saying it was your most downloaded game. What are your feelings about that game, and can you say anything about what the data is telling you there?
Supermarket Mania Journey is many years old. I think at least 4 or 5. I think it's one of the examples, but you're right that it generates a lot of downloads. It's one of these games that has been in the harvest mode for a very, very long time, but it continues to drive downloads organically. It's interesting. It's an interesting example because I think in the second quarter last year, it has generated more downloads than any other game in the company's catalog, because there was such interest in supermarkets that we actually saw the downloads for this game go up substantially. And the revenue of this game, I think at that point it tripled or something from a low base, but it contributed to the performance of our old catalog of games quite well. And it's one of the examples of this really long tail of sales of games that were released and put in what we call a harvest mode without much support many years ago, and yet they still continue generating money, and sometimes they even go up on whatever the trend happens in the society that kind of awakens the interest towards this type of games. So it was very interesting for us to see. We even started thinking maybe we need more time management games in our portfolio, although we haven't been making them for some years. Maybe this is something for us to explore.
Thank you. That's quite interesting. Moving on to some questions just in regards to COVID-19. I mean, obviously a lot of mobile gaming companies saw a large inflow of players in Q2. Now there's new lockdowns here in Q4. Are you seeing similar types of inflow as you saw earlier this year, or is it more stable?
Yeah, I would say there was a strong increase in the downloads Q1 to Q2 this year, and then Q3 was kind of the reversal of that. We delivered very strong performance in terms of financials, but underlying new downloads actually went down as people went about their business, having their vacations, etc. Now in Q4, we are seeing that the downloads are coming back to around the level of Q2, which is, which is quite interesting. Although I don't think that the lockdowns are as seriously considered as in the second quarter. But nonetheless, we see that there's a lot of downloads, and it's comparable to what we had the second quarter. I think it's just the seasonal effect. Usually, we have a good increase, from Q3 to Q4, and then Q1 is really good performance as well. And we are able to deploy a little bit more user acquisition capital as well, usually in Q4. As I mentioned, it's not going to be a big difference, but it can be slightly higher than before. And I think it's a combination of these 3 things: slightly higher budget on user acquisition, just people really willing to play some games towards the end of the year as it's colder and they spend more time at home and buy their new devices, and also in some form the reintroduction of the lockdowns or this continued background information where authorities are telling them to spend more time at home. It also benefits us.
And also, you kind of touched upon this earlier, but I'm just wondering, what's your view of the long-term effects of COVID-19? Do you think we've created a new, larger base on which you can grow? Or are you seeing that type of retention from the new users which has come in during COVID?
I think we have pushed the civilization, if you will, forward with regard to all things digital, right? We've even when this is over, there will still be a lot more remote conferencing instead of in-person meetings. I believe so. There will be more education online, and people will play more games online. They will interact more with each other online. If you do something for a couple of months, it becomes a habit. Especially if this process is enjoyable and convenient, and you see the benefits of doing it. So I think we just had some years of advancement of all things digital kind of compressed into just a couple of quarters. And there are a lot of new habits developed for the population. And this will benefit all things digital in the long run and games as well. So I don't think, I just think it's it's an unfortunate thing that happened, but it at least something good came out of it.
One last question. I think you've probably gotten this question before, but I think it's worth highlighting or asking again because it's kind of gotten some wind recently. And it's in terms of user acquisition and how that might be affected by the upcoming changes to iOS 14 and the IFDA process. Apple is saying that the change is going to come early next year. And it could affect the effectiveness of user acquisition. And I was just wondering, how are you working to prepare for these changes? And do you see them having a large effect on the ROI on user acquisition for G5?
I think the whole industry of advertising, performance advertising, user acquisition is preparing. We hear it from our partners that we work with that they are preparing. I think we will be in the same situation as all the other game developers, right? It's an even playing field. This change happens. It happens for everyone. It may affect prices in the market. Maybe they become lower, but we will still be able to measure the performance. On a level that we did it before, we will continue to be able to measure the performance. There may be some loss of precision or granularity when it comes to measuring the performance on advertising, but I would say we never went to that level. We always operated on a higher scale, like on a cohort level, rather than the level of individuals. So I don't see that this will affect us dramatically. And most important is that this change will affect all companies in the field equally. So we are preparing. We know that our partners are preparing. I think we've made a lot of very important improvements to our tools, and we will comply, of course, with any policies that Apple introduces. But also, I think that Apple, as a company, is really interested in their service revenue, right? And in growing their service revenue, and they were always saying that. So I believe it is in their interests to not, create too much of a trouble for the developers that are driving this revenue. So I think some things will change. I do not expect anything dramatic to happen.
Gotcha. Those are all the questions for me. Thank you, Vlad, for joining us today and presenting G5.
Thank you, Jesper. Thank you for having us.
Thank you.